go after anyone, but he didn't name China by name in that sense. So that's the, I said this yesterday morning as well. Iran anyway has been one of the most heavily sanctioned countries in the world for decades now. So this is another layer. And this is, by the way, secondary sanctions. So, I mean, not just on Iran, but anyone who deals with Iran also now faces U.S. Sanctions. So that's that. Now, U.S. equities is the other bit which closed lower. S&P was down a third. NASDAQ was down about 0.8%. And NVIDIA was down about 3.5%. NVIDIA, of course, reports numbers tomorrow. That is going to be after market hours. Now, the third leg is U.S. bonds. U.S. bond yields cooled, especially on the long end. The 30-year was down 5 basis points to 5.23% yesterday. And, again, there was, by the way, there was a story on CNBC, our network, sister network, where they said that U.S. Treasury is contemplating using the general reserves, about $1 trillion of general reserves, to fund the increased long end of the buyback program, which the Treasury has been talking about, the Secretary has been talking about. Secretary Bessent was asked about it. When he appeared in front of the media at the press conference, he declined to comment per se, but he avoided, essentially, and maybe we will hear something later. But you have this, article which is getting a wide amount of press, globally, which is written by Stanley Druckenmiller. By the way, Stanley Druckenmiller is one of the greatest of all times in terms of macro traders, and he and Treasury Secretary Bessent were also, by the way, at one point colleagues. He's written a piece, op-ed for the Wall Street Journal. It said the title is "Let the Bond Market Speak," and I think it's extremely illustrative. I mean, all the arguments why they shouldn't try and suppress, yield curve, not near, not long term, and all the consequences of it. There's just one line, right? Every basis point of artificial yield suppression is a subsidy to procrastinate, which you can only ill afford at this point in time. So it's a fantastic piece. I urge you to go and read it, the full article. So really puts that entire context in the entire debate around U.S. managing treasuries, managing borrowings, the fiscal part of it, etc. Essentially making the point, this is not a technical problem to be solved. This essentially is a fiscal issue. So I think it's a discussion we'll keep having. I'll just tie in the levels here. Every day, the point is that the markets, of course, been, to use the bond yield analogy, has been suppressed, but of course for different reasons. And it's been suppressed for a large measure because of all the supply, right? I mean, look at the amount of new paper which is coming in, IPOs, blocks, QIPs, etc., etc., etc. And I think it's just incredible. All of it, of course, is getting absorbed. Some of the new paper is finding great reactions as well. And yesterday was a case in point with this jewelry company which did very well. But I mean, it's if you just map it out in terms of the next few months, the supply is incredible. The amount of paper which will come to the market continues to grow. I mean, the lineup continues to grow. The levels are on your screen. 24,130 is the first support. 24,025 is the next support level. Both are very, very near term. And on the upside, 24,270 is the resistance level. So if you want to work with a band, the 24,270 is a downward sloping trend line. And 24,130 on the downside is an upward sloping trend line. It's kind of sort of, we'll see. The point is, in a very near-term basis, you can make the argument the last 15 days that the market's been making lower highs and lower lows. But if you look at, what the market has done since the lows of April, you're essentially still in a higher high kind of a situation. So the hope is that you will eventually break out on the upside. GIFT Nifty comes up on the screen, gives you a quick sense of how we start. It's about 50-odd points lower. Nigel has walked across to the wall with the F&O-Qs, the positioning. Nigel, take it away.
Well, that's right. The Troika is actually well behaved this morning because crude, the US 10-year yields, as well as the dollar index, all of them are softer today in comparison to what we started off yesterday. But today is going to be monthly expiry for the August contract. So volatility will pick up, particularly in the second half of trade. Moving to the flows then, well, the DIs, they were buyers yesterday. The FIs were sellers. But as you have been saying that, the last few days, on a day-to-day basis, you have a lot of supply of paper, a lot of large trades as well. So that's why the data is skewed. The Nifty rollovers more or less in line with what we have seen in comparison to averages. What about index futures? What did both the big participants do? That's the FIs, as well as the clients in yesterday's trading session. So the FIs, they added close to around 10,000 short contracts approximately. While the clients, they went ahead and the swing factor out there is close to around 10,000 long contracts. Why do I say that? Because they covered 2,000 shots and they added some long contracts as well. So both of them moved in their respective directions. That's the FIs. They got a little bit more short in comparison to what they were yesterday. And also, if you look at the client side, well, they added more longs on already a net long position. So that's what takes the FI net short positions to around 2.2 lakh contracts thereabouts, while the client net long positions have moved to around 1.8 lakh contracts also. So 10,000 contracts is the swing that we saw on both those two out there. Moving to the index options, it's going to be important, but getting into the expiry day, actually the FIs, they wrote calls very aggressively, and some of those puts were unwind. And because of this kind of aggressive call writing, we have seen that the PCR has come down to around 0.83. Remember, yesterday at the start of the trading session, it was at around 1.11. So the call writers came back into play, and a couple of strikes were active. 24,300 call, well, you had more than 80 lakh shares getting added there. The premium has come down to around 30 bucks. 24,200 call as well. The premium came down to around 60 rupees. So there was more than 1.5 crore shares that got added at these strikes. Moving to the levels to track then, going by the technical levels, going by what the options data is suggesting, the recent low, that becomes the first reference point on the downside. You don't want this to break on the downside. And on the upside, closer to around the 20-day MA, which is ballpark around 24,350. That's going to be the broad range for the day. Volatility in the last hour of trade. And then, in fact, we do start the next series. And then I think we get a fresh trend. But the bias, I still think, is more towards the upside than the downside, going by the current cues that we have.
All right, thank you very much for that. And now let's get back to the big Besant press conference that we were waiting for yesterday on new and secondary sanctions against Iran. Well, Washington has indeed announced that it is enacting fresh sanctions against Iran to sever all financial support for the regime. Besant also added that U.S. President Donald Trump is urging allies to support the measures. Listen in to some of the important comments.
Iran now faces a very clear choice, with only two paths before them: complete global isolation and a subsistence economy, or a path back to normalcy with an opportunity to rejoin the global economy. Today, we are launching Operation Economic Outcast to foreclose every other option available to the Iranian regime. Beginning today, the actions of Treasury and other agencies will tighten the noose and block every potential source of revenue that funds the IRGC and the evil Iranian regime. We are enforcing a zero leakage approach. There will be no minimal breathing space for the regime to rebuild its capacity to inflict terror against America and the world. The President is making phone calls to world leaders with specific requests to cease their interactions with the regime. We are already seeing results. No one is above the reach of U.S. sanctions. That if they facilitate transactions and are part of the ecosystem that turns Iranian oil into money, into repression, they will be targeted.
Well, for now at least, the U.S. government is avoiding immediate secondary sanctions against the government. So individual entities, vessels have been sanctioned, but not the government or friends of Iran. And when one of the reporters asked Scott Besant about it, why not implement secondary sanctions against the government? Well, he said, we don't want to blow up the global financial system. William Lee, Chief Economist, Managing Director of Global Economic Advisors, is now joining in. William, great to have you. Your view of Operation Economic Outcast, what are the implications?
Well, it's really quite one step in a whole maze of steps that are being taken by the Treasury Secretary, both vis-a-vis Iran as well as the Treasury market. And we also have heard him comment on the discussions with Canada. So there's a lot on the plate right now. But I would say the effectiveness of these sanctions is going to depend clearly on the most important patrons for Iran right now, which are China and the Soviet Union or Russia. I think one of the things that we have to keep in mind is that Iran would not be able to exist or do anything without the implicit support from these two countries. And I think as much as President Trump wants to preserve good relations prior to President Xi's visit to the United States, and he still has some hopes of influencing the Russian-Ukraine conflict, I think they're holding off on mentioning anything about sanctions with these two governments. But it's going to be key to the effectiveness of this program is whether or not the Russians and the Chinese will cooperate.
So without China and Russia being involved, I mean, being sanctioned at a government point of view, you don't think this is going to be very effective anyway? The Iranian economy is in sort of collapse. The rial has plunged to historic low levels. Inflation is running high. So it's already been choked. It's been sanctioned for a very, very long time. What is going to be the incremental impact of this? We've not seen a reaction in crude prices. So from an equity market point of view, what will be the impact knowing what we know today?
The global equity markets, I think, are taking these statements, essentially as statements. Right now, there's not much reaction at all, as you saw all day today. There's the key, I think, is going to be whether or not the Iranian population is going to be able to put up with the economic pain that it's been bearing for decades now. The regime still has a very tight grip over the population, and any possibility of revolt or internal dissent seems still to be controlled by the IRGC. So until somehow we find some sign of domestic unrest appearing, these sanctions are just going to keep the pressure on until that happens, and that may be a while. As I said, I think the only other way to accelerate the process is to have the governments of China and Russia start to cooperate with us, and it doesn't seem like that's going to happen soon.
Got that, William. The other one, of course, is what's happening in U.S. Treasuries, right? The Druckenmiller article in the Wall Street Journal warning against yield suppression getting a fair bit of press, obviously, because he's a practitioner, well regarded. What's your view, William? Will this just blow over? I mean, 2 weeks down the line, will we be talking about this?
I agree with Druckenmiller that ultimately the level of the U.S. Treasury is going to depend upon our fiscal solvency or insolvency and the path toward insolvency, how fast it's going to take place. The maneuvers that Scott Bessent has put in place is typical of what a hedge fund manager does. If you remember the days of LTCM, the on-the-run, off-the-run arbitrage was something where they made quite a lot of money. And for Bessent, it's not the purpose not to make money, but rather to provide some liquidity and lower the volatility in that 20-year off-the-run, heavily discounted and relatively illiquid market. But in terms of actually keeping the rates low, that's going to have to depend upon the future tax trajectory and where the deficit is going, and that's not going anywhere but up. So I think Druckenmiller is absolutely right to say that these holding measures are a nice signal on the part of the Treasury Secretary to say, I'm watching you guys. I'm making sure that whatever volatility is in this off-the-run market at the 20-year level is going to be moderate. And if anything, I'm going to be supplying enough liquidity to ensure against any kind of excess volatility. The key is the level. And right now, the level is being pushed up by all the factors you mentioned earlier. And I think very, very much so the AI capital call that's been made on the debt markets to finance a lot of the infrastructure.
All right. Hi, William. William, what about the Jackson Hole Symposium? That's what's scheduled for later this week. What do you expect to hear? Positioning? Or do you expect, him to give some indications? I think you've been in the camp that believes that there's no hike coming.
I firmly believe that it would be a serious mistake on the part of the Fed to hike in the face of the kind of inflation we're facing right now, because it's supply side inflation, and everyone learns in Econ 101 that supply side inflation is something you look past because it is a temporary bulge in prices, and unless it changes inflation expectations, you should just leave it alone. And right now, there's no evidence that medium-term inflation expectations, as measured by the break-even, say for the 5 years, have changed at all. They're stuck pretty much at the 5.25 level. But I think what Chair Warsh is going to do is depend upon his committees to come in with some kind of recommendations as to how he might move forward with reforming the policy framework for the Federal Reserve. And what I expect to see at the Jackson Hole meeting is a hell of a lot of jockeying on the part of the dissenters. As I said earlier on your show, I'm a firm believer that the presidents of Cleveland and Dallas are trying to establish their inflation fighting credentials and their strategic thinking credentials, because both of them come into the Fed as policymakers from positions of being traders. They were market tacticians, and they would be right with you, Nigel, in terms of talking about where the resistance levels are and where the support levels are for various interest rates. But they have to demonstrate to the FOMC and to the world that they are strategic policy makers and that they are capable of thinking big picture. And this dissent that they've been so vocal about, I think, is just a lot of bluster to establish their inflation fighting credentials.
William, if you're a contrarian, what will you do? Go long bonds?
When you have the equity market doing so well, why would you allocate to bonds?
I'm just saying, if you're trading, right? No one thinks they've got this under control, right?
That's right. And if you are a fixed income house, you're stuck with that portfolio. But right now, I would be cashing in a lot of my fixed income stuff and going more toward where the true action is, especially with a horizon of, say, 3 to 5 years. And so for the short-term rates, they're likely going to go down, I think, if the Fed does ease. And the long-term rates are going to be going up. So you're going to be losing your shirt hanging on to long-term treasuries.
Okay, well, William, we'll see. Thank you very much for joining us. It's always a great chat. Appreciate you joining us here on CNBC TV 18.
Thanks,
well, let's just quickly run you through the interactions which are lined up on the program. So 8:30, we get you a conversation with the management of TCS. They've announced an acquisition, a large deal, and you'll hear from both the TCS and the Porsche management on it. 9 o'clock, we'll be joined by Rakesh Arora to talk about the metals space. The space has been seeing some action lately. 9:20, we have someone from Axis Capital joining in to talk about markets. Darshan Hiranandani and Santosh Kumar will be with us at 9:40 to talk to us about the real estate space. 9:35, beg your pardon. Ratnamani Metals and Tubes is the company at 9:45. They've got some export orders, and of course, business outlook will be in focus. And Lata in conversation with Swamikanti Ghosh of SBI and Sakshi Gupta of HDFC Bank on the first quarter GDP numbers due on the 31st of August.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you. Get to that in just a bit. For the time being, I give you a sneak peek. TCS, Pyramidal Finance, Seagull India, Afcons India, Brigade Hotel Ventures, all of them will be reacting to positive news flow. Add to the list Sigma Advanced Systems and Sudarshan Chemicals. On the flip side, Hindustan Copper, Lenskart and IFL Finance will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, both of you. But let me begin this one because TCS will be the big stock to watch today. Now, the company has announced that they will be acquiring 100% of Porsche's IT services subsidiary. It's called MHP. For this, the company will pay 320 million euros. As a part of the deal, TCS also has a confirmed commitment, a 5-year partnership for 1.25 billion euros. So the good part about the deal is, one, it's inexpensive. The valuation is done at only 0.5 price to sales. Secondly, it supports growth in the near term. So, the company is hopeful of closing in Q4 of FY27. So FY28 money comes in. And then plus, you get industry expertise in the automotive segment. Porsche becomes an anchor customer, confirmed revenues, capabilities in software development vehicles. The negative, perhaps, is that the acquired company's revenues have declined now for 2 consecutive years. It was 828 million in calendar year 2023. It came down to 742 million euros. And that's because generally the entire European automotive segment went through a tough period from a macro point of view. Also, secondly, margins for the acquired company are lower than that of TCS. So initially, it will be margin dilutive. And plus, as a part of the deal, they onboard certain employees. They'll take on 4,500 employees, and those employees are based in Europe. So higher costs associated with it. But again, it's a good move. And this is the third acquisition done by the company in the last couple of months. There was ListEngage, Coastal Cloud, and now acquiring MHP with a partnership, a larger partnership with the Porsche Group. So we'll have to see how this one opens up.
Okay, all right. I'm tracking Hindustan Copper, and the stock will start off in the red because yesterday an OFS was announced. But you look at the stock price action, yesterday it appeared there was a bit of a hint that there could be something that was coming about because in the final 30 minutes, the shorts just piled in. So, but still, the stock starts off in the red because, the flow price is at a 9.5% discount in comparison to yesterday's close price at around 514 rupees. The government is looking to divest close to a 3% stake. They have an additional option to divest another 3% stake. So if they go ahead with the entire 6% at the flow price, they should, raise close to around 3,000 crores. The shareholding pattern comes up for you in the screen. So the government of India currently holds around 66%. If they go the entire hog, then in fact it comes down to around 60%. FI holdings around 6%. And DIO holds roughly around 4.8%. Most of that is LIC, or more than 50%. What makes Hindustan Copper stand out? Well, it's the only listed pure copper miner in India, only play on copper prices as well. They have access to close to 45% of India's copper ore reserves as well as resources. Now, the stock, in fact, looks favorably placed in terms of the backdrop with regard to the global theme that's playing out, shortage of copper, strong copper prices. However, on a trailing basis, it's trading very expensive at more than 50 times. However, if you look at what Anand Rathi has put out, they're expecting the EPS to double in the next few years. So then it's a little bit more reasonable at around 25 times. Stock starts off in the red and then expect, interest to come in because, it's in the right place. Metal pack, copper is something that people are quite bullish on. So we'll see how the action goes on that front. But hopping across to Vivek, he's tracking a couple of large trades. Hey, Vivek, good morning.
Good morning. That's right. The deluge of fundraising continues. Piramal Finance, has gone ahead and launched a QIP. The company is looking to raise up to 1,200 crore rupees. Likely share issue could be in the range of 9.9 million to 10.5 million shares. And the indicative issue price, is at the lower end 2,000 rupees per share, implying an up to 8.4% discount. Sources to indicate the demand here has been quite robust. Why is the company raising funds? Well, number one, to meet future capital requirements towards onward lending. Number two, for AUM growth. And number three, to meet capital adequacy ratios. Given the strong demand going with the green as far as Piramal Finance is concerned. On the other hand, Lenskart, remember yesterday SoftBank Vision Fund actually went ahead and sold close to 2.6% stake. We understand that today there is another block deal that is likely. The likely seller here is Alpha Wave and Affiliates, again an early stage investor in Lenskart. The block size is again close to 2.6% of the total equity, up to $300 million. We understand that there could be an up to 5% discount to yesterday's close of 657 rupees a share. So again, going with the red as far as Lenskart is concerned, we'll wait and watch whether this particular block deal does happen in today's trading session.
All right. Thank you very much for that. Over to Ananya now for IIFL Finance.
So yes, IIFL Finance has disclosed 2 tax developments from a block assessment covering April 2018 to February 3rd, 2025. Now, what happened is its subsidiary IIFL Home Finance faces a 963.39 crore tax demand, mainly relating to 419 crore of overriding commission income, 392 crore of interest strip assets, 305 crore under Section 36, subsection 1, clause 8, and 53 crore of ESOP expenses. Here, another company is contesting these additions. Separately, IIFL Finance has an earlier 475.56 crore tax demand, but a recovery has now been stayed until December 31st, 2026, or disposal of the appeal, subject to 5% payment or 24 crore. Now, 5 crore has already been paid here. Now, at this stage, we need to keep this in mind. This is only a tax demand and not a final settled liability. IIFL Home Finance is contesting these additions, while IIFL Finance earlier demand is already under appeal with a recovery state. So, we need to wait for the outcome of the proceedings before assessing the actual financial impact. And if they, come out clean of whatever they are mentioning, then we got nothing to worry here.
Okay. All right. Ananda, thank you. Thank you for that. That's IIFL in focus. Well, more stocks with news flow. Vinny's here with that list. Vinny, morning.
Hi, good morning. First up, let's talk about Seagull. This one has received a letter of acceptance from the Ministry of Road and Transport and Highway Construction. This is for a highway section specifically in Arunachal Pradesh. The contract value of this is around 700 crores. So we could see some green here. Moving on, Afcons Infra, that's the next one. They won an arbitration award of around 335 crores from UP Express and India Development Authority. So it is key to watch out for, and we could see some green here as well. Sigma Advance, they further expanded and deepened their relation with Rolls-Royce Aerospace UK partnership. This is a further contract that they have of around 1,600 crore rupees. So watch out for this one. This is a further increase in terms of the partnership that they already have with the company. Sudarshan Chemical, green expected here as well. The company signed a definitive agreement for asset sale and transfer agreement with Clarent Additives to acquire its aluminium dyes and chemicals manufacturing plant in Switzerland. This is a value of around 7 million Swiss francs. It's important. Why? Because this is second such acquisition that they're making in that region, the European region. Exports are improving as well. So that is why maybe we could see some green here as well. And lastly, PVR Inox, they are going to be considering to approve a proposal for buyback of equity on 31st of August. So watch out for this one. Green expected here as well.
Okay, thank you very much for that. Those are some stocks. Let's do a quick recap then. Stocks with positive news flow are TCS, Piramal Finance, Seagull India, Afcons Infra, Sigma Advanced Systems, Sudarshan Chemicals and PVR Inox on the back of their block deal. Stocks with negative news flow are Hindustan Copper, and that too. Perhaps it opens in the red and then manages a bit of a recovery, Lenskart and IIFL Finance. All right, let's just do a quick check on Asia before we get to that big TCS interactions lined up. It's on the back foot today, so perhaps weighed down by the the overall sanctions against Iran. So that's just keeping a lid. The Korean markets have lost close to about 2.5%. A 1% fall coming through on Taiwan. The Hang Seng and the Chinese markets too are in the red right now. And the GIFT Nifty will come up for you on your screen. And we'll just wait to see how that plays out. Well, it's suggesting a decline of close to about 50 odd points. One big thing to watch today will be Nvidia's numbers. Nvidia has been declining for the last 7 trading sessions, and that generally changes the picture for the technology stocks in the US. But back to technology here in India, TCS, as we said, they will be acquiring 100% of Porsche's IT services subsidiary, that's called MHP, for an enterprise value of 320 million euros. Also, as a part of the broader framework, a big partnership between Porsche and TCS, there is going to be a commitment of 1.25 billion euros. So Porsche will become an anchor client for TCS. In fact, I caught up with the top heads at both the companies, and I started off by asking them about TCS's rationale in acquiring MHP outright and why not just sign a strategic deal. Listen into a slice of that conversation.
First of all, we keep talking about acquisition, it has to be seen as a larger partnership for building AI mobility transformation. See, that's what we and Porsche together want to achieve. And MHP brings in a lot of capabilities in the area of digital transformation and consulting and software-defined vehicle, SAP S/4HANA. And TCS brings in deep capabilities in AI engineering global scale. Together, we want to build what we call a AI Mobility Center of Excellence. that will address the entire value chain from product engineering, manufacturing, operations, customer experience. So this is the main intent of the deal. And of course, Porsche would be a customer zero, but we will be providing the same services to multiple other auto majors and industrials in Europe and rest of the world using TCS scale.
But critics, Kriti, would say that you are buying growth. By spending and acquiring the subsidiary for 320 million euros, you're getting that committed spend of 1.25 billion euros.
Yeah, we are getting the committed spend, but what you
So you're buying growth. That's the...
This is not, that's what I'm saying. I want you to look at, there is a growth or the 1.25 million is essentially laying the foundation for the partnership. Okay, we don't look at it as buying growth, we look at it as transforming AI mobility, getting into software-defined vehicles. So many interesting things we'll be doing along with Porsche, which has strong engineering capabilities in automobile sector over the year.
Okay, fair enough. Kriti, so the company that you acquired had revenues of about 740 million euros last year. The committed spend is 1.25 billion euros over 5 years. So that's essentially 250 million euros annually. So roughly, that's about a third of the acquired company's revenue. So where does the balance 500 million
go? Like you look at, MHP has never been a captive of Porsche. MHP's revenue was always about 30 to 40% coming from Porsche. They were, that's what I'm saying, they had deep capabilities in transformation, deep capabilities in consulting, serving all other, 60% of the revenue was always coming from outside the Porsche group. And that is actually, you have to see it as a value for us. Like now we gain entry into so many other organizations outside of Porsche. That's a value we get. That's the reason I keep telling you, don't look at the 1.25 billion. That provides a platform. But what we get is access to so many other automobile majors in Europe.
Michael, your first trip to India, and congratulations, you took over as the CEO of the Porsche Group earlier this year. How does this fit into Porsche's broader strategy, and why TCS?
So for us, it's a very important step in our strategy, Sportwagenschmiede 35, how we call it, because there are two elements for us. One is we want to focus on automotive business and our core business, and therefore it's important that we find the right partner and the right owner of MHP. And the second is that, as Kriti said, we are intending to build on MHP and this deal also a broader partnership. We think that the capabilities of TCS to scale this business and also the depth TCS had to develop actually capabilities in MHP is a perfect fit for MHP to make that company even better and grow this company better than it could be in the Porsche world.
Has MHP and TCS worked together, or this will be entirely net new?
This will be entirely net new.
Yeah.
Entirely net new. Got that. And who called who first? How did this deal come about?
No, I think that's a normal process. If you are interested in selling a company, you are reaching out for partners, potential partners. We were really interested in having an industrial partner and not a financial partner or investor here. And again, I think TCS is offering various capabilities and will bring a lot of value to MHP.
Okay. MHP's revenues, though, Kriti, have declined in the last 2 years. Why is that, A? And two, what are the margins of the acquired company?
See, the acquired company, the margin is somewhere in the range of about 10%. And also you need to keep in mind, MHP is operating completely at on-site. Now, when we are able to bring in TCS offshore capabilities, so there is a lot of headroom for margin improvement. And the decline is more to do with the overall stress in the automobile ecosystem. But we believe it is short term. Like there is, in fact, this sector is up for huge transformation. It gives us a lot of opportunity to grow.
Will this acquisition be EPS accretive from year one? And when do you think revenues flow in? Q4 FY27 or only FY28?
I think from Q4 some revenue should flow in. It will be EPS accretive.
From year one. So FY28 it should be.
From first full year, it will be EPS accretive.
But there are 4,500 employees, on-site employees, which you will be onboarding.
Yes.
So there is a cost associated with that. And plus, it's not that instantly MHP's 10% margins come up to 25% of TCS. It's 25% margins. So how would you bridge that?
See, we believe like there could be about 50 to 60 bips margin dilution at the TCS level for the maybe in the short term, and then we will be able to bring in the usual margin improvement measures of TCS and achieve the margin. As I said, we are looking at it more from what we get from as a transformative initiative. Okay, and eventually it will be value adding for both the organizations.
How many years do you think it will dilute your margins?
Couple of years, I would say.
Couple of years it should be margin dilute.
But we have to put in all the other efforts that we do normally to shore up the margin that will go kickstart.
Okay. Once again, just trying to understand the kind of synergies you will be able to extract. MHP's annual revenues, 700 million euros, 740, 720, that's in the bag. Over and above that, on an annual basis, say 3 years down the line, how much do you think you will be able to get to?
Rima, I don't have a specific number in mind, but I would expect like at least by year-on-year growth of at least double-digit growth from synergy should come in. And so maybe 3 years down the line, like I would definitely challenge the team to make it $1 billion business.
We've seen a pickup in your M&A, and we've spoken about it. There was Listing Age, Coastal Cloud, now this. What else? Is M&A still big on your pipeline for FY27, or do you think you want to just execute on this?
I don't have a upper limit at this time. We keep looking at right opportunities. And even this discussion, we, as you would imagine, has gone through a lot of vetting and discussion. So we will be very pragmatic about it, and we also want to see where it adds value to us in terms of our stated long-term strategy.
Any change to the kind of cash that you'll return to your shareholders, 80 to 100% of operating free cash flow?
Like at this time, like our policy remains same.
Okay, that's the TCS CEO telling me that MHP's revenues are today 740 million euros, but a couple of years down the line, he will challenge the team to bring in the synergies and raise the revenues to 1 billion euros on an annual basis, though initially it will be margin dilutive. Actually, we spoke a lot about even the broader opportunity. This Porsche tie-up with TCS brings on how it expands their presence in Europe in the software development vehicle and in the broader Porsche group, which includes companies like Volkswagen, etc. But due to paucity of time, this is the part, the financials that we've taken on the TV interview right now. But interesting deal. We will slip into a very short break. We'll come back and connect with Payuresh Joshi of MarketSmith India for some fundamental stock talk.
Welcome back. As promised, we have Mayuresh Joshi who's joining in to help us out with some fundamental stock talk. Hi, Mayuresh. Good morning. Good to see you, Ben. Let's talk about Hindustan Copper. All that glitters is copper, right? Because structurally, it appears that it's in a good space globally. That's copper prices have been strong, not too much supply into the system. And that's why prices have held its own. And we also know that the management of Hindustan Copper has been talking about increasing production and improving the grade as well. Now, today you have an opportunity, if you want, to buy it in the OFS. And the floor price is closer on 10% lower, 9.5% or thereabouts. What's your view? Should people subscribe or not?
Morning, Nigel. No, obviously, I think the demand dynamics as far as copper is concerned are probably going to remain structurally strong over the next few quarters and years. And therefore, I think being one of the largest players as far as copper production is concerned, I think it probably has an advantage of its own. The second element, obviously, is the expectations in terms of how copper prices are expected to play out. And obviously, I think with expectations of global demand remaining extremely strong structurally, I think that is expected to have a reasonable say. The management, again, I think is a little bit conservative in my opinion when they're probably laying out targets. I saw that interview that we had conducted, Nigel, a few weeks or months back. And therefore, I think our own sense is that how numbers have probably played out in the quarter gone by. Yes, there was a quarter-on-quarter decline in terms of how revenues were reported. But over a longer period of time, I think being the only listed copper play in India and expectations of structural drivers which are expected to drive copper prices higher, specifically as we benchmark it against the LME. I think it's a good play in terms of how numbers can play out structurally over the next few years. So yeah, anybody holding can continue holding.
Just a couple of things. Mayuresh, morning. TCS and all these IT stocks. There's this deal in TCS which we just spoke with the management about. But there's also this H1B, $100,000 fee, which is again resurfaced. I mean, the report suggesting somebody's proposed it. Just your thoughts quickly on IT.
Morning, Prashant. No, I think so. We're still winning underweight on large cap IT. Again, I think I was hearing Viva and the TCS management. I think the kind of management contracts that they're probably winning will be accretive as we move into the next few quarters. The H1B visa, I think, is cropping up again. But I think a lot of managements, Prashant, to a large extent, since the episodes the last time round as well, have mitigated that to a large extent as we speak. And therefore, I don't think that H1B visa is going to be so much of a concern when it probably comes out to probably hit the EPS to a certain extent or the operating margins. But generally, our call on large cap IT has been that the ratings and rankings still look a little bit shaky to us in view of competition and what is happening in terms of the entire AI trade globally. So I think large cap IT still underweight as far as markets potential.
All right. Mayuresh, Lenskart, everyone was rubbing their eyes when it listed. Now the bulls are dancing away. However, last couple of trading sessions, there is supply that's coming in. Yeah. Do you think this temporary overhang is actually creating an entry opportunity, or do you think bulk of the good news is in the price?
So Nigel, again, a clear disclaimer. I think we own this stock in our swing portfolios, and we had bought this stock at lower levels. So to that extent, our target price on Lenskart is set at 710 rupees as we speak, and we continue holding on to those target levels. Our own sense is that the kind of numbers that Lenskart had posted, and then the key few facts that probably came out, the cash that they're probably throwing out every passing quarter, the product portfolio now that they have developed domestically as well, where they've also started introducing the premium range, which has started probably doing well, is probably expected to also start contributing quite significantly. At the same time, I think the margin performance and the margin profile has remained extremely strong. The international operations, and there is a huge opportunity out there to the key markets that they're probably serving, whether it's Middle East or even Japan to a certain extent, and Southeast Asia. I think there is huge scope of growth out there as well. So I think domestic drivers are very much in place, both in terms of expectations of how operating margins are expected to hold out, the kind of volumes that are probably expected. The sheer number of eye tests that they probably did in one quarter is almost 70-75% of the number of eye tests that they've probably done in the entire annualized year last year, pouring into tier 2, tier 3 cities as well. and they're getting all the probably right responses that you probably can. So yeah, a little bit biased, but as I said, we hold on to our target price of 710 on this stuff.
Okay, all right. We'll take a break. Mayuresh, thank you very much for joining us. Faster conversation, had a bunch more questions, but maybe next time we'll connect on the other side with the management of IIFL Home Finance, which is under the tax department's scrutiny scanner. Stay tuned, coming up. Welcome back. Now, IIFL Finance's subsidiary, IIFL Home Finance, is under the tax department scanner. It's received a 963.39 crore rupee tax demand. Tushar Kotecha is CFO of IIFL Home Finance. He's joining us on the phone line right now. Tushar, good morning. Good to have you with us here. Thanks very much for joining us. 963 crores is an extremely substantial demand, tax demand. Could you give us a sense of...
No.
Can you hear me, Tushar?
No, in between it got absolutely off.
Okay, now you can hear me?
Yeah, now I can hear you.
Okay. Tushar, 963 crores is a very, very substantial tax demand. Could you give us a sense of, what is the dispute basically? I mean, is this a genuine tax dispute? You say, well, or this is like a timing or tax credit kind of issue. What exactly is the issue?
So there are 3-4 issues which department has picked up in this assessment. department has done certain addition on account of the notional income which we book under the Ind AS reporting standard, like interest strip. It is a notional entry which has happened due to the upfronting of income, and then over the period it gets unwind. On a periodic basis, we have offered that for a taxation purpose, but that department is not considered. There are certain expenses like ESOP, they have not given us a reduction. And there are one or two more items on which department has failed to appreciate that we have already offered it for the tax and paid regular tax on it.
Okay. So, you will appeal, right, Tushar, against it?
Yeah.
Could you?
So we will evaluate all the possible options of going to appellate authority, filing a rectification and stay of demand.
So how much will you have to deposit while you try and get a stay?
So it depends on what the authority will instruct us. But largely, they go for around payment of 20% of tax demand or maybe lesser than that.
Okay. All right. So that will be less than 200 crores upfront.
Yes. Yeah.
And how long do you think probably where we could get a stay on this particular order?
So we are expecting if we go for an appellate, outcome can be anything between 6 months to 1 year.
Mm-hmm. Okay, all right. So we'll have to wait by for that. You know, y'all have been looking at various ways of unlocking value, right? Probably a fund infusion into the parent company, or I'm not sure whether it's going to be an IIFL Housing Finance itself. But do you think this could put a bit of a spanner in the works?
No, I don't think so, because we are in continuous touch with our tax advisor and the legal counsel. And all this demand, we feel that will get deleted at the first appellate authority level, and everybody understand and appreciate this point of view. Okay. So we don't think so it will have any impact on that.
So when do we hear then about this fundraising?
Sorry?
So by when then do we hear about the fundraise, either in the parent or in the housing finance arm?
So that our different team is working on it, and they will be right people to make any comment on those sides. But from a tax demand point of view, we are expecting the appellate order in our favor, and normally whatever time it takes, it gets clear within 6 months to 1 year.
You know, some of these the 3 or 4 things you described, Tushar, these have been assessed in earlier scrutinies, and they were cleared?
Yeah, they were clear in our all regular assessment, but this particular disallowance has happened in our block assessment, even though.
But why do you think this has happened as a different different position?
What happened? The different income tax officer assess cases at a different point of time, and each officer has some point of view on certain things. Few officers practically understand and appreciate certain things. Few officers have their own viewpoint. And they take their call, and that's why the appellate mechanism is available to the city.
Okay. The other one, you'll be able to talk about the IIFL Finance 475 crore sort of order as well, where the deposit amount has been reduced, right? From 20% to 5%.
Yes.
How should we read it? I mean, is that the department taking a favorable approach to your point of view?
It's like I mentioned, the maximum deposit is 20%, but definitely based on the merit of case, they can instruct for the lower deposit amount, and that is what has happened in IIFL Finance. And we are expecting similar favorable view from the appellate authority in our case as well.
Okay, you're saying that maximum is 20, but you can ask for a lower amount as well. In this case, it's been lowered from 20 to 5%. What you have to deposit?
Yes, that has happened in IIFL Finance. In our case, it's yet to come.
Yeah.
We are expecting, because we see a lot of merit in our case. So we're expecting the favorable view from the appellate authority in our case.
I see. So I mean, all in all, from your point of view and the IIFL management's point of view, you're seeing this as, it's a pretty substantial amount, but you're saying, well, this should pass. I mean, it's not an issue which should linger. It's well understood. It's just happened because different tax officers, etc. The same thing was cleared earlier scrutiny, so it should happen this time around as well when you appeal, right?
Definitely, yes. But we'll go through the entire process that we have to do. No option.
Thank you very much, Tushar. Good speaking with you. Appreciate you joining us, and thank you for taking out the time. So that's IIFL management, IIFL Home Finance Management in this case, talking about the demand for, in the case of home finance, and of course, I mean, the reduced deposit number as far as IIFL Finance is concerned. We'll take a break. We're back with the pre-open in just a bit. I think about 3 minutes to go for the pre-open. We'll also connect with Rakesh Arora of GoIndiaStocks.com to talk about the metal space. Stay tuned.
Welcome back. The pre-open rates have just kicked in and it's an absolutely flat opening, blinking red and green. So we'll let the rates settle in. Good time then to get in a few trading ideas before trade begins. Sudarshan Sakhani joins in. Mitesh Thakkar, as always, here with us. Gentlemen, good morning. Monthly expiry today. So the last hour will be tricky and important. So how should you position yourself and how do you think we're likely to end this series? Sudarshan?
Good morning. The chances are that we'll remain flat somewhere around 24,000. That's where the series should end. And it also means that if you have long positions, 24,100 was your stop loss. If the Nifty slides below it, close your long positions, do nothing again. I'm so sorry that this market is repeatedly making me say this, do nothing, do nothing. Otherwise, we usually have some trade or the other for the Nifty. But this very narrow range gives us no message. So below 24,000, do not have any long positions, do not open short positions, expect as expiry somewhere around 24,000 and stay away.
Very clear advice, Sudarshan, always helpful for our viewers. Mitesh, morning, what would your approach be?
Good morning. I think I have a very similar kind of outlook. One, I think, yesterday we failed to get past 24,300, which means that we're back to this range of 24,000 to about 24,300. And I would want to explore some buying as we get closer to about 24,000. But if that level breaks, and that is what Sudarshan also highlighted, I think if we are breaking below 24,000, then I think we might be in for a slightly deeper correction, and therefore below that level, long should be totally avoided.
And stocks, Mitesh?
Yeah. I have a mix of buys and sells today. On the buying side is Siemens with a stop at 41.30. Look for targets of 43.50 here. Steel Authority and metal stocks are looking slightly better. I think SAIL was a buy earlier as well. Now can be bought with a stop at 175 for targets of 188. A sell on Canara Bank with a stop about 130. Look for a target of 121 here. And Geo Finance is a sell with a stop about 247 for a target of 232.
And Sudarshan, your picks?
And it's AB Capital buy. There's a buy there. It's also an investment idea. Buy AB Capital with a stop under 400. Jindal Steel is a buy. It's one of the few stocks that's build a base, broken out. Hopefully, it should continue that way. Buy with a stop under 1110. Techem is a short sell, stop above 1605. And Bharat Forge is another short sell with a stop above 2065. So 2 buys, 2 sells.
Helpful. TCS will be in focus today, and we'll just get the pre-opening rates. In pre-open, it's opened up with a positive buys. So there is a green tick, 0.5% up on TCS. Sudarshan, would there be a trade here?
No, absolutely not. I think IT is best avoided.
Mitesh, would you have a view on TCS considering the underperformance? There is some aggression shown by the management in terms of deals, and it is a long-term partnership. Would you be interested technically?
Yeah, I think, in IT, TCS is not the strongest outperformer. In fact, HCL Tech and Coforge, etc. are looking better. But individually on TCS, I think 23.20 is an area of 20-day, 10-day moving average. They are converging over there. Only if we start getting past 2320 would I take a long position over here.
Okay, all right. Thanks a lot for that. Well, let's focus on Hindustan Copper. Remember, the stock will open in the red because the OFS was announced yesterday post-market hours. The floor price has been fixed at around 514 rupees. That's around a 9.5% discount to yesterday's close price. The government is looking to divest close to around 3% stake, but they have an option to sell another 3%. So the government could raise close to around 3,000 crores from the Hindustan OFS, Copper OFS, if they do close to around 6%, if they go the entire hog. In terms of the shareholding pattern, well, the government held close to around 66.14% stake in the company. You have FIs at close to around 6%, while DI is at around 4.84%. And out of that, close to around 50% is LIC itself. But you will be asking, what makes Hindustan Copper stand out? Well, it's the only listed pure copper miner in India, and it's the only play basically on copper prices. It has access to close to around 45% of India's copper ore reserves as well as resources. On valuations, it's not very, very cheap because the stock trades at more than 50 times, even at the base price of last year's earnings, when they did a little less than 10 rupees per share. But Anand Rathi and various other brokerages, they expect the EPS to go up double to around 20 times. How do they expect that? Volumes will improve and grades as well as improve. So then it's at least a little better at around 25 times, though still not cheap at all. So watch out for that stock. For starters, it opens up in the red. Well, let's get in Rakesh Arora. Rakesh, good morning. Good to see you. What do you make of this one? Hindustan Copper. Rakesh, just to pull out a couple of points, in the past when they've done the OFS, I think 2017 they did it at sub 70 rupees. In 2021, they did it at around 120 rupees or thereabouts. Initially, the stock did pull back, and then, in fact, it took off. What is your view? At around 514, would you be interested?
So, Nigel, you summed it very well. Meaning valuations are extremely expensive, and government seems to be the smart one. We'll get a list of investors who are not that smart today. Just watch out for that.
All right. So you would say avoid it?
100%.
Okay. All right. And avoid out there. But, Rakesh, to be fair, everyone says the government, that they strategically don't do things at the right time. I think on this, they've got it quite right? Because around 9 years ago, they did the OFS at around, I think, sub 70 rupees. And for around 6.5% stake, they raised close to around 400 crores. Now, for this 6%, they're going to be raising close to around 3,000 crores. At that point of time, you could have got 50% of the company at around 3,000 crores. But that argument for another day. For the time being, you're saying you would rather avoid this one. Yesterday, you had a lot of these stocks actually that were buzzing around. Let's take the aluminium piece first, because you had mentioned, I think, a few months ago that if you had these aluminium stocks, and when you saw those, euphoric listing of Vedanta Aluminium or Nalco at around 440 rupees, you would have taken money off the table. These stocks have pulled back a little bit from the top, though from the lows as well, they've seen a bounce. What's your view on aluminium? Buy into it or still stay away?
So, Nigel, we are seeing a bounce as we expected in aluminum prices and even aluminum stocks. But when I look, few months ahead, there's a lot of supply coming in Indonesia, and even the 6% supply in Middle East, which was disrupted, has come back online. So I'm seeing a reasonable, supply coming in the near future, and that will keep a lid on aluminum prices. In any case, currently China is producing at overdrive. It doesn't show up in aluminum ignots, which is there in warehouses, etc., because China has a differential duty. So on pure aluminum, there's a 30% export tax, and but alloys, etc., there's no taxes. So China is exporting more and more alloys, which is growing at a much faster pace. So there's enough aluminum in the system. It doesn't show up in the warehouses. That's the only issue. So apart from the U.S., tariffs, which impact the trade flow, I don't think there are shortages of aluminum in the next 6 months, and probably prices will drift downwards. There's a small possibility, that we have this Jackson Hole symposium on Wednesday, and if the rate hike, expectations don't come through for this year, maybe dollar weakens and there's support for metals. But beyond that, I don't see any real reason for aluminum to go back to that $3,600. Most probably it will, inch back to below 3,000.
Okay, you're in the camp that believes that aluminum prices go back to sub $3,000 per ton. That'll be interesting, right? From 3,800 going to sub $3,000 per ton. The other tricky one is alumina, Rakesh. The bullish argument is that it's trading at very low levels as a percentage of aluminum prices, but you're expecting aluminum prices itself to pull back. I think, the alumina prices from the recent lows have bounced a little bit. Where do you think it will settle as a percentage of aluminum? Do you think it goes back to that 16-18%?
So I think that's slightly far away because currently they are at around $350-$360 as compared to 3,200. So it will take some time, but yeah, definitely it will go back because I think alumina will settle in this 330 to 350 range, and aluminum will settle at 2,600 to 2,800 range. So it will go back to that 15 to 17%.
You're sounding quite cautious. You don't want Hindustan Copper. You don't like alumina. Let's try with the other one. What about steel? What is your preference? I think the last time you joined in, we had chatted about this prospect, right? The difference between long as well as flats. It had gone to the highest levels you've seen in multiple years, actually, at around 12,000 rupees. That's narrowed a little bit because long prices have moved up. Currently, how would you approach the ferrous space, and what do you like from there?
So ferrous space, I would say I would be neutral at this juncture because Q2 is looking weak. Coking coal prices have jumped up quite materially, around $25, whereas steel prices are still, around 1,000 rupees lower than Q1. So we are expecting a margin squeeze of $1,500 rupees per ton in Q2. And let's see how it goes for Q3. So I think it's more of a neutral-ish range. Stocks have come up a little bit from their lows. But the metal pack is not going anywhere, in the near term.
So you don't. So you're not. You will not look at buying any of these. SAIL has shown a good bounce in the recent lows. What about NMDC? At around 85, 86 rupees. Are you interested?
So international iron ore prices haven't really done anything. They are flattish. And supplies from this, that much awaited project in Guinea has really started. So let's see how it pans out. Probably iron ore would move down from $105 to $90 in the next 6 to 8 months. So that will put a little bit pressure on NMDC. So I think NMDC again is in a very tight range. It is not very expensive stock, but because there's a overhang of international iron prices coming off, the stock isn't really moving up also.
Rakesh, you're sounding quite somber this morning with regard to buying anything. But, sometimes you have identified some of these stocks in terms of miners, say Godavari Power and Ispat. There's a special situation playing out in HEG. I don't know whether you're tracking Rain Industries with regard to the CPC prices. All these are tricky. But do you see any trend in any of these where there is an opportunity? Say Godavari Power and Ispat, I think, has pulled back 20% from the top. You have Sarda Energy as well that's pulled back, I think, 15-20%. Any stock you like from the broader markets?
So Nigel, I know pellet prices have moved up from Q1 lows of 9,000 odd to 10,600. So that should benefit pellet companies like Godavari. So the stock is correct. I don't know, maybe it can really rebound, but we do investor relations for them, so can't really give a view.
Okay, all right, Rakesh, we'll leave it there. Thank you very much for joining us. Good conversation, as always. Metals in focus. Well, 9:10 calls, it's 9:12. Mitesh and Sudarshan are with us. Mitesh, what do you have?
I'll go with the buy on Siemens and look for a target of roughly around 40-50 over here.
Okay, Sudarshan, what about you?
It's AB Capital, buy AB Capital with a stop under 400.
Okay, got it. Well, let's thank you both for that. There's news on two names that we want to just highlight. One is Sigma Advances. It's a small company. The other one is a buyback at PVR Inox, which is going to be considered. Vinny's got both. Vinny, take it away.
Hi, Sigma Advance. First up, they are extending and deepening the partnership that they have with Rolls-Royce Aerospace UK. This partnership, furthermore, is a long-term contract of around 1,600 crores additionally. So this is a strategic partnership that they have post the Bromford acquisition that they made. So it's an important one for them. The other one, PVR Inox, like you mentioned as well, they're going to be considering an approving a proposal of buyback for equity shares. This is going to be on 31st of August when they'll be meeting. So we'll be key to watch out for this one as well.
Okay, all right. Well, those are the two names. Sigma, of course, has done well lately. I think they got a large order, another defense order about 3 or 4 weeks back. And of course, there is this Rolls-Royce thing now. And of course, the other one is PVR Inox, where the buyback perhaps will be considered. There are lots of other names, right? Just a quick recap, maybe if you've got 60 seconds. TCS will come up. There's Piramal Finance, where there is that block. TCS is starting about 1% higher. You got Piramal Finance, which is flattish. So Seagull India is up 3.33%. Sudarshan Chemicals has had a breathless run over the last 10 days, actually. Hindustan Copper is down about 6% or so. Lenskart should come up. IIFL Finance is down 4%, but I mean, it's, of course, the demand is a demand and they'll have to pursue the legal route. But the management sounding pretty confident. Afcons Infra, PVR, there is Sigma, which we just highlighted among others. So that's where we are at this morning. The first rates will come up on your screen shortly. We'll look at the indices and then we will look at broader markets as well. So just counting down to the initial first few sort of rates which should come up. It's been sideways and it's been that way now for 12, 13, 14 days. Of course, occasionally you get a bounce, I think, like we got on Friday, but then the market sulks again. So we'll see. 24,170 on the Nifty. We are down 0.2. The Nifty Bank is down 0.3, 0.4. The Sensex is starting down about 0.14. Nothing, I mean, actually sideways. Small cap index is down 0.25%. The mid cap index is also down, I think, about 0.25% or so. So that's the picture with regards to the indices. 24,150 is where the Nifty is now at. That's an 80-odd point cut right at the word go this morning. Okay, the heat map will give you a sense of where stocks are opening up. TCS is the top gainer, and it's followed by Eternal, Adani Ports, Trent, which are number 2, number 3, number 4 respectively. On the other side, you've got Max Health, which is lower. Cipla, Aisha, BEL and SBI are stocks which are down. 40 down, 10 up. That broadly is the Nifty 50 pack for you. Rima.
Well, in terms of IT names, TCS, of course, is the big winner. But we have some green going for names like Coforge and Birlasoft. So they've opened up in the green. Along with that, even a Tata Tech and Sign have a little bit of a green tick going for themselves. On the way down, Hexaware has corrected, though, after the gain of 5% plus that it had in yesterday's trading session. Lalita Jewels, after the more than 30% up move in yesterday's trading session, should come up for you on your screen. Let's see whether it is continuing with the up move or seeing some profit booking. Well, 2.5% up on Lalita Jewelry Mart. IIFL Finance is getting weighed down by the income tax order. So straight away 7% gone on that. And Hindustan Copper, another stock we were highlighting earlier, that's under pressure on the back of that offer for sale. Sugar companies are weak in trade. You can see softness in Sri Renuka Bajaj Hindustan. Netweb has successfully completed the QIP fundraise of 1,200 crore rupees, but the stock is weak in trade today. One sector which is doing very well is fertilizer. So FACT, FACT 7%, RCF 3.5%, NFL up 3.5% also. And then you've got some order wins for names like Seagull India, Afcons Infra, boosting the share price.
Well, that's right. IIFL Finance is interesting, right? The stock is down close to around 8%. If you look at a DAM Capital note, they said that out of their target price of 750 rupees, 200 rupees is what they attribute to the housing finance arm. And this, notice is actually 10% of the net worth. So if it pulls back around 10% of the 200 rupees, then it should be 20-25 rupees odd. For the time being, the stock has pulled back 45 rupees. So let's see whether or not there's a recovery. Nonetheless, this news of IT is never good news. And that's why, in fact, the stock is taking a bit of a sentimental dent today. What else? Nit goes up more than 10%. Good move is what we're seeing out there. Hindustan Copper, actually, you have the floor price at 514 rupees, but the market was net short on this one. And that's why the stock actually has not opened anywhere close to those levels. So we'll keep an eye out on that one as well. What else is moving around? Genesis International, I think they had a rights issue that closed out. That stock opens up with a gain of close to around 10%. And I think there was some news flow on Federal Mughal Ghats as well. I think it was a dividend payout. So that's why that stock as well has opened up with a gain of close to around 6% or thereabouts. Bodal Chemicals, that one's opening with a gain of close to around 5%. Small market capitalization, but I think H asset prices are moving up. So that's why that one's been moving from circuit to circuit. In the last few days, I was observing that as well. Net markets open with a bit of, a downtick, but individual stocks doing a thing of their own, guys.
Well, absolutely. And I think we have, Brigade Hotel, a small entity for now, but they've got big expansion plans, and they've got a new CEO in place as well, which is starting about 3-4% higher at this point. About 1 lakh odd shares have been traded. What else? I mean, it's a Nifty Midcap Index, Nifty Bank. I think the other indices are all sideways, but they've picked up a little bit, 20-30 points off the lows on the Nifty, for example. Let's just look at the other, let's just look at the TCS and the Infi, HCL Tech, etc., those names before we go any further. TCS is still up about 15 odd bucks. Infi is flattish. HCL Tech and Tech Mahindra and Wipro, etc., will also come up. So not very much, actually, at all coming through today. Let's just look at SBI. PSU banks were the top losers yesterday. So maybe just a quick look in there. Nothing very much, 0.5% lower. And maybe a RIL perhaps as well. If you're talking about large caps. So just see what's happening before we move on. So about 7 odd rupees lower. Flat, nothing on Reliance Industries as well. Actually, market breadth is also pretty evenly matched. 1,300 up and about 1,200, 1,250 lower is where we're at. GE Shipping is coming up with some gains. It's up about 2.5%, and it's got volumes behind it as well. So that is that. I think Ratnamani, we highlighted. Ratnamani is up 4%. We have the management. You'll hear from the management at about 9:45. So that's about 2 lakh shares on Ratnamani Metals already. There is FACT, which is the fertilizer company, 9%, government fertilizer company, 9% higher. Molbio is the other one, diagnostic company. It's the recent listing, 2.25% higher. So it was up about 3-4% yesterday as well. So keep an eye out on that one. Manipal is coming up with about a 2% gain. I think there is an initiation by a broker on Astra Micro that is up about 3% this morning. So yeah, that's about it with regards to what's coming through. Welspun Corp, of course, has had a phenomenal run. So it's just taking it a little easy this morning with a 2% pullback. That's it. Balu Forge, again, something which was up very sharply yesterday. It's down about 2%. And the other one is Shanti Gears, right? 40%, almost 40% in 2 days. And today, again, it's just taking a break, nothing more, down about 4% or so. Similar thing with Car Trade, where, again, there's a 2.5% pullback. But again, it's one of the big winners that we've had in 2026 off the lows. It's done phenomenally well. We have Raman Johar. He's Managing Director and Head of Equities at Axis Capital with us. Raman, good morning. Good to have you with us here. Thanks very much for joining us. Good speaking with you. What is the what is Access Capital telling investors, clients? What's the thing to do? Where to focus? Generally, the mood, of course, has been turned around to the positive after strong numbers, strong earnings, etc. But markets pricing things in very, very quickly, very fast. So I guess if you can take a broad sectoral view, but I think it's been all about individual stocks, especially mid and small caps.
Morning, Prashant. Thank you for having me. So yeah, you're absolutely right. Things have improved over the last few months. When I think I was on your channel about 4 months ago, the sentiment was as negative as it could have been. There were earning downgrades all across. We saw INR coming off sharply. So all those things have stabilized a lot. As you said, earnings has been extremely constructive, and it's constructive not just on an aggregate level. I mean, we saw large cap. This is for the first time in 2-3 years when the market is now confident that large caps will deliver a double-digit earnings growth after a couple of years. But even if you look at the breadth, even the breadth has been very, very supportive, wherein about 75% of our coverage universe has seen either a beat or earnings, at least a beat or meeting expectations. Just about a quarter of the companies have sort of surprised on the negative side. So that has been a big change. And lastly, the FI flow or the FPI flow narrative has also changed a lot. So that remains the broad construct. Within that, I think the one thing which has really stood out in these earnings has been that the consumption trend, the domestic consumption trend has really come out. And again, this is all across. So you see staples, about 15% revenue growth, best in 2 years. And this is driven by an 8% kind of a volume recovery in some of the names that we cover. Discretionary, extremely strong. Paints, after 2 years of painful consolidation across the industry, we are seeing growth come back. After this was visible in the last quarter as well, and that's continued. Even some sectors like QSR have seen volume growth come through. They have their own challenges, but again, at a broad level, you're seeing volume growth coming through. New age businesses, Nykas and Lenskart of the world, again, very, very strong growth trajectory. So wherever, and autos, again, goes without saying, so we don't have a strong view on autos because of margins are in pressure. But if you just look at the domestic consumption trend, once again, you will see that that's a very, very strong indicator. Hotels, real estate, sales, everything. So domestic consumption remains a key focus area. And within that, there's always been this conversation around urban versus rural. So urban and premium is growing faster, but the rural and the mass end is no longer a big drag. So that remains, a broad theme to focus on. Within that, as you said, there's a lot of sector, the stock-specific activity and work that you can do and find niche areas.
Raman, hi. Rima here. Good to see you. So do the strong earnings provide a floor for the market right now, or do you think it can result in upside for our markets? Do you see us going back to, say, all-time highs by the end of this year on the back of this broad-based pickup in earnings?
The market, so Nifty will remain range-bound in my view, but the range has definitely shifted after these earnings. So I would imagine we are closer to the bottom of that range now, 24,000-ish. Levels should remain a reasonable amount of support. I would imagine that Nifty continues to grind up with earnings from here on. I would still imagine that the growth in Nifty or the move in Nifty will maybe slightly be lower than the large cap earnings. And there are a couple of reasons for that. So first is, FPI flow has improved a lot. But once again, the change in sentiment is only incremental in nature. So this is a situation which is stabilizing more than a full-fledged return of foreign buying, and that will have a little bit of a structural cap. The second is that the primary market continues to be very, very active. And you've seen that as soon as the market's recovered, we are seeing a bunching up of a lot of capital raise. And while, capital raise is extremely positive for the market ecosystem and the entire sort of microstructure of the market in the longer term. But in the shorter term, it is a competition to secondary markets. And again, going back to the FPI flow, if you look at the split of July, between July and August, how foreign money has flowed between secondary and primary, 40% of capital coming in August has been towards primary, and this was more than 50% in the last month. So that again will, in the short term, put a little bit pressure on Nifty as the market finds more and more interesting business models to invest in that will compete with some of the existing firms, and that's essentially the reason for the thesis that the markets will continue to grind up, but it will be a grind and not a full-fledged rally where earnings start outpacing. So we might see a little bit more compression on Nifty PE ratios, but that will be more gradual, maybe 4 or 5% over the next year and a half. But yeah, earnings support will make sure that on an absolute basis, the market continues to move up.
All right, Raman, let's talk about themes then that you liked. I recall the last time you were speaking about a range, and the upper end of the range was around 24,500 on the Nifty, and we're very close to that mark. Let's focus on real estate. That was something that you liked, as well as ancillaries like cement. What's the view as of now? The news flow is a little bit worrying on various parameters with regard to real estate, but the stock's already corrected a good deal. So now they're discounting that news. We're not seeing any big reaction on the downside. Your view on both these two? Cement, which is lacking any kind of spice as of now, maybe post-monsoon beer something, and real estate?
Yeah, absolutely. So cement, I think, has some seasonality to it. We should see things improving as we are past the monsoon season. That comes through a little bit later. In general, once again, if you go back to the original or the starting comment I made on domestic consumption, we remain extremely positive on the domestic consumption theme, which would include real estate. That's a very, very strong proxy to play a domestic market. So within that theme, if you look at, one of the key concerns for real estate stocks over the last couple of years has been slowdown in new launches, and that concern has partly been abated, but once again, if you look at the recent data, launches are still down. So that's one part of it, which obviously impacts cement because that's again new construction activity. That is again an indicative of how the demand is expected to grow going forward. But if you look at the absorption, so the absorption data, when you look at the top 7 cities, it's still grown 11% in the recent months over the last year. So absorption remains high. Within that the premium sector is doing fairly well. The mass market is starting to improve. If you look at the data from housing finance companies and the commentary, you see that is also fairly encouraging. So things are moving in terms of sales. The reason for the slowdown in both the sectors, which are obviously linked sectors, remains the fact that launches have been slower. Again, just to put some data to contextualize this, there's been a 17% decline in launches. But our view is that going forward, these things will resolve, plus the absorption remaining strong will support both the sectors.
Raman, give us some color in terms of the flows. You said, right, FI flows have sort of picked up when it comes to India. Are the Asian markets still as hot? Because they've gone sideways. Some of them have corrected quite sharply from the top. So some more nuance about the foreign inflows into the Asia-Pacific region and India in particular. Is this hot money that's coming in long-only money, which is India dedicated, or are we getting a larger pie of the emerging market flows?
Sure, yeah, and that's something very interesting as well. So we've seen 2 months now of the flow into Indian market turning positive. I'm just assuming that August doesn't throw up a surprise in the last week. One thing that I already said is that primary is a big part of the money flowing into India. But now if you look at the other way to sort of dissect will be which are the kind of funds which are investing or being more aggressive. And when we looked at the data for the previous month, a lot of money, or a vast majority of the money, was more longer term in nature. Sovereign funds have turned the first ones as buyers, and the traditional long onlys have not yet been as excited by the Indian market. This is quite visible also when you slice it as per markets that funds or benchmarks that the funds follow. So over the last month and a half, we are seeing that the EM and world benchmarked funds have largely been turning equal weight on India versus being underweight earlier, whereas the Asia funds continue to be underweight. And between all of that, the clear messaging or the clear messaging that the market is giving is that Asia continues to be fairly hot. This is fairly visible in our conversations with our clients as well. We hosted a corporate day in Singapore last week. And while everyone was extremely positive on the earnings trajectory for India, the excitement still remains in North Asia. And I know Korea and Taiwan, especially Korea, saw a fair bit of volatility. But it seems that the market consensus still remains that there is more upside to that. And hence, in the beauty parade, we continue to be not at the top. So, a couple of years ago, when we spoke to clients, sometime in 2024, 23, 24, when people used to talk about India, they used to say, India has no alternative. Maybe 6-8 months ago, it changed when we were in the peak of the negative cycle of AI narrative, of the war, crude, etc., INR coming down. That time the narrative had shifted from there is no alternative. It had moved to India has no hope. Now I think we are seeing a little bit more balanced, but still I would imagine that North Asia continues to have everyone's eyeballs for now. And to that extent, India will continue to grind up, as I've been saying, but it's not going to be a re-rating kind of a rally in India. It will be, at least on the large caps, it will continue to be an earnings-linked slow grind up.
Okay, all right. We'll leave it there. Thank you very much for joining us. It's always a pleasure. Good speaking with you. Well, I think, we want to focus on the, issuance from Piramal Finance, the QIP. And Vivek is here with details on what he's picking up. Vivek, take it away.
Well, that's right. Piramal Finance, as per what we understand from our sources, the demand for the QIP has been quite strong. And what the company actually did last evening was that they launched a QIP for a fundraise of up to 1,200 crore rupees, implying that there could be close to 10.5 million shares of fresh share issuance that could happen. And this taking into account that we are looking at the indicative issue price for this particular QIP or fundraise at close to 2,000 rupees a share. This is at the lower end of the price band. The implied discount, of course, being a little over 8% to yesterday's closing price. Now, why is the company raising these funds? Mainly, it is going to be used for growth capital. It will be future capital requirements towards onward lending that Piramal Finance would need. Along with that, AUM growth is something that the company is targeting, and as well as to meet capital adequacy norms. And this on the back of the fact that Piramal Finance, remember, has actually said that in the past as well has taken enabling resolution for a fundraise, on the back of which we have taken and gone ahead with a 1,200 crore fundraise issuance last evening.
Vivek, sorry, just one thing. Is it is the QIP 1,200 or 2,100 crores? Because I'm getting feedback that they've done 2,100 crores in the QIP.
I'll just need to go and check back, but what I actually understood from sources today morning was that close to 8:45 a.m. that book was fully subscribed, and they actually closed the book on the back of the fact that this particular issuance was done with. Go and check back with the actual number. Last evening what I realized, what we actually found out was that it's close to 1,200 crore, but we'll check back whether it's a 2,100 crore issue as well.
Okay, yeah. So looks like, as you said, Vivek rightly points out, the demand has been strong, but we'll just look at the number. It looks like it's a 2,100 crore QIP, the fundraise which has happened. So we'll just confirm it and make the changes if that is indeed the case. Well, I think, there's news at the bottom of the screen. Suzlon has backed a 250 megawatt order from Torrent Green Energy. So that is interesting. 47 odd rupees on Suzlon. So far, no reaction. But there is a reaction as far as Ratnamani Metals is concerned. Stocks up. Najal, take it away.
Well, that's right. The stock is seeing some follow-through banks. So Ratnamani Metals, that's the stock on our radar. Remember, their subsidiary, Ratnamani Finno Spooling Solutions. That's Finno, it's known as. They received export orders worth around 2,700 crore rupees. We have with us Mr. Manoj Sanghvi, the CEO at Ratnamani Metals and Tubes, who joins us on the show. Hi, Manoj. Good good morning. Congratulations on, a solid win. Out of nowhere this comes about. Everyone was talking about the core business struggling a little bit, and out of nowhere you go ahead and you get a big order in the spoolings business. And why is this important? Because this order is nearly around 7 times Fino's FY26 revenue of around 390 crores, and also it increases the spooling business order book from around 400 crores to 3,000 crores odd. All the top points come up for you on the screen. So let's get going right away. Manoj, give us a few details. Top of mind will be margins. What margins are you going to be making on this particular order? In the last quarter, the margins had gone to more than 50%, but the street is in the vicinity for spoolings business at around the 25 to 30%. Would that be fair for this particular order?
Yeah, morning, and thank you for having me, Nigel. So this particular order is total 286 million. It's an export order where supplies will happen in MENA region. Margins, if I say, of course, we cannot compare those with the current margins. In a long run, I would say 25 to 30% is a good number which we can look for on this particular order.
Okay, all right. And how does this 2,700 crores start reflecting in terms of business? Will it be around 1,200 crores in FY28? And in FY27, will there be some revenue recognition?
So this particular year, because these spools and support systems, the design and engineering will take place and be approved this particular year. We will try to, dispatch around 50 to 100 crores within this year. Next financial year, it is spread over 3 years, the supplies. So next financial year, maybe 750 odd crores. Thereafter, 900 crores. And the last financial year, 1,000 crores.
Okay, all right. Got that. So that's how it will be spread out. Just a quick question. This is a nuclear power related project that you've got this order for?
Yes. This particular project is nuclear power related. We have, as you know, we have a partner, JV partner by the name of Techno Energy. So complete design and engineering is going to be provided by them. Once it is approved, we will start the execution.
And just to get my number correct, on 1 gigawatt of nuclear power plant, you require around 4,000 to 5,000 spools. Is that the ratio that you're normally looking at?
Yes, 1 gigawatt would translate to about 4,000 tons of spools.
4,000 to 5,000 tons of spools, right?
Correct.
And your capacity is going up in December, I understand. What will it go to?
So we will have a capacity of 2,500, 3,000 odd tons, depending on the size mix. So that will be our annual capacity.
Okay, all right. And this is because your Kutch facility, right? That's going from around 1,400 tons to around 4,000 tons.
Yes, correct.
Okay, just a quick question. You have 51% stake in this particular unit. And as you said, your JV partners the remaining 49%. Is there any agreement between both of you all that, you go ahead and buy the remaining 49%, or you're happy with the current arrangement?
No, as of now, we have no such understanding that we buy the remaining percent. It is because they are in a different geography. We cater to different geography. Depending on the total demand supply situation, we bid for the jobs. They are currently busy in Europe. We are focusing more on Asia and Africa, Middle East per se, and we see a lot of nuclear power demand.
Okay.
Well, that said, going forward, maybe from next year, we will have not only dependency on nuclear, but we will have jobs from the thermal power plant, oil and gas segment, and data centers. So which will maybe of the total revenue going forward, what we want to do is 20 to 30% of revenues we want from a different stream of industries.
Okay, got it. Any further orders that will come in? Since you have suddenly bagged this big 2,700 crore order, do you have capacity, first of all? On an annual basis, what kind of revenues can you do from the spoolings business? Around 1,200, 1,500 crores?
Yes, that's what the current capacity post-December, that will be the capacity, what we can execute. Yes, there is some room for more order booking in this year.
Okay.
We have bid, so another 30 to 50 million can be expected. However, these are all long lead delivery items.
Okay.
So we are hoping that another 30 to 50 million US dollars we can book within this year.
Okay, all right. That comparative will be small in size in comparison to what you have done with regard to this order. So we've got the spooling business and we have understood this order completely. Let's talk about the core bread and butter business, Manoj. That's the pipes and tubes business. In the first quarter, things were under pressure, right? I mean, you got a degrowth in the core business of around 25%. But I think for the year, you were guiding for 20% growth and you were hoping that there is a resolution in the Middle East. Now, as of now, we're not sure about the resolution. Hopefully that comes about. But do you stick to this 20% growth in the core business, or do you think you'll have to temper down expectations a little bit?
So demand still, if we see within India, is quite muted. Plus, the international situation, especially the Middle East, is not, I would say, it is not yet fully resolved. The shipping lines, the ordering, or what the countries in Middle East plan to order is still not very clear. So once we have that, yes, those numbers, what we indicated during start of the year, it's very difficult to achieve this year because we are almost 5 months down now.
So in the core business, then we should look like more like 10% growth?
About 4,000 odd crores, yeah, is what we still can achieve.
That's around 10%. Last year, you did around 3,700 crores approximately, so a little less than 10% in the core business.
Yes.
So the guidance in the core business has been revised a little bit lower in comparison to the start of the year. At the start, you were looking at 20%. Now, in fact, you're saying a 10% is more like it. Tell us about the other verticals as well. So 10% in the core business. In Ravi Forge, what kind of growth are we looking at?
About 10 to 15% growth. So we are targeting, say, close to anywhere upwards of 425 crores with an EBITDA margin of mid-teens.
Okay.
On Ravi Technoforge.
Okay, so we've got that out of the way. So for the year then, Manoj, on the whole, it appears that the consolidated revenue should now look more like 5,100 crores in comparison to 4,500 crores last year, or a little more than 5,100, 5,200 crores?
Yeah, you're correct. So if 600 of RFSS, 400, 450 of RTL, and then 4,000 of Ratnamani, all put together 5,000 to 5,200 crores with a margin of 15, 16, maybe 17. It depends on our product mix for the parent company.
Okay, 15 to 16% margins. All right. So this year could be a little bit of a softer year, though you're saying the smaller verticals are now coming, to the party with regard to supporting the core business. Final question. In times like this, when uncertainty is there, sometimes there is a talk of inorganic growth. Are you looking at any kind of inorganic growth? There's a smaller company, Welspun Specialty Steel. Have you looked at that? I'm not sure whether or not it's on the blog. But there's a lot of speculation in the market. When things are dicey, sometimes there is consolidation that takes place. Have you looked at this asset? And are there any such plans?
I mean, we have, I would say we've looked at it, but considering what value it is, it makes no sense for us to dive in at that value. So, provided the valuation is right, we may again look at it. But in the meantime, we've already decided that we will go ahead with the Greenfield project, for which we are already scouting the land. Once we have clarity on that, and of course, if anything, if it comes in between which can give us that early start, we don't mind looking at it.
Where are you? Welspun Specialty Steel, the market cap is around 3,400 crores. Oh, at what valuation would you be interested?
Of course, I mean, if I set up a newer plant, it will be much less than.
So at this price, you're not interested?
No, definitely not.
It's always a pleasure talking to you, Manoj. Thanks a lot for giving us, how do you see business shape up with regard to the core business, the spooling and Ravi Forge business that was smaller parts of the business that could grow at a faster clip right now. And on the whole, 5,200 crores of revenues this year with margins in the range of 15 to 16%. And on Welspun Specialty Steel, as of now, not interested at these prices. Maybe, in fact, if it's a little bit lower, then probably you could give it a relook. Thanks a lot, Manoj, for joining in.
Thank you.
Well, time to slip into a short break. Come back. We continue to focus on markets. We'll also focus on the real estate sector. Stay tuned.
Welcome back. Let's turn our attention now to real estate. When we were chatting with Axis Capital's Raman, he was telling us how new launches have taken a back seat. New launches have actually declined 17% in Q4 of FY26, and then even in Q1 of FY27, data seems to suggest the new launches have seen a drop. But has there been a pickup? And what's lined up? What's ahead? Santosh Kumar Group Vice Chairman at Anurag Group is now joining in. Santosh, we have the numbers till June. All the listed companies came out with their Q1 numbers, and they have taken a backseat in terms of new launches. So whether it's an account of rising raw material costs, or they just want to clear off their existing inventory, West Asia disruption, regulatory issues, no approvals, but launches have been subdued. Are you seeing a pickup? How has July been? How has the first half of August been?
Definitely, the first July month of this year has been really good. Many of the developers have started launching. As you said, last quarter has been little subdued as far as the launches are concerned, especially for the some of the new, some of the listed real estate players, primarily because of 2-3 things. One is definitely is the West Asia crisis, because of which raw material has been one of the challenges. But those who have, those developers who have launched their project during the last quarter, they have been able to get a very good response. Just to give you a few names, Shobha, Mahindra Lifestyles, Raymond Realties, these are the guys, who launched their project. They have been able to get a good launches. More than that, I think during the last quarter, the collections from the market for some of the developers has been very, very good. And because of which, cash flows have improved for the many of the listed developers, and they have been able to reduce their debt from the market. So these are some of the challenges. Yes, definitely, it has been a little bit of subdued as far as the launches are concerned. But this quarter, because the festive seasons are coming up, we have seen Independence Day launches in many of the cities across India. So there has been a good response from the market on those launches.
And even in Q1, even though the launches were fewer, at least in terms of the larger players like Lodha, Oberoi, DLF, they had sales value. There was value growth because they have sold some of the previous inventory that they were sitting on, and prices broadly have gone up. So some numbers then, Santosh, for say Q2, what should we expect of a full year FY27 in terms of launches? Like I was looking at one report which said that basically for the 4 large real estate listed players, DLF, Lodha, Prestige and Godrej, if they have to hit their annual target in terms of sales, they will come up with a launch pipeline of 1 lakh crore rupees. Is that doable? What are the numbers you're working with?
Absolutely. Our projection for this year has been more or less the same what it was last year. And this year also, as far as sale value is concerned, I think this year too, the market will beat the last year's number. We have seen already in the top 7 cities, value of units sold in first half of the 26 was around 2.88 lakhs. We are projecting around 5.8 lakhs units of sales for this financial year, which is maybe 3-4% lower than the last year's. But as far as value is concerned, it could be around 10 to 12% more than what it was last year. Again, the luxury housing segment continued to gain share with 22% of sale value, about 2.5 crores and larger than the value. That's really pushing the market. And as you mentioned, many of the listed players, the grade A developers, we call it, they have a very strong pipeline during the festive season, especially in the H2. And we will see, maybe more or less similar kind of quantity which is being launched in the market as we have seen in the last financial year.
Yeah. Santosh, talk to us a little bit about the city of Mumbai, right? Unprecedented level of construction. I mean, you look right, left, front, back, there's only cranes all around, right?
Yep.
Are we, there is the there is the issue of what it means for people living through all of it. That is another issue. That is not the discussion here. But are there concerns around oversupply or no? This is all well balanced.
Not at all, Prashant. I think it's well balanced market. What we have seen, we are very excited that the demand for the luxury housing continue to be very, very strong. And only thing is that affordable housing, which is not seeing that kind of a result what we expected to do because of the various reasons. Land prices have gone up, the construction costs have gone up. But if we look at the mid and the luxury segment, we have seen a great amount of demand from the customers. The project which has been launched.
I just had a quick question. Does Anarock also look at so when you assess projects, etc., right? Yeah. There are basically buildings are going vertical, right? I mean, there's a fair bit of redevelopment happening. 40, 50, 60 floor, high rises across the board. Whatever is being built, mostly what is being built. Do you assess projects on the basis of livability as well? The infrastructure around it, the carrying capacity of roads, etc.
Absolutely.
Absolutely.
Go on. When we are, doing the research on, of the launches, many of the developers appoint us to do the feasibility study, not only from just a sales perspective. It is, what is coming across, what are some of the new infrastructure development which is coming in, why, the people should be, commanding a price for the project of various reasons which is going in that micro market. That is very, very important for any project to be launched by the developer. Why the developer should pay a certain price? Why should they be commanding certain price? So it is not just construction or the land court. It is the peripheral which the environment which the ecosystem which is being developed across the project, that's going to give the fillip to the price, Prashant. Having said that, definitely when we look at the projects of many of the developers, there are various factors which really command the price and the demand for any project.
Did you see this headline that housing sales across 8 cities fell 6% in the first quarter?
Yes,
this was...
it was 1% actually. Housing sales in H1 was recorded around 1.92 lakhs units across top 7 cities. From a value perspective, it is around 1% higher than the last year. But on the number of units, it is 7% down from second half of the 25.
So value is up 1, volume is number of units is down 7. This is H1.
Absolutely.
Right. But you're saying H2 perhaps should be better.
Yeah, Prashant, it's primarily because of the sentiment has been very low, because of the West Asia crisis, as well as the stock market is not, there was, some sort of volatility on the stock market, because of which, there was a low sentiment on the real estate side, which really impacted the number of units going down.
Yeah, we'll leave it there. Santosh, thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV 18. So that is real estate for you, better H2 compared to H1. Well, let's get Chandan Taparia in. He's head of derivatives and technical wealth management at Motilal Oswal Financial Services. Chandan, good to have you with us here. Good morning. It's been ranged sideways for a while now. So view on indices and then your trades.
Yeah, good morning. Thanks for having me. So it's monthly expiry being the last Tuesday of the month, and it's first monthly expiry after CES. So some volatile swings cannot be ruled out in the last hour. But as of now, it seems that market got stuck in a range. Put writing is clearly visible at 24,000 and 24,100 strike that is going to be respected. But at the same time, sustained call writing is visible at 24,200. So as of now, the immediate trading range for index could be 24,080 to 24,220 marks. If you look at for 2-3 day point of view, I believe 24,000 to 24,400 could be the trading range. The index is trading lower than its weekly and series volume weighted average. Because of that, sustained call writing and upside could be kept in the market. Now talking about Bank Nifty Index, here the immediate support is at 57,250. Hurdle is near 57,750, so likely to be in a broader range. Both the indices are likely to have the limited upside with sustained call writing at higher strike. Talking about stock wise, I believe selective stocks and counter are likely to do well in this market scenario. First trading idea is buy on Kalyan Jewellers. We have seen a major price spurt in the gold and silver in last couple of days, and we believe this trend could continue. So Kalyan Jewellers is first trading idea, which has given a consolidation breakout. We have seen better rollover. Put writing is active in the next series, so one can buy with support of 606, and this stock can head towards 640 mark. Second trading idea, that is buy on Divis Lab. Selective pharma counters are doing well, and Divis Lab is forming a positive price pattern similar to a pole and flag on the lower time frame. It is all set to give a decisive breakout, so with support of 8500, looking for an upside target towards 8900 to 8950. Last trading idea, that is buy on AU Bank. Here we are witnessing a major consolidation breakout. Counter has given a decisive breakout with hold above key moving averages. In fact, most of the mechanical indicators are giving the bullish crossover with positive rollover data. So one can buy with support of 1112 for upside target towards 1180 marks.
Got it. All right. Thanks a lot for that, Chandan. Let's focus on Hindustan Copper then. The government, the stock started in the red because the government yesterday post-market hours announced that OFS, the floor price was fixed at around 514 rupees, and that was a 9.5% discount to yesterday's close price. The government is looking first to divest close to around 3%. They have an option to sell another 3%. So they look to raise close to around 3,000 crores if they go the whole hog, that is sell the entire 6%. Remember, as of the last reported shareholding pattern, the government had close to around 66.1% stake in the company. FIs were close to around 6% and DIs at around 4.8%. 50% of what the DI holding is, that's attributed to LIC, who over the last few quarters, they've trimmed down their stake a little bit in the last 2 years or so. From around 7-8%, it's come down to around, around 2.5%. You'll ask, what makes Hindustan Copper stand out? Well, it's the only listed pure copper miner in India, the only play on copper prices. Remember, if you're talking about Hindalco, they are TCRC, so they are getting a particular margin for conversion. While this is the pure player on copper price moves up or in the downward direction. Hindustan Copper also has 45% of India's copper ore reserves as well as resources. Valuations look very, very expensive. Last year, they did less than 10 rupees in terms of an EPS. So at around 530 rupees, it trades at more than 50 times. However, Anand Rathi, they are one of the few brokers that cover the stock. They are saying that the EPS goes from around 10 bucks to around 20 rupees. So then it's trading at around 25 times, which is still not cheap at all for a miner. But, going by the kind of interest, going by the kind of tailwinds for copper, a bit of a deficit globally, and prices as well will remain elevated. So because of that, the street could be interested in this particular one. Today, non-retail looks at it, and tomorrow retail could come in to participate as well. So we'll keep an eye on the stock for the time being. It's down 6.5% because of that OFS. Well, we'll slip into a short break. On the other side, Manisha Gupta is waiting for us. She'll tell us what's going on in the commodity market.
Okay, welcome back. Manisha is here with a focus on commodities. Gold is at a 3-month high. Manisha, take it away.
Oh, well, absolutely. What a gain that we've seen happen in the month of August and the last few weeks as well. This actually is a fourth straight week where we're looking at gains continuing in case of the gold prices. If you look at the movement then, we're trading at a 3-month highs, $46.50 an ounce is where it's holding right now. And for the month of August, the gold prices have gained up by 15%. This is the best monthly gain that we have seen since 2008. So strong gains continuing there. Let me tell you on what all has been supportive for gold in the last few sessions therein. To begin with, it is about the U.S. government interventions in the bond markets, the yen buying that has revived the debasement trade, the so-called debasement trade yet again, and there is buying coming back in case of gold. It also is about the U.S. Treasury, which has ramped up liquidity support bond buybacks, and that is leading to pressure on yields. So when the yields are not doing well, you usually see money flowing in case of precious metals there. It also has to do with the statement that the Secretary Bessent has put out saying they're flagging on upcoming longer-term fiscal plan therein. You have Middle East geopolitical tensions, crude oil prices trading at 92. Pardon me. All of that, in turn, also supporting prices. And then it is about the U.S. national debt, which is at $40 trillion. That seems to be, pardon me, bothering the markets as well. I want to quickly take you on what the gold prices have done in this year till time. So when you look at the month of January, we were trading at around $43.30. From there, we saw the gold prices go to an all-time high of $5,600 an ounce. From there, the prices came to a low in the month of July to the tune of $39.80 an ounce. And from there, we are trading at $46.70 right now. So that clearly is the chart on what the gold prices have done in the matter of time therein. Take a look at the gold prices on what we've done in the last many years as well. So you have prices actually gaining for all of those years in the last 5 or 6 years. We did see prices gain or decline by 3.5% only in 2021. Last many years, we've seen constant gains. Last year was 70% of a jump up in case of gold prices. This year, we were negative by the time it was July, but currently we are trading in the positive by 7% for gold prices. Even more important is going to be on where are gold prices headed from here. So it is a bullish scenario that Wall Street banks and even Indian analysts seem to be putting out. $6,000 an ounce is the view coming in from JP Morgan for this year itself. $5,400, $5,000 an ounce from Goldman Sachs. Metal Focus is a possibility before we end the calendar year 2026. And that is the kind of levels that you have seen most other banks putting out as well. Anywhere between $4,600 to $4,800 an ounce from Deutsche Bank, HSBC, ING as an average price for the fourth quarter of 2026. So clearly stronger gains going in there. And the markets, of course, will watch out for the Jackson Hole Symposium and the Fed chair announcement or a testimony therein on where the markets could be moving from here in sense of dollar, interest rates, and that would tell us on where gold can be going as well.
Okay, well, Manisha, thanks very much for that. That is what's happening as far as the precious metals are concerned. You know, just look at the Nifty, which had recovered actually quite a bit, but it's also come off a little bit more now. So about 73, 75 points down. And you look at the advanced decline ratio, about 1,750 stocks are down, 1,350 stocks are higher. And, there's a fair bit moving around. So, there is data patterns, which is coming under some selling pressure, 3.5% lower. Paras Defense has had a, dizzying move up. So even, I think just a 1 week move has been from 1,300 to 14, actually almost 1,500 or so. So that's coming off a little bit, about 1,400 now. That is Paras Defense. HAL is down 1.6, 1.7. Hitachi is down about 1.7. GE Vernova is down about 2.25%, and so on and so forth. Voltamp is another one which is down about 5.5% as well. So that's the picture. Take a break. We are back. Our special segment is the economy. Lata speaks with economists Soumyakanti Ghosh of SBI and Sakshi Gupta of HDFC Bank on their first quarter GDP numbers due on the 31st of this month.
Welcome to It's the Economy, an important data coming up on August 31st, the first quarter GDP. And State Bank expects the first quarter GDP to hit 8%. If this is true, then it will be a huge positive surprise for the market. The CNBC TV 18 poll is seeing the Q1 GDP at 7.5%. That's about a dozen economists from whom we got data. But even at 7.5%, it is better than Reserve Bank's forecast of 7% for the first quarter, which itself was upgraded from an earlier 6.6%, which was always way too unrealistic and pessimistic. Even more positive than this GDP, real GDP number is the nominal GDP growth, which our poll says will come in at 13.9%, almost 14%, which, if correct, will be the strongest nominal growth in 10 quarters. The full year nominal GDP for this year is seen at 13.3% by the poll. That also makes it the fastest growth in 3 years. Joining me today are economists Soumya Kanti Ghosh of State Bank of India. Even now, the first and the highest forecast on the street, and Sakshi Gupta, the economist from HDFC Bank. Soumya, Sakshi, thank you very much for joining us. Soumya, to begin with, what makes you so positive? For starters, I'm also positive. That 6.6 I thought was such an understatement. I thought the debate should always have been between 7 and 8%. But you're at the upper end. Why?
Yeah, thank you, Lata, for having me on the show, and good morning to all of you. Now, I think the debate started at the end of June, I think, when CNBC and we had in fact flagged that the 7% growth was a likely outcome given the numbers. And I think as the months have progressed, all the leading indicators, we actually track around 55 leading indicators, and all of them are showing significant acceleration. Just to put the numbers in context, out of around 50 odd indicators we track across rural and urban and across several segments of consumption, investment, external sector, and others, 86% of the indicators are actually showing an acceleration, which is an all-time high. And just to pick some numbers, which are the most important numbers, for the first time, two-wheeler sales, tractor sales, passenger vehicle sales, three-wheeler sales are on average expanded by more than 20%. Government capex has expanded by close to 24%. For the state capex, also around 6%. And exports, imports, all of them have been buoyant. Tax collection also have been buoyant, e-way bills. So any number you pick up and choose, I think most of them has grown in double digits. So, and recently the corporate sector result numbers also, so the net sales have actually expanded as a rate of 24%. So I think all these indicators believe that and these numbers are actually higher than the fourth quarter number when the growth came in at 7.8%. So at that point also, we are expecting the growth could actually touch 7.3. But this time, I think, given all these numbers, given the backdrop, given the leading indicators and the pace of acceleration across urban and mostly rural, we believe that an 8% looks growth in the first quarter on the table.
No, actually, I take your point on that. Many of the leading indicators, or at least some of them, are better than Q4. And for Q4, the base was actually 7%. So we still did 7.8. Now the base is 6.8%, first quarter of last year. So the expectation that we should do a little better than 7.8 seems logical. Sakshi, would you have any reservations? I mean, why are you falling short of 8?
No, good morning, Lata. Look, we are at 7.5% for Q1. I think by no metric is that a pessimistic number. I think it is signaling that we are expecting growth to be strong. I think beyond the high frequency indicators that Dr. Ghosh highlighted, a couple of other points. Look, yes, consumer demand has continued momentum and has been strong in the first quarter. We, however, are expecting that at least on the agriculture side, in terms of production, there could be, some impact of heat waves that played out in the north, during these months. Secondly, if you look at, a lot of the consumer sentiment indicators, you look at, hiring intentions in the formal sector, some of these things have actually moderated, over the last couple of months. And also on private, while government capital expenditure has been strong, on private capital expenditure, we are still unsure whether the momentum that had started building up second half of last year, how much of that momentum has really continued, and whether private investors have turned slightly cautious because of the West Asia conflict. So I think overall a positive number, but we do see these little niggles where because of which we are not expecting 8%.
Okay, so capex and jobs could be the worry points, but otherwise lead indicators are excellent. Soumya, let's come to nominal GDP. Is your number as good as 13.9 or is it 14%? You're even higher than the average. And more importantly, I mean, why is nominal GDP higher? And what is your expectation for the full year itself for nominal GDP?
Thank you, Lata. And I just wanted to add to one of the leading indicators that all of you are at is the bank credit growth, which is now running close to around 19%, and deposit growth have picked up significantly. The FCNRB has now more than 15%. Now, having said that, the nominal GDP growth in the first quarter could be as high as 14%, if not higher. Because if you remember, the WPI could be close to around 10%, the CPI average, and if you take the weightage of 70-30, I think the GDP deflator of 6% looks eminently feasible. So with an 8% growth rate and a 6% deflator, 14% nominal GDP likely on the cards for the first quarter. Okay. And for the full year, I think we are looking into 13 to 13.5%. Please, because remember that the headline CPI is likely to accelerate in the second half of the current fiscal, and WPI will see some amount of moderation, but not to the extent which the markets believe. So if we take that factor into account, I think the overall nominal GDP may not significantly moderate from 14%. It could be at 13 to 13.5% for the full year.
Okay. Sakshi, in your report, you point out that there is this uncertainty about whether MOSPI will use the new PPI to deflate. Just for my viewers, until now, whenever the MOSPI is counting the GDP, they count it at current prices for most things. Some of them, they take volume, otherwise they take it at current prices, and they deflate many of them with the WPI. But now they're going to change to the global standard, which is the producer price index. We have just a few months' data of producer price index and some back data for some of the indexes, which is a little lower. That deflator looks a little lower than WPI. So, Sakshi, should we worry that are we running away with high nominal GDP numbers?
No, look, Lata, we have done some estimation using the PPI, sector-wise deflators, and also looked at certain categories within CPI, where specific, sub-products, especially on the services side, could be, are going to be used as in the deflator calculation. And we are getting a broad deflator, which is close to 5.5% for Q1, which still gets you a nominal GDP growth that is going to be above 13% for the first quarter. So even if you look at the trends in PPI as well as WPI, and you compare that at the headline level, the numbers have been broadly similar, about 9% over the last couple of months. So we are estimating the nominal growth will be above 13%. Our estimate is somewhere between 13 to 13.5.
Okay. Even if you use PPI.
Yes.
All right. Okay, so let's wait and see. It was just that the initial set of PPI looked very low. That banking, insurance, those PPI numbers, services numbers looked low to me. But yes, the new set perhaps is not that, that low. Soumya, ultimately the market will want to extrapolate from the August 31 numbers what we do for the rest of the year. Our poll stands at 6.9. Where are you in terms of full year GDP, real GDP growth? And will there be any quarter where we should worry?
Now, I think, Lata, that's a very interesting observation. We were actually at 6.6% and we have not revised it. So we are going to look into the numbers very closely once the first quarter numbers are announced. But in our sense, if the first quarter numbers are anywhere close to 8%, I think the full year number could be higher from our base estimates by at least 50 to 60 basis points. So that's a first-hand estimate. We need to look into the numbers very carefully. The only point of niggle which I'd like to say at this point of time going forward is the monsoon. I think monsoon has significantly moderated from the earlier numbers. It is staying at the 13% deficit now for the last 2 weeks. And many of these producing states like Bihar, Andhra Pradesh, Uttar Pradesh are showing, Punjab, which are actually the cereal granaries, are showing significant lower amount of rainfalls. And global food prices are also not likely to be benign. So if I take all these factors into account, that could put a niggle on the rural demand. The second half, the growth will moderate. But still, even if it moderates, I think full year a growth rate of close to 7% or more looks likely on the cards for the full fiscal.
Okay. Sakshi, what we hear from the Asian economists is that Asia is growing at a steaming pace, at least the North Asian countries. Highest ever credit growth in 18 years, we are told. I mean, that's the level of capex. So do you think we could do better than 7? Simply, I mean, as you all point out, both of you have said how export growth is very good.
Right. No, I would put a fair probability on us printing an above 7% for this fiscal year in terms of real GDP growth. Look, there are a couple of things that we need to watch out for. I mean, the Q1 data is now behind us. I mean, in terms of activity, that number could come in strong. We all agree on that. But going forward, I wouldn't necessarily linearly extrapolate those trends. And I think I would watch out for a couple of things. One is consumer demand. Look, this data in Q1, a large part of that on the supply side is being led by consumption. And if you look at latest, consumption sentiment indicators from RBI, that's showing a moderation. If there is a higher pass-through because energy prices are still elevated, then I think that is a risk for consumption. And of course, the monsoon situation is there. So I think that's one key monitorable, that I would watch out for to estimate whether we would end up with, a 7% plus number for FY27 going forward. If that continues, then, I think we could have a third year where growth is strong, for India.
I take your point. There is this strong base that kicks in when we come to the second, third, and fourth quarters. So, doing over 7% over that kind of a base will be tough. Shaumya, now to come to the more newsy question of FCNRB. Again, you were the first to have the highest forecast. You were, I think, telling me $80 to $100 billion from the word go. Now there are more people veering around to that at least $80 billion mark. What's your current figure in terms of how much we may do, since we have done 65 billion as of August 21 itself in FCNRB? What may be the total FCNRB and total dollar float target for you?
Yeah, Lata, thank you. Just one point to add to Sakshi's point. I think the July indicators have remained significantly stronger and in fact stronger than June. So that's first thing. Regarding the FCNRB flows, yes, we are expecting around 85 billion overall inflows. And now I think these numbers could be a little more on the higher side, could be a number of around 90 to 95 billion. So that will actually put around 9 trillion additional liquidity into the system. And as you have already seen, the good thing is that the most of this, and as I think that is by the structure of the system, since most of the dollars doesn't come into the system, the RBI forex reserves has significantly increased, and almost the entire amount which was lost when the war started, the FCN, I think the foreign exchange reserves were at 728 billion. So now we are very close to that. So hopefully when the scheme ends, our forex reserves will be at record highs. But I think that should also put into question some of the liquidity management issues.
Okay. Put into question as in you expect that they may not have to do too much of liquidity management?
Yes, they will have to do liquidity management, but what will be the pattern? That will be the interesting point to note.
Okay. Well, I think the RBI was of the view that they may not have to do much because it's anyway going to be Diwali time and there will be a lot of cash withdrawal. And therefore, maybe a little bit of VRRs or longer ranged reverse repo should meet the situation, was the impression I got. But very quickly, running out of time. So from both of you, I would want a rupee forecast from now till the end of the year, since we have this extraordinary, strong for FX flows. Sakshi, what's your range and average?
Right, Lata. So in the near term, that is, till the end of this quarter, we are estimating 95 to 96. So broadly, very stable movement for the rupee. But as we move into the fourth quarter of the calendar year, we think that, the range is going to slightly shift up towards a range of about, 96 to, 97. This is because of a couple of things, primarily on the global side. I think the, US midterm elections, what happens to Fed, rate trajectory, and the fact that the current West Asia conflict kind of continues. So we expect a gradual depreciation move as we, draw closer to the year.
Out of time, Soumya, if you can just give us a number, your range for 2026.
No, I think our range is broadly in the range of 95 to 96.
Okay, so basically both of you are expecting a steady performance. But let's see, the fourth quarter, we normally have a stronger current account surplus. So perhaps that 97 may not come after all. Let's wait and see. Wrap up on Bazaar on that note. Thank you very much, Sakshi and Soumya, for joining us. After a break, it will be time for Chartbusters.
The government launches an offer for sale in Hindustan Copper to sell up to 6% stake and raise around 3,000 crores with a floor price of 514 rupees a share. The stock slips over 6%.
IFL Finance material subsidiary, that's IFL Home Finance, receives an income tax demand of around 963 crore rupees. The stock slips even as the management tells CNBC TV 18 that they will evaluate all options and will file an appeal against the order.
The United States proposes a fee of over $100,000 for new H-1B visas. IT stocks are one of the top sectoral losers, led by HCL Tech and Persistent.
Sigma Advanced Systems expands its partnership with Rolls-Royce Aerospace with a long-term agreement worth around 1,600 crore rupees. The stock is locked in an upper circuit, up 5%.
And Seagull is higher by around 2% as it secures a 704 crore highway project order in Arunachal Pradesh. Afcon's infra is about 3% higher as it wins an arbitration order worth around 330 crores from the UP Expressways Authority.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Ekta. Hi Ekta. Well, the market's a little under pressure today. Volatility will pick up in the final hour of trade because it's monthly expiry. But stocks doing a thing of their own.
Hi, Nigel. Yes, absolutely. You know, for today, again, it is a little bit of a consolidatory session, you would have to say. So we're just about trending lower, below that 24,150 mark as we speak. So 24,130 is currently where the Nifty is at, down around 0.4% along with the mid-caps, which are down around 0.2%. So it's a bit of a subdued day. Good time then to get in a technical check. We have Himain Kapadia joining in to tell us what he's strategizing today. Himain, hi, welcome to the show. Well, for the Nifty, it is showing a cut-off close to around 90 odd points at this point. What is the strategy that you would recommend?
A very good morning to you, Ekta. Thank you for having me on the show. It's always a pleasure. Frankly speaking, the Nifty has been sleepwalking for the last 18 trading sessions, Ekta. Nothing much happening. Okay, the VIX is sub 12, it's sub 11.5. So you would normally expect the bulls to do better, market should improve. But that hasn't happened. So 18 trading sessions, 19 trading sessions. And so as far as the Nifty is concerned, I don't think there is much to do. Yeah, as long as 24,000 holds psychologically, I think it's a win. As far as the bank Nifty is concerned, it's a shade better, but they are meandering aimlessly. There is no trending bias. Nothing seems to be happening. It's very stock specific. And paradoxically, the small cap index has posted a fresh all-time high, and last week the mid-cap index posted a fresh all-time high. So it's mid-cap, small caps, mainlines have just continued to sulk, actually.
Okay, all right. Hi, Iman. Good to see you in after a while. What about individual stocks?
Yes, Nigel. It's been a long time. Good to see you too. Yes, individual stocks. Firstly, I have a buy call on HDFC Life Insurance. Firstly, there is not much to lose. It's virtually fallen off a cliff from 820 to 530. Downside limited, rounding bottom. Stock is oversold. Mechanical indicators crossover buy. And not only the daily, Nigel, even the weekly charts are showing positivity as far as the oscillators are concerned. So one can buy HDFC Life at 550, stop loss of 530, target of 590. I believe a medium-term base formation is in place. Second stock to act or buy is SBI cards, Nigel. Same logic almost applies. We've been down for almost 4 or 5 years. Base formation is in place. A base probably has been formed on the weekly chart, and the stock seems set for a turnaround. Albeit the markets don't allow you the luxury of a fast move, but yeah, it seems reasonably stable. So one can buy SBI at 650, stop loss of SBI cards at 650, stop loss 625, target of 690. Same story, oscillators, base formation, positive divergences. Everything seems to suggest we're on with a bounce, and the bounce is supposed to bounce some more. Nice.
Okay, all right, Himain, we're going to let you go on that note. Thanks very much for joining in and giving us all of your strategies. Well, for the Nifty Bank, a little bit of a recovery from the day's low. But let's shift focus now to our special segment where we will get you a few ideas for profit from Money Control Pro. We have Tejal Parab of moneycontrol.com joining in now to talk about a stock that she's tracking very closely. Tejal, over to you.
Today's stock idea is Bharat Electronics Limited, a key player in India's defense electronics space. The company specializes in critical systems such as radars, communication equipment, and electronic warfare solutions. One of the biggest positives for Bharat Electronics comes from its order book of around 72,000 crore, nearly 3 times its annual revenue, which provides strong revenue visibility for the coming years. Moreover, the company has a strong pipeline of opportunities from programs such as QRSAM, the P-75I submarine project, and the AMCA aircraft program, which are expected to drive the next phase of growth. Apart from its domestic opportunities, Bharat Electronics is also expanding its exports business and expects export to contribute 10% to the overall revenue over the long term. Furthermore, in terms of financials, the management is guiding approximately 15% revenue growth and healthy EBITDA margins of 28%. So, overall, even though the stock is trading at 38 times its FY28 estimates, the valuation seems justified given the robust growth visibility and healthy order pipeline.
Okay, thanks a lot for that, Tejal. Well, for the time being, we'll slip into a short break. On the other side, we'll focus on the OFS. That's Hindustan Copper's OFS. We'll have Parthiv Jonsa of Anand Rathi who will be joining in to give us his view on this particular OFS. Stay with us.
Welcome back. You're still tuned into Chartbusters on CNBC TV 18. Well, while the market is subdued in today's trading session, it is IT and pharma which are taking really a brunt of all of the selling pressure today. So we have HCL Tech, which is down around 1.5%. But we even have Cipla, which is the top loser on the Nifty today. So that stock is down around 1.6%. Watch out for a couple of these steel stocks as well. So we have Hindalco, JSW Steel, all of these stocks down and out in today's trade. A handful of stocks which are managing to hold their head above the water. So Trent is one of the key gainers. It's up around 0.7%, but really not even a percent in terms of gains coming in for that particular counter. Nonetheless, we do have one stock in the broader markets which is seeing good gains. Nitco is surging in trade after its subsidiary signed an agreement with the house of Abhinandan Lodha to develop land in Alibag. Yash gets us all of the details on this story. Yash, go ahead.
Well, this is something that we had reported on April 13, 2026 about this very deal between Nitco and House of Abhinandan Lodha. The company has confirmed it to the exchanges today. Essentially, Nitco, along with the promoter, has entered into a memorandum of understanding, that is MOU, with HOABL, which is House of Abhinandan Lodha, for a joint development of various land parcels as far as Alibag is concerned. I mean, as far as the cash consideration or the fund consideration is concerned, Nitco expects to generate about 1,300 to 1,500 crore from this particular transaction, and that would be done over a period of next 5 years. Now, the consideration as far as this 1,300 to 1,500 crore is concerned, that will be recognized in the books of Nitco and Nitco Realty, which is a 100% subsidiary of Nitco. What makes this transaction very interesting, it's of course a large transaction in that sense, but Nitco's market cap as of today is about 2,500 crore, and over the next 5 years it expects about 1,300 to 1,500 crore from this deal alone.
Got it. All right, Yash, thanks a lot for that. Well, we'll slip into a short break. Come back. We'll continue to focus on markets and stocks that are moving around. Stay with us. Welcome back. You're tuned into Chartbusters here on CNBC TV 18. Well, let's focus on Hindustan Copper. The stock is under pressure because yesterday there was an OFS that was announced post-market hours. And the floor price is fixed at a 9.5% discount to yesterday's close price at around 514 rupees. Remember, today non-retail will be applying. Tomorrow, retail gets a chance to apply for this issue. The government will divest close on 3% stake. They have an option to sell another 3% stake. So if they go ahead and do the whole hog, like do the 6% odd, then they could probably raise close on 3,000 crores or thereabouts. Remember, as per the latest shareholding pattern, the government has around 66% in the company, FI is at around 6%, and DI is at around 4.8%. Of that 4.8%, more than 50% is actually LIC. You'll ask, what makes Hindustan Copper stand out? Well, it's the only listed pure copper miner in India and the only play on copper prices as well. They have access to around 45% of India's copper ore reserves as well as resources. On valuations, well, it looks very expensive, right? Because it's the only play on copper prices. On a trailing basis, it trades at more than 50 times. However, the EPS from sub 10 rupees is expected to go to around 20 rupees as per Anand Rathi. And then it trades at close to around 25 times odd. Remember, globally, there's a structural tailwind that's taking place for copper because there is a bit of a deficit and there is, usage of copper in various fields, whether you talk about EV, data center, electrification, and across various segments. So because of that, there's a lot of interest in copper. But should you be applying to this particular OFS? Well, let's get one of the loan analysts that have been tracking the counter and in fact been quite spot on. Parthiv Jonsar joins us on the show. Hi, Parthiv. Good morning. Thanks a lot for joining in. I think you were the lone guy at much lower levels actually to initiate coverage on Hindustan Copper, and that call has played out quite well. But the valuations are always a worry, right, Parthiv? What would you do? Your advice would be go ahead and subscribe to this particular issue?
Sure, Nigel. Let me just answer you on the valuation front, actually. As far as valuation is concerned, it's not as expensive as it looks, right? You might say that, okay, being the mining company, it is trading at about 16, 18 times EV/EBITDA 2 year forward. But if you see companies like Southern Copper or Ivano or, likes of those in global market also, they all are trading at around similar level between, say, 13 to 17 and a half, 18 multiple, forward multiple. So it is not that only Hindustan Copper is, basically commanding such a high valuation. It is basically copper as a concept which is commanding a high valuation at the end of the day. If you see from 2021-22, the multiples have also got re-rated. Even pre 2021, when say your iron ore miners or any other miners used to command a 2 year forward multiple of 4.5, copper still was commanding a multiple of 6.5, 7, which has now gone towards that 15 mark. So as far as valuation is concerned, I don't think this is a expensive, very expensive stock, especially considering, your volumes are going to kick in and they are consistently improving. Even if you see Q1 results, the volumes were up at the end of the day, including your LME plus your rupee depreciation. All of these things and negative TCRC actually helped out to a great extent in Q1 result. Okay. Now, should you be applying to OFS? At a 514 rupees of a flow price, that's almost about, say, 9.5, 10% discount. And this is not the first time, Hindustan Copper is coming out with an OFS. If you see the history right from 2012, 13, 14, 16, 17, and 21, right? You have multiple OFSs coming in. So 2012 OFS was a very extraordinary period when, the public holding was less than 0.5%, where, government actually had to, move down towards 90% mark. But if you see any other OFS, whenever there is an OFS, the stock price remains under pressure, comes down towards the floor price or even below the floor price. But within a couple of, weeks or months, it actually bounces back to a great extent. So even currently, though the price is down about, your stock is down about 6.5% today, I'm expecting it to be further remain under pressure tomorrow. But thereafter, say from that 500, 490 level, it should bounce back in next couple of months. Okay. And our target has remained at 715. So that, see, OFS does not mean there is a change in fundamental, right? Your fundamentals, your underlying fundamentals continue to remain strong, basically.
Okay, Parthiv, hi. Thanks very much for joining in on the show. So this target price of over 700 rupees that you have, what is the long-term bullish argument that you are providing to support that thesis or that target price?
See, number one, this year volumes are expected to hit about... when you say ore, that's expected to go about 4.7 odd million ton, which is also what the MD sir has said on your channel just a couple of days back. And as far as MIC, what I'm expecting it to be about 34,500 tons of concentrate for this current financial year. Thereafter, eventually, this 4.7 million ton of ore going to say 12.2 when Raka comes in, all the other mines, basically start kicking in, right, at the end of the day. What my other argument is that, though your copper LME is hovering, yesterday it closed over 14,250 odd level. My estimates in my model for current year is about, say, 13,500. Thereafter, I've actually reduced it. Stating that as and how your global mining companies, enhance the production, I've actually reduced it towards that 12,600, 12,700 mark. So I'm very well comfortable as far as my estimates are concerned. I'm very confident because I have personally seen the Malanchganj mine on few occasions, and I'm very confident that eventually the shaft would come in, and eventually this current 3.5 million ton of a run rate will actually go to 5 million ton. So as far as my underlying understanding of copper as a concept, I'm very confident on the metal at the end of the day.
And MIC volumes would be what? The MIC volumes you're factoring in the next couple of years is how much? I think 27,000, you're expecting 34,000.
Correct.
And then, say by 2029, what are you expecting?
So eventually 34,500, thereafter going to say 40 to 43, and eventually going, excluding Raka, I'm expecting it to about 79, 80,000 tons, basically.
Oh, that's large.
And when you add Raka with the existing mine, and this basically excludes your the mine in Sikkim and one of the mines in Jharkhand, which the MOU has been signed with the state, but excluding those two mines, on a cumulative basis, it's expected to go about 1 lakh ton. Basically.
Lakh tons. That'll be a blue sky scenario, Parthiv, if that happens from 27,000 tons on. But you're confident with regard to the execution as you're saying you visited the mine. One more factor is, what kind of grade are you expecting? I mean, last year I think it was around 0.75% or thereabouts. That as well as gradually to move up. What do you expect it to go to?
So what the company, if you remove the data for all the 7 mines, right, the average is anywhere between 0.8 to 1%, just to give you a broad scenario. What also the MD sir just a couple of days said that, okay, Malanchganj has a 0.85, and that is basically there in the public domain, right? What we are factoring in is this year, say last year it was 0.747 precise grade in 26. This time we are expected to be 0.75. And as in how you move your operations more underground, as in how shaft comes in, you ramp up the volumes, the grades are expected to go. But just to be safe enough, we have kept a grade at 0.84, 0.85 by 31, not even 30. So we are very comfortable as far as the LME is concerned, as far as our grades are concerned. And we have taken the volume ramp up as given out by the company. So in all the 3 scenarios, we are very much comfortable as far as our estimates are concerned, basically.
Okay. Well, Parthiv, Q1 was extremely strong for Hindustan Copper. What is it that you are estimating in terms of an exit rate for FY27 for Hindustan Copper in terms of revenue as well as profit?
So let me just give you this in terms of EBITDA. I think they did about 500 odd crores of EBITDA. That was about 54 odd % of EBITDA margin they did in Q1. What I'm expecting is about 2,500 crores of EBITDA for 27 and about 2,850 kind of the number in 28, basically. Now they are actually increasing and going, doing the production and increasing the volumes. So there are four events which plays out. Your LME, your rupee depreciation, your volumes, and your TCRC. If you see TCRC right now, it's at a record low level, and the benefit, Hindustan Copper gets that benefit, right, at the end of the day. As far as your LME is at a record level. Your every 1 rupee depreciation, in rupee actually helps your earnings by about 1.7, 1.8 percentage, right, at the end of the day. So all the 4 events are in favor of Hindustan Copper, I would say, at the end of the day. So I'm confident that the company would do that about 2,500 crores of an EBITDA this year, and eventually 2,850 to 2,900 crores of EBITDA next year. Eventually inching it towards that 4,800, 5,000 crores mark over next 5 to 6 years, basically.
Okay, part of the final question, the other problem is, as you said, 2017, the government sold 6%. I think they raised close to 400 crores. 2021 as well, they sold another 6%. I think around 700 crores is what they raised. Now, this time around 6% is going to fetch them 3,000 crores. The problem is their stake comes down to 60%, but they still have close to around 9% that they could potentially sell. That's an overhang, right?
I don't think so. If you see, they have been selling in at a very, at a good interval, basically. It's not that overhang is going to come out overnight. I would rather put this across that, this, say 3 plus 3, assume they do 6%, right? This will actually add a lot of liquidity to the market at the end of the day. especially, companies like Hindustan Copper, where everyone would like to participate in a copper play, which is one of the direct copper play, 1:1 copper play, and if you take a bet in copper as a subject, right? So I think this is actually a good event. Even after this, they will be still over 60%. And OFS of the past were because, they had to come down, they had to reduce their stake. It was a mandatory event, if you see. And that is the reason why you cannot compare levels of the past with today's level. So, for example, what they did in 2012, they gave a 42% discount to that price of 250 rupees. They gave it at around 155. The OFS what they did in 2012, but again the 2013 OFS what did that was more calculated, with hardly any discount of about 2.5-3%. So not all OFS are just to capture on that divestment purpose. Some of these are also very strategic in nature. So I think this is not an overhang in my opinion.
Okay. All right, Parthiv, thanks a lot for joining in and giving us that view. Ekta, market's full of opinions. Earlier this morning, you had Rakesh Arora said the stock is too expensive for my liking, so he wouldn't take it. And yes, Parthiv who says he believes that valuations actually are secondary because as things go by, they are expecting EBITDA to move up, profitability as well to improve. So he believes that it's actually a good opportunity. So opinions make the market, and that's precisely what we've heard in the last 90 minutes.
Absolutely. So for Hindustan Copper, it's down around 6.5% today, reacting to the news of the OFS. But remember that the stock itself has rallied over 120% just in the past 12 months. But on that note, it's a wrap on Chartbusters. Stay tuned. Trading Hour up next.
Hello and welcome to Trading Hour live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra and with me is Ritu Singh. Ritu, good morning. Well, another down day for our own markets. While the Bank Nifty was a big drag yesterday, it is attempting some recovery in trade today. But other than that, it's a 72-point downtick on the Nifty. It is below the 24,200 mark. And mid-caps, though outperforming the benchmark, are not doing so well as well. And PSU banks are the ones which are bucking the trend for now. But let's see which way things go.
Well, good morning to you, Sonal, and we will see how things go and hopefully up from here. But, you know, it is a little cautious mood in the market today, and it is a monthly expiry as well for the Nifty. So there's going to be some volatility, and we're seeing that choppiness in the morning, this morning in the trade as well. The broader markets are also seeing the pressure that was holding up part of the markets yesterday. So you have the mid-cap index that's trading with cuts of about 103 points as we speak, and the small-cap index is also down in the red. The IT pack, that's down about 0.6%, and the Bank Nifty also dragging the market slower, trading still very much in the red. But look at the market breadth. That also shows you where the anxiety really is. You have close to 1870 stocks that are on the decline versus about 1270 stocks that are advancing. So it's not at all even, Stephen, this morning as we were seeing yesterday. But a quick check on the macros as well. Oil prices are also edging slightly higher today. They're gaining after that sharp drop of 2% that we saw in the previous session. The Brent crude now at 92.5 to the dollar. So it's come off since the morning a bit. The rupee has also been trading in a very narrow range. Just around 30 to 35 paise move is all we've seen in at least the last 10 trading sessions, and RBI's likely persistent intervention that has kept the rupee afloat. It opened this morning about 2 paise higher, now at 95.72 to the dollar. The 10-year GSEC yields, they're also hovering near a 2-month high at about 6.87%. as we speak. But that is the setup on the macros and the markets. Let's get it back to Sonal with the buzzing stocks that are making news today. Sonal.
Well, you know, a lot of moving parts in the broader markets. Let's talk about Nifty first because it is below the 24,200 mark. There was an attempt to recovery, but it's really Nifty Metals which is leading to the fall, one of the top sectoral losers in trade today. And that is something that is putting pressure for now. But if we get stock specific, we do have a lot of stocks which are in news. There's an OFS for Hindustan Copper. It's down around 7%. Sigma Advanced has advanced a deal, and it's an extension of a deal that they've made. So that is something that the street likes. Some tax issues around IIFL Finance, so the stock is lower in trade. We do have Afcons Infra and Seagull, which are higher in trade on the back of some order wins. So those are some infra stocks on our radar as well. A lot of stocks which are buzzing on the back of huge volumes. We have PVR Inox, which announced that they'll be looking at buyback and other considerations in a press release today. Paradeep Phosphates is the other one, up around 6% in trade. Huge volumes again here. GE Shipping is the other one, which is up around 1%. In the broader markets, we do have fertilizer stocks which are buzzing, and how? Fact is up around 12.5%, 70 times the average volumes that it trades at on a daily basis. There's Madras Fertilizers, which is up 6.5%, RCF2 doing really well. And we do have NFL, which is higher in trade as well. Which are the stocks losing in trade? We have far and few of them. Godrej is the one, Industries, which is down around 4%. We do have Acme Solar. The stock has been declining ever since numbers, and there's another 3% fall today. LT Foods, which was surging in trade yesterday, is seeing some profit booking in trade today. We do have Affle as well, which is not doing so well. And BLS International, which was down around 11% yesterday, continues its down move, though it has recovered from the lows of the day. Some stocks at a 52-week high in a weak market like this. We have AU Small Finance BAG. Wellspun Corp also continues its up move after that big order. We do have HFCL as well, which is doing well in trade. Though right now flat, it did touch that 52-week high level in trade today. At 52-week lows, we have Dabur continues its down move. IRB Infra is the other one. PI Industries, ever since it reported its numbers, the guidance is something that the street did not like, continues to trend lower. Brainbees is the other one, which continues to decline. It is actually at an all-time low as well. First Cry is the brand that I'm talking about, and Brainbees is the listed entity of that one. Sun TV is the other one, which is at a 52-week low. So yes, these are some of the stocks which are buzzing around in trade and on our radar as well.
All right, Sonal, thanks very much for running us through that exhaustive list. But there's another stock that's on our radar, Hindustan Copper. That stock is now down about 6.8% as we speak, after the government said it is set to divest stake in the company through an offer for sale. The floor price has been set at 514 rupees per share. But let's get all of the details with Nigel D'Souza, who's tracking the company closely. Nigel.
Well, that's right. Hindustan Copper is in focus because the government of India came out post-market hours yesterday and said that they're looking to sell some stake in the company via the OFS route. Now, the floor price has been fixed at around 514 rupees a share, which is a 9.5% discount to yesterday's close price. They're looking to divest close to around 3% with an option to sell another 3%. Now, put this together, they could raise close to around 3,000 crores, if they go the entire hog and they sell the entire 6% or thereabouts. Remember, as of the last shareholding, that's as of June 2026, the government had close to around 66% stake. So effectively, if they go the entire hog, then the share comes down from around 66% closer to around 60%. FIs have a little south of 6% in the company, and the DIs, they have close to around 4.8%. More than 50% of that is LIC's holdings in the company. You'll ask, what's so special about the company? Well, it's the only listed pure copper play in India. They have access to about 45% of India's copper ore reserves as well as resources as well. But it's coming at a hefty price because there's a scarcity premium, right? They're the only listed play on copper prices. Remember, copper demand is expected to remain strong globally because of EVs, the electrification theme, data centers, and, it's basically the play on global economy as well. So that's why, in fact, there's strong demand, and besides that, there's a bit of a shortage as well that plays out. But valuations, not cheap at all. On a trailing basis, it's coming in at more than 50 times PE. But going ahead, the street believes, or Anand Rathi has put out estimates as well, that the EPS can move from around 10 rupees to around 20 rupees. So in that sense, it would be a little bit more better at around 25 times or thereabouts. So Hindustan Copper in focus on the back of this OFS.
Thank you so much, Nigel, for joining us with all those details. That's Hindustan Copper, which is declining in trade. The other stock which is on our radar is IIFL Finance subsidiary. IIFL Home Finance, which is under tax department scanner, has received around 963 crore rupee tax demand. Ananya is joining us with more details on this one. Ananya.
So IIFL Finance has reported 2 income tax matters arising from their block assessment covering from April 2018 to February 3rd, 2025. Now, here IIFL Home Finance, which is a subsidiary of IIFL Finance, has been served a 963.39 crore tax demand here. Now, the major additions include 490 crore of overriding commission income, 392 crore of interest strip asset, 305 crore under section 36 subsection 1 clause 8 and 53 crore of ESOP expenses here. Now the subsidiary is challenging these additions through the appellate process. Now, the second matter relates to IIFL Finance itself, which had an earlier 475.56 crore tax demand here. Now, recovery of this amount has now been stayed until December 31st, 2026 or until the appeal is decided, subject to a payment of 5% or 24 crore. Now, out of this, 5 crore has already been deposited here. Now, today on our channel, CFO Mr. Tushar of IIFL Home Finance expects the 963 crore demand to be deleted at the first appellate level, although the process could take around 6 months to a year, he mentioned. Importantly, while the requirement can generally go up to 20% of the disputed amount, IIFL Finance has been asked to deposit only 5%, he mentioned, and management expects that this lower requirement would be favorable for them also. So Mr. Tushar is expecting a favorable resolution, but the final impact will depend on the appellate outcome here.
Ananya, thank you so much for joining us with all those details. In fact, earlier today, we spoke to Tushar Kutecha, who is the CFO, IIFL Home Finance, who said that the company will evaluate all possible options and appeal against the tax department's order. Listen in.
We will evaluate all the possible options of going to appellate authority, filing a rectification and stay of demand. So it depends on what the authority will instruct us. But largely, they go for around payment of 20% of tax demand or maybe lesser than that. We are in continuous touch with our tax advisor and the legal counsel. And all this demand, we feel that will get deleted at the first appellate authority level, and everybody understand and appreciate this point of view. Okay. We don't think so it will have any impact on that.
All right, let's stay with the financial space, but here's a CNBC TV 18 exclusive. Now, we've picked up from our sources that private sector lender Federal Bank is looking to acquire a controlling stake in Jana Small Finance Bank. My colleague Sudarshan has been tracking the story and he joins in with the details. Sudarshan, at what stage, are these talks between Federal and Jana, and how quickly could the deal be concluded?
So we understand from sources that it's likely in advanced stage between both Federal Bank and Jana Small Finance Bank, and the deal can be announced very soon. So as part of the deal, Federal Bank may look to acquire the controlling stake, and they may acquire the stake of promoter. Promoters holding as of June 30th was around 17%, or say exactly 16.9%. And after that, once they acquire the promoter stake, they might bring in open offer to acquire stake beyond 26%. Now, remember last month on July 9, Jana Small Finance Bank had informed exchanges that once the promoter stake goes below 9.99% in the company, they may seek reclassification from promoter category to public category. And also, we had reported attributing to sources that merger with a peer bank cannot be ruled out. Now, why exactly promoter is looking to divest or paid stake in the company? So, Jana Small Finance Bank's promoter, that is Jana Holding, owes TPG Asia rupees 700 crore for 37,000 NCDs, and that were issued in May 2023, and that for the same payment was due on June 30th, but lender had agreed to roll it over. Now, Federal Bank also just last week on August 20th, board had approved raising up to $500 million via bonds. We understand that they might use this fund, or they might use the proceeds from the bond fundraising to fund this acquisition. Now we have returned to both Jana Small Finance Bank and Federal Bank. We are awaiting the response from both the companies.
Okay, thank you so much for joining us with those exclusive details, Sudarshan. So that's an important story in the financial space. Slip into a short break now. When we come back, we'll discuss bond markets with Manisha Gupta on the other side.
Welcome back. As promised, let's get you all of the action from the bond markets. And Manisha Gupta, as always, is standing by to fill us in. Manisha.
Well, thank you so much for that. It has been the global markets where we have seen the yields decline, and Indian markets in the meanwhile seem to be trading in a narrow range at this point in time. Yesterday the yields were higher, but that is also because of the elevated crude oil prices, which continue to hold above 90, even $92 a barrel therein. There also are fears of escalation between US and Iran war. Financial and economic stuff is what US seems to be throwing at Iran at this point in time. In the meanwhile, the markets also are awaiting clarity on what really is working with US in the sense of new sanctions on Iran. We've been hearing Secretary Besant's comments in the last couple of days as well. So that is the clarity that the street is awaiting at this point in time. And then apart from that, there are various actively traded papers that we've seen into the market in the last couple of sessions. Within this, you have Bajaj Housing Finance, IFL Finance, and Poonawalla FinCorp, Andhra Pradesh State Beverages Corp, L&T. These are some of the companies where the papers are most actively traded. If you look at the private bond issuances, well, yesterday was 57.7 billion worth being issued, and today is even higher at 66.75 billion. Let me take you through some companies which are into the market today asking for bids. You have Vision Infrastructure Equipment, which is looking to raise 250 million, and they're doing it via 2 bonds. You also have ITI Gold Loans, which is planning to raise 1.5 billion. They are doing it via 2-year bonds. And then you have Progwin Private Limited, which is looking to raise 1 billion, and they are doing it via issuances of bonds, which are maturing in May 2028. Satin FinServe is also looking to raise nearly 1 billion, and they're doing it via bonds, which are maturing in 2028. Bajaj Finance is into the markets yet again today, and they're looking at 60 billion, and they're doing it via issuances of 10-year bonds, which are maturing in 2036. In the meanwhile, there are various companies which also have board meetings and board approvals which seem to be coming in as well. So Fed Bank is one where they are looking at into the markets today. They have considered raising 25 billion, and they're doing it via debt instruments. You have Punjab National Bank, which also is looking to raise $1 billion, and they're doing it via 3 to 5 year raising notes rather in the month of September. Home First Finance also is into the market, and they're also looking at the board approving raising 1.5 billion. And then you have Balkrishna Industries also looking to raise 5.5 billion via NCDs, where the board approval for many of these companies already is in. The date, of course, is something that the street is waiting for.
Okay, all right. Thank you so much, Manisha, for joining us. So that is the update from the bond market. Actually, we'll do one thing. We'll slip into a short break. When we come back, we'll discuss market technicals with Rajesh Palya of Axis Securities and also discuss their top trading bets. Welcome back. You're still tuned in to Trading Hour on CNBC TV 18. While the broader markets continue to be under pressure, of course, they're outperforming the Nifty by a wee bit. We do have some stocks which are buzzing on the upside, and there is a sizable recovery which is underway on the Nifty as well. That's courtesy Bank Nifty, and we'll talk about the other indices which are leading to that gain from the lows of the day as well. Vodafone Idea is the one which is buzzing in trade on the upside in the broader markets. It is up around 5%. The outperformance continues. There has been a lot of resolution for this company which is underway, and the commentary in the conference call was strong as well. Since then, the stock has seen a one-way up move. It is up around 13% in this month itself and is now up around 6%. But the recovery that we are talking about, which is underway, whether that will sustain or not, Rajesh Palvia from Axis Securities is joining us for a quick technical check on the markets. Rajesh, good morning. Thank you so much for joining us. There is a recovery which is underway. We have the expiry as well. Do you think it could continue to be very volatile, or we will continue to stay above the levels that we are seeing right now?
Yeah, hi, morning. So looking at the structure for indices, still we believe that, some more consolidation we may see for Nifty, as the Nifty has already broken 20-day or 50-day moving average. And on the higher side, there is a constant call writing activities taking place. So 24,200 to 24,300 is major call concentration area at this juncture. So that may act as a supply zone for any kind of, near-term recovery if takes place. But on the other hand, 24,100 to 24,000 is the immediate support area based on the put-based concentration. And continuously, we are seeing that, put writers are confident around 24,000 strike. So that level may protect in this, supply pressure, which we are seeing since last couple of days. But Bank Nifty is looking quite interesting, as Bank Nifty is attracting some buying interest and now negotiating with its immediate supply zone of 57,500, 600 zone. If at all Bank Nifty able to take out 57,600 zone, I think then we could see some short covering action to play out in Bank Nifty. As we have seen, constituents of the Bank Nifty is also attracting buying interest from the private sector as well as from the PSU sector also. So Bank Nifty is a area where, one can focus on during the day if you are index trader. Here one can deploy some long trade with stop loss of 57,150. On the higher side, Bank Nifty can scale to the level of 57,650, even 700 zone. So one can look for this trade. On the stocks front, I think pharma is one space where, buying interest is there. Broader market is showing good traction in terms of buying. So stock specific buying interest is there. So some of the stocks where we are focusing at this juncture is Keynes Technologies, looking quite interesting at this juncture. The way stock is trading near to its series highest point, I think here we could see some momentum to extend. Stock is now breaking out its near-term supply zone. So projecting target of 4,200 to 4,250 on the downside. 3,900 needs to keep as a stop loss. Another stock where we are focusing is from the jewelry space, and Kalyan Jeweler is looking promising. Stock is now breaking out its contracting triangle on daily chart, and since last couple of weeks, we have seen, stock is consolidating in range only, and now stock is attempting to give breakout of that range. So Kalyan Jeweler can scale further, and we are projecting target of 635 to 640. On the downside, one needs to keep stop loss around 600 level.
Well, Rajesh, since you brought up the banking space, I don't know if you saw the news that was just put out by our colleague Sudarshan. Jana Small Finance Bank and Federal Bank are in merger talks, where Federal Bank could acquire a majority stake in Jana Small Finance Bank on account of, the promoter debt and whatnot. Any calls on these two particular names?
So overall, Jana Small Finance Bank is in a bullish trajectory only. Stock is comfortably holding its 20-day moving average. Looking at the near-term, short-term structure, 580, 85 is the immediate supply zone. If at all stock crosses those level, I think stock can scale further towards 620, 630 level also. So overall structure is bullish. Those who are already on the long side of trade can hold the position. Even in the decline, one can add with stop loss of 550. Federal Bank is also holding the strength, though there was some supply pressure at higher side, but still looking at the short-term structure, we do hold bullish view. In this decline, one can look to buy still stock is trading above 335 zone. I think a trend is likely to exhibit further on the bullish side. Any breakout above 365 can attract more buying action, and then stock can scale further towards 380, 390 zone also.
Okay, all right. Thank you so much, Rajesh, for joining us as always. So those are some technical bets and levels on the Nifty to track as well. But what's happening in the world of F&O? Nigel is joining us now with the lowdown. Nigel.
Well, looking at the options data first, the PCR is holding at around 0.8 or thereabouts. And there's good amount of action both on the call as well as on the put side. But clearly the call writers, they seem to have the advantage in the last few trading sessions. I think, everyone's waiting for this session to play out. And then we'll get fresh direction from tomorrow. So the 24,200 call, just take a look at the premium. As of yesterday, it was at around 60 bucks. It's come down to around 15 rupees. So there's aggressive writing we're seeing on that one. Even if you look at the 24,150 call, the premium was around 93 rupees. That's come down to around 35 rupees. So there is clear amount of writing on both these two strikes. While on the downside as well, directionally you've got it right? Because the Nifty is down 80 points, 60, 70, 80 points or thereabouts. But still, at around the 24,100 put, the premium has halved. From 24 bucks, it's come down to close to around 12 rupees approximately. So there are signs of writing at that strike as well. That brings you to the levels. The Nifty resistance mark is at around 24,270 approximately. Because of the writing you're seeing at 24,200 call as well as the 24,150 call. Support though comes in at around 24,070. So that's where you're looking at a close 200-point range on the Nifty. Individual stocks, well, AU Small Finance Bank, that's showing signs of buying actually. There's some delivery-based buying and the rolls as well are on the long side, so keep an eye out on that one. And Vodafone Idea gradually moving toward that 15-odd mark. I recall a couple of expiries ago, it was around 9.5 to around 10 rupees and the rolls were very, were on the long side. It appears that one as well is moving with some momentum and there are signs of fresh buying on Vodafone Idea, so keep an eye out on that one as well.
Okay, all right.
Thanks very much, Nigel, for running us through that. Slip into a short break, but when we return, we'll get you market fundamentals with Rakesh Vyas from Quest Investment Managers. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Well, the big news, the U.S. Department of Homeland Security has proposed a $103,265 fee on caps subject H-1B petitions. If finalized, the move could make employers more selective and narrow down their options for Indian technology workers. To discuss what could the possible impact of this be on the IT industry, we are now joined by Ganesh Natarajan, Chairman at GTT Data Solutions. So, Mr. Natarajan, good morning. Thank you so much for joining us. Well, if this proposal does survive any legal challenge, what does it mean for the IT industry? Do you think these are some costs which will be absorbed by the clients, or it breaks the entire process or the setup which is already in place?
See, I think we're seeing history being replayed again, because if you remember, there was a proposal for 100,000, which was shot down by the US Supreme Court. So my own belief is that this is not going to go very far, because it is a restrictive trade practice. But if it does, obviously it's very detrimental, because there's already a move to say that, look, freshers cannot be given priority. The experienced people will get priority for higher salaries. So that's detrimental. Of course, it's expected to happen. But this one would be very punitive, because obviously a lot of people can't just afford to pay whatever the amount will finally turn out to be. So I'm hoping that this does not go through and we have a normal level playing field as far as H1 is concerned.
But Mr. Natarajan, like you said, I mean, we've seen this play out before, that 100,000 rhetoric earlier. But it's not that the Indian IT companies have abandoned their largest markets or completely changed their hiring strategy. I just wanted to understand, if this keeps on coming up, though, do you think there would be a structural shift in how campus hiring goes and how, these IT companies look at placements overseas? Or what do you think would change if this narrative continues? And that clearly seems to be the direction this is heading in.
See, there are two or three drivers for this. One is, of course, AI. As we all know, a lot of entry-level jobs are being taken over by AI. So the traditional demand for testers and coders, etc., has substantially come down, because a ChatGPT or a Claude can do it probably faster and more effectively than a human being. So that's one deterrent. The other deterrent for campus hiring, yes, is this, because if you cannot take a person, train them for 1 year and send them off on H1 to the US, it's not going to work out. And it's only at the higher levels of, let's say, project managers and above that you will see demand happening. So yes, there is going to be a structural shift in both hiring and in the kind of projects that we can afford to do from on-site offshore kind of a mix.
Okay, Mr. Natarajan, thank you so much for joining us. A short conversation, but as you pointed out, it's still a proposal. The hope is that it doesn't go through, and what happens next is something that we'll be tracking very closely. We'll do one thing. We'll slip into a short break now. When we come back, we'll discuss the market fundamentals with Rakesh Vyas from Quest Investment Managers. Stay tuned for that conversation.
Welcome back. Let's bring in Rakesh Vyas from Quest Investment Managers to discuss market fundamentals and his top sectoral picks. Rakesh, thanks very much, as always, joining us here on CNBC TV 18. Let's address that IT question first. If you just heard, we were talking about this proposed H-1B visa fee. It was 100,000 earlier. Now this 103,000 again has been proposed. I mean, the headwinds for the IT sector, AI, H-1B, all of this rhetoric from the US doesn't seem to die down. I'm wondering if you'll stay cautious on the sector, or does this open any opportunity for you?
Yeah, good morning, Ritu, and thanks for me having on the show again. So you are right. I mean, some of these are reasonable headwinds that we are continuing to see. But in the markets, Ritu, as you know, markets discount the future earnings and the risk thereof. But we are finding a lot of opportunities, especially in the last 6 months, to add some of the mid-sized companies which have been growing much faster. Where we have also seen them changing the business model to more tilting towards outcome-based model than the traditional, time and effort basis pricing models, etc. And therefore, there are these opportunities that we still think, despite all the headwinds, there is reasonable growth that can be seen in these companies available at a reasonable price. And therefore, we have added companies like Coforge and Persistent in recent past, and we continue to remain positively biased towards that. And I think some of these aspects around higher H-1B visa cost, etc., is probably going to be more impacting everyone in the market in general, and therefore it would be easier to absorb that effectively, although with a lag, and therefore the margin, etc., will not see meaningful pressure, is my view.
All right, take that point, Rakesh. Let me quickly address the other news that has been, been done right here on CNBC TV 18. That is this potential merger where Federal Bank could acquire Jana Small Finance Bank. Without, I understand you cannot talk about specific names, but largely, do you think investors would reward this kind of a consolidation? And do you see more deals happening in this space? The mid-tier banks, we've seen a lot of action with foreign investors coming in with big bucks. But do you see some more consolidation in this space, and how would investors look at it?
Absolutely, Ritu. If you see, if you look at the overall banking space in general, large cap banks are where they have a meaningful size already, and therefore for them to grow meaningfully higher than the system growth is always going to be difficult, and therefore the opportunities probably lie in the mid-sized banks, some of the regional banks which are trying to expand beyond their geographies and entering newer spaces, newer asset class, etc. And in that context, I think this overall FDI money that is coming in, helping them to drive that growth also is a theme that we have been continuously positive on. For example, we have a company called City Union Bank, again in a similar space that Federal Bank also probably operates. But this is a name where we are also playing the gold loan thesis, because more than 30% of their loan book is secured through gold loan, and therefore we are finding these opportunities where some of these banks are moving away from the traditional asset mix, which were probably, let's say, MSME, etc., into retail, newer geographies. And this is a theme that we think will continue to drive the growth in this particular space across many of these banks that you are trying to highlight.
Okay, all right. Take that point, Rakesh. Rakesh, I was just looking at your fund as well. You do have some of these mid-cap IT names. There is Eternal as well. I wanted to understand what makes you bullish on Eternal, or generally the quick commerce space. Do you think something could, or the new age companies, Urban Company has been doing really well, the stock so far. Is this a space which will continue to see growth from here on? Or because the dark store edition, we were having a conversation yesterday, could taper down, could peak off. So what is the sense that you are making on this space?
Hi, Sonal. Yeah, so I think on the overall new age space, and particularly on the quick commerce and the food delivery platform, we have been fairly positive on that space for some time. I think this is an opportunity that has just started from the metro cities and expanding into many newer cities. I think there is still potential for a player like Eternal, who has been executing very well and has not impacted their cash flows as well in that expansion phase, continues to remain, best in class in terms of the profitability, unit economics, etc., have a potential to continue to drive growth. And you are right. I mean, from a low base, the growth rates in the overall dark store expansion may taper off. but there is a lot of opportunity for them to start expanding the SKUs, start expanding the overall TAM, and therefore the utilization of dark stores may continue to move up, which will drive the growth. And in that context, I think both the names which are in the food delivery platform, which are driving a lot of profitable growth already, and we have seen them converting from a loss-making business trajectory to a strong profit-generating vehicle in 3 to 4 years' time in the food delivery. I think something of this sort may as well happen in the quick commerce, although competitive intensity remains high, Sonal. But I think this is now starting to taper off. Everyone has found their niche, and it's more about execution now than just land there.
Okay, take that point. Anything that you're bullish on now, Rakesh? Because we've seen earnings go through. Q1 stood out in terms of strong earnings, but a lot of it was led by better spreads. There were a lot of one-offs because of inventory gains, etc. What do you think will continue to do well now from here on? Something that you are bullish on, or maybe, look at buying now?
No, Samuel, you are absolutely right in your analysis that, first quarter earnings have positively surprised most of us. And I think that is what the market is trying to, absorb now and consolidate at this point of time, expecting the sustainability of this earning growth beyond the first quarter as well. Because some of these impacts that you highlighted could be inventory gain and pricing power, etc., reflecting in 1Q. But overall, I think the market will still probably see 12 to 14% earning growth over next 2 years. And in that context, the companies which have had very strong pricing power or are now looking at export as a reasonably large market in the context that rupee has depreciated meaningfully against various currencies, and there is a lot of opportunity where some of the global companies which have arms in India can find this potentially a very strong opportunity for increasing the export in the mix, which normally comes at a better margin, are the place where we are more positive on. For example, in the consumer side, some of the names which are in the building material segment, or the names where there is food inflation and the ability of the companies to pass on that and improve margin profile. Also in the manufacturing, as I was highlighting, Sonal, some of the names where the global players can now start to look at India as an export opportunities, which can be in the auto segment or the consumer durable space, etc., where we are not just addressing the domestic market growth, but also the potential growth on the export, are the names where we are fairly positive on. For likes of ZF and LG Electronics, etc., are the names we have recently added. So these are just the names we have added. It's not a recommendation, but I thought I'll just highlight.
Okay, take that point, Rakesh. Always a pleasure speaking with you. Thank you so much for joining us today. So that's some market opinion coming in. But let's move on and talk about some updates from the mutual fund industry as well. PPFAS Gift City Fund has reduced the minimum investment in 2 of its outbound funds. And let's talk about which are these funds and how important this particular piece of news is. This is for IFSC S&P 500 Fund of Fund and NASDAQ 100 Fund of Fund, where the minimum initial subscription has fallen to $500 from $5,000. So that's a big fall that has come in here. The change is effective from August 25th, and the threshold below which the PPFAS Gift City Fund can redeem all units in case of a partial redemption also falls from $1,000 to $100. So this is a big cut in minimum investment coming in from PPFAS. Now, if we take a look at the other AMCs, because a lot of them have been launching funds in the Gift City, and always the minimum investment is very high versus normal mutual funds. For Tata AMC, the minimum investment is $500. If we talk about DSP Mutual Fund, which is an outbound fund, it is $5,000, and which is into global large cap stocks. If we talk about Edelweiss, which is Greater China Equity Fund, which is again an outbound fund, the minimum investment is $10,000. So of course it is at par with Tata's, but much lower than the other AMCs. Just an alert, resident Indians can only invest in the outbound funds under the liberalized remittance scheme. And inbound funds are restricted to NRIs, OCIs, or foreign nationals. So that is the differentiation right now. And a lot of them have not opened up for Indian retail investors as yet. But it's time for a short break now. We'll get you an interesting insight on UPI marking a decade of transforming India's digital payments landscape. Stay tuned for that. Welcome back. A decade ago, UPI set out to transform how India pays, and it has done just that. But 10 years on, the ecosystem remains heavily concentrated with a handful of players commanding the lion's share. Here's a look at how India's UPI story has evolved.
Well, UPI has gone from a payment experiment to one of India's largest digital payment networks in just a decade. And as UPI turns 10, the best way to understand this transformation is to look at the growth curve. Now, transaction volumes have grown from just 1.8 crores in FY17 to more than 24,000 crores in FY26. That's nearly a 13,000-fold increase. And the value of transactions have gone from virtually zero to over 314 lakh crore rupees annually, which puts the decade-long compounded growth rate at a staggering 188% for volumes and 155% in value terms. Now, growth rates, of course, have slowed down as the base has exploded. So volume growth has come down from about 106% in FY22 to 30% in FY26. Value growth has also eased similarly to about 21%. But look at the absolute scale. I mean, UPI processed nearly 2,366 crore transactions in a single month, which was worth about 30 lakh crore rupees. That translates to roughly 76 crore transactions every day. So the scale is undeniably enormous, and it's very much a mass market usage story. Now, here's the more interesting split. Merchant payments, they make up about 63% of UPI volumes, but person-to-person payments still make up nearly 70% of the value. So in other words, UPI runs on two engines. Merchant payments give it frequency, and person-to-person payments give it the size. Now zoom out and the scale gets even more clearer. So UPI now makes up 84% of all digital payments in India. Globally, it accounts for nearly half of all the real-time payment volumes, and it is now live in 11 countries from the UAE and France to Greece and Cambodia. But despite that massive scale, the UPI app market remains highly concentrated, with the top two players, PhonePe and Google Pay, together commanding nearly 80% of all UPI transactions. And that's exactly why NPCI has been pushing for a 30% market share cap for individual third-party UPI apps to address the concentration risk. But of course, the cap is yet to be enforced. The deadline keeps getting pushed. Now it is the 31st of December this year. So think of overall the UPI story in India in three acts. Act 1 was adoption, which is getting India onto the network. Act 2 was the scale, which is the numbers we just walked you through. And now we're entering Act 3, and that is the sustainability of this very large ecosystem. And that's where the MDR debate now comes into the picture, with the government opening the door to potentially charging select merchant transactions in the future.
Okay, all right. Thank you so much, Ritu, for that update. India's 10-year digital payments journey, going from cash to cashless. Don't forget to catch the full conversation at 5:30 p.m. today. Well, that's the lineup that we have for you. But, Nifty, that has come off sharply from the lows of the day. We're at just the flat line, and Nifty is seeing a big recovery. In fact, if we talk about the Midcap index as well, that is the one which is in focus. It is still, it is actually now underperforming the benchmark by a wee bit. We do have metals index, which has come up from the lows of the day. It's a 65-point recovery from the lows. So we'll keep tracking that for you. A lot of moving parts in the broader markets. We were talking about Vodafone Idea. That stock is higher. Fertilizer stocks continue to trend higher. Some of these names which are doing really well will be in focus as well. In fact, we do have an important conversation for you on the show now. DIPAM Secretary Arunish Chawla is now joining us, and Nigel is here to take this conversation forward.
Well, thanks a lot for that, Sonal. Well, thanks a lot for joining in, Mr. Chawla. We appreciate you speaking to us here on CNBC TV 18. Well, that big OFS has been announced. Hindustan Copper, the timing could have been actually not better, because there's a bit of a deficit in copper globally, as well as demand has been rather strong. What kind of feelers are you getting in terms of a feedback, sir? And if you could tell us, as of now, do you think you all will exercise the other 3% as well? 3% is what you're scheduled to sell, and the green shoe could be another 3%.
Absolutely, you're absolutely right. Hindustan Copper OFS has been announced. 6%, which is 3% base and 3% green shoe. Total 5.8 crore shares are on the table today for the investors. The timing is optimal as the commodity prices are now picking up. The metal prices are picking up. And the OFS has been designed in a way that it also leaves some room for a decent room for the investors to make money and gain profits and make money from it. And the forecasts are good. The future is even better. Hindustan Copper has very far-sighted capital investment plans in terms of its mining operations, modernizing them and increasing the output. And that is why this OFS has been announced. And I'm happy to share the news and also share with the investors that in the last 12 years, we've had 6 OFSs market offers for Hindustan Zinc. And the government's equity has been brought down from 100 to now 66%. And this is a big OFS because in one leap, we'll come down from 66 to 60. As you can understand, we are leaving 10% margin for the company to meet its capex plans and mobilize capital on the markets. This will help sustain its growth in the future and give forward returns to investors. So our message for the investors is don't miss this opportunity. This is a golden opportunity. And in line with the Honorable Prime Minister's vision of sharing our national wealth with the investors and the citizens of India, this is your moment. The offer is on table today and tomorrow. So please partake in it and make best use of the opportunity.
You know, Dr. Chawla, if I look at it, actually, the timing has been perfect. In 2021, I think the stake sale was done at around 115, 120 rupees. So those investors are sitting on gains. And if I jog our memory back to 2016 and 2017 as well, the OFS was done in that vicinity of around 65 to around 70 rupees. So those that had held on, they would be making some money. Interesting to see what happens this time around. But as of now, you're telling us the intent is to bring it down from 66% to around 60%. Is that correct?
Yes, which is why we've put a big block of 6% on the table this time.
Got it.
I think 1/4 is already, a base offer is already subscribed.
Yes.
And we still have 4 market hours to go. And people are coming in. And so we hope and, we are expecting that the full green shoe will be exercised today.
All right. The feedback that I'm getting as well, because I've been running the phone calls, is that people are waiting for the second half of today to put in some bids because there's not too much coverage on the stock itself. But as you're saying, you're quite optimistic that the 6% goes through. The investors, sir, though, will be wanting to know what happens next. Because from 60%, will you bring the stake down to around 50%? Or is the government of India now satisfied with the 60% holding in Hindustan Copper? And they'll not look to bring down the stake from around the 60%, say for the next couple of years at least?
See, we have a capital management framework. And in that framework, we share, existing stocks with the investors, which is one part of the deal. And we also have capex plans. And as you know, the PSUs have a performance framework. And we are very careful that there is sufficient room for capital investment in future to sustain growth plans and also to ensure incomes are sustained, and we impose a fair dividend policy, which is 30% of profit after tax or 4% of net worth, whichever is higher. That has to be shared with the investors on continuing basis. That is a must. So you should see this as an optimization framework, which is how we decide how much of existing stock to offload, which is primary, which is secondary, and how much to mobilize as capital in the market, which is primary.
Keeping it open-ended for now with regard to what the government does next. But as of now, the intent is to bring it down to around 60%, and then we'll have to see how things go. Is that fair?
Correctly.
Okay. Let's focus on the other asset then, sir. Over the last few days, there's been some speculation the government of India probably will come in there and sell some stake even in Hindustan Zinc. Could that be the next asset on your radar?
You played it out all the day in the market hours yesterday. Mm-hmm. In the evening, after the market hours ended, we pulled off a bit of a surprise, and that has helped. That has helped the process. So I would not say anything more. We knew the market offers, but we will also continue with our part of the surprise.
Right, sir. But we didn't play any news with regard to this, but there has been speculation that since Government of India has around 27.9% stake, I know they are not a promoter entity, so there's a possibility that Hindustan Zinc could be the next asset that you're looking at.
Not immediately, not at the moment.
Not at the moment. Okay, we take that then. What about strategic sales, sir? For the remainder of this fiscal year, does IDBI Bank actually go through?
I'm not going to comment on it right now. We don't comment on transactions in process. And going further, I will not be able to give you any transaction-specific detail. Wait as the time comes.
Just one more word, sir. Then what is the target for this year is around 80,000 crores, right? In terms of a divestment target.
Yes, please.
You think you get there, or is that? Do you think a more realistic number will be a little bit lower?
Team Deepam has worked very hard. We are confident of meeting our targets, and we are confident of meeting our obligations to small investors.
Okay, so you will be meeting that target, the target that you have for FY27 in terms of disinvestment.
Yes, please.
Okay. Just one more question before I hand it over to Nigel again. What is in the pipeline? There was stocks around ONGC as well. There was one done in 2022, 1.5% OFS. Before that, it was scrapped because oil prices were quite volatile. Do you think ONGC is also a candidate? Maybe you cannot give us the timeline, but do you think this is one of the candidates for an OFS?
We don't comment on speculative news.
Okay. Sir, let's just focus on the strategic sale for this year. Which is most likely? IDBI Bank, Concor, BEML. Which one of these three could possibly take place?
You've already asked that question. We don't comment on strategic transactions. Wait for everyone comes with a time. Please wait.
Okay. Final question, sir. Then with regard to LIC, you'll have gone ahead. 30,000 crores is what you'll have managed to raise via that sale. What is the targeted holding in LIC, and for how long now we'll not expect any further divestment from the Government of India in LIC?
As you know, we had a large sale offer, which is the largest sale offer on our markets ever. 31,500 crores is what investors invested, and they have not regretted it. They have already gained 10% on what they invested. And with this, we have reduced the government stake in LIC to 90%, almost 1 year ahead of the deadline, which means there will be a pause and a sufficient opportunity for investors to gain from their investment. I will keep it at that for the moment.
Okay, all right. So let's shift focus away from some of these listed entities. What about RINL? Is there a plan to, divest that asset, or probably try to turn that asset around and then come up with an IPO?
No comments at the moment.
Okay, last question then. We'll try to understand your strategy. How does Deepam decide the timing or OFS or for IPOs given the market volatility? What are some of the processes in place for you to decide which company and what is the timing?
Deepam now has a market research unit of its own. We have market professionals, a very energetic team. We have an operation room of our own, which we call Kurukshetra. And these people work. We do a micro research for every asset, and we take decisions at the moment on the money and on the basis of our asset-wise strategy. We are neither guided by broad sweeping statements that overall market is good, overall market is bad. There is time to do good things all the time.
Okay. All right, Dr. Chawla, we appreciate you speaking to us here on CNBC TV 18. All the best with regard to this particular issue. But the last time around, when you all sold stake in Hindustan Copper, at around 120 rupees or thereabouts, those investors made a lot of money, and you will be hopeful that this time around as well, interest is high, and those that actually get allotment, they actually make some money from here on. We look forward to touching base with you yet again and finding out what's the strategy from here on, and which is the next potential OFS that we look forward to.
Thank you very much, and good luck to everyone.
Okay, Dr. Chawla, thank you so much for joining us with your word on this OFS. Thank you, Nigel, for taking us to this conversation. And with that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
Welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra. With me is Vinny Motiwala. Well, it is turning out to be a subdued session yet again for the market. So we have the Nifty, which is just about hovering at around 24,172. We have recovered from the day's low, but nonetheless nothing to write home about in terms of any kind of significant moves. For the Bank Nifty, absolutely flat as we speak. And we have the Midcap index, which is trading with a marginal loss of around 100 odd points. A lot of stocks in news. We do have some important statements coming in from the DIPAM secretary talking to CNBC TV 18 about the Hindustan Copper OFS and a lot more in terms of the plans on divestment in FY27. For Hindustan Copper, for example, that one is one of the broader market losers today, so down over 7% for that particular counter. Hi, Vinny.
Hi, Ekta. Good afternoon. Yes, market's a bit subdued. Obviously, we'll keep an eye on those OFS names as well, but a whole host of other stocks that are moving around in the trading session on the back of news flow as well. What are we watching out for in terms of expiry as well? Let's go across to Vivek to first take us through the list of stocks that are moving around in the trading session. Vivek?
Well, thank you so much for that. Actually seeing quite a bit of volatility in the broader end of the markets. A lot of news flow is something that the street is digesting currently, especially in the PSU names. In terms of individual stocks, can't look beyond idea today. After a while, you're seeing a very sharp up move on this particular name. This on the back of the fact that newspaper reports yesterday indicated that the company may be very close to securing a loan as far as its own operations are concerned. The entire fertilizer pack today, a buzz in trade. Most of the NSE 500 names are fertilizer names doing very well. In fact, up 15% on very good volumes. RCF, Paradip Phosphates, all of these stocks also moving higher in the session. City Union Bank, the other name, especially as far as small private financials are concerned, up almost 3%. And Grow, this particular stock has seen a very sharp intraday recovery in trade. That particular stock high by almost 4%. And again, on very good volumes. On the other hand, quite a few laggards as well. You just mentioned one particular name, Hindustan Copper. Given the fact that there is a steep discount to yesterday's close, this particular stock is low by almost 7%. Remember, 3,000 crore worth of equity is on offer in this particular name. The entire IT pack, an overhang as far as further restrictions, higher costs as far as H1B is concerned, has led to a bit of a downtick across most of the mid-cap IT names, especially Birla stocks down by almost 2.5%, other names down anywhere between 1% to 3%. Data patterns, this particular stock, after a brief upward rally, today down by almost 5% in the session. Archean Chemicals, remember yesterday, this particular stock was in focus on back of higher bromine prices. Saw a bit of an up move, but today has seen quite a bit of profit booking emerge, almost 4% lower. And aluminium stocks, after a brief rally, both Nalco as well as Hindalco today seeing about a profit booking.
Okay, all right. Lot of stocks buzzing around in today's trading session. Vivek, thanks very much for joining in and speaking with us and giving us all of that, all of those stocks. We'll take a short break, but up next we'll connect with Sandeep Agarwal of Sowilo Investment Managers as the IT giant TCS will be acquiring 100% of Porsche's AG's IT consulting subsidiary MHP. That conversation coming up next. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. As of now, the markets obviously have recovered from the day's lowest point, but still below the 24,200 level, which has been the case since the get-go today, and 24,170, 180, around that is what the Nifty is trading at. But IT back today is a bit under pressure. We're seeing Nifty IT seeing cuts of around 0.7%. But the IT giant TCS has made an announcement. They'll be acquiring around 100% of Porsche's AG's IT consulting subsidiary MHP for an enterprise value of around 320 million euros. Both the companies sign a 5-year strategic partnership valued at around 1.25 billion euros. My colleague Rima caught up with the CEO of the company, K. Kirthivasan, about what this means for the company, about MHP's margin levels, growth expectations as well. Listen in.
Somewhere in the range of about 10%. And also, you need to keep in mind, MHP is operating completely at on-site. Now, when we are able to bring in TCS offshore capabilities, so there is a lot of headroom for margin improvement. See, we believe like there could be about 50 to 60 bips margin dilution at the TCS level for the maybe in the short term, and then we will be able to bring in the usual margin improvement measures of TCS and achieve the margin. As I said, we are looking at it more from what we kept from as a transformative initiative, okay, and eventually it will be value adding for both the organizations. I would expect like at least by year-on-year growth of at least double-digit growth from synergy should come in, and so maybe 3 years down the line, like I would definitely challenge the team to make it a $1 billion business.
Okay, well, to discuss more on this, we have Sandeep Agarwal, who's a fund manager at Suvilo Investment Managers, joining in. Sandeep, hi. Thank you very much for taking the time out and speaking with us. Well, for TCS, how transformative do you think this particular acquisition and 5-year deal is going forward in terms of revenue addition, as well as maybe the eventual margin improvement that you expect?
Hey, hi, good afternoon. Thanks for having me on the show. So, a lot of data is still flowing in, and we have also heard what Kirti was saying. And the point I would like to make here is that, what is the alternate use of that money? And I think whatever steps the company is taking, whether earlier it was the AI data center, now this is the acquisition, I think the alternate use of that fund, which ideally would have got them 3.5% post-tax return, is being used to generate much higher return. So I think, the low growth phase for the Indian IT industry has pushed all the Indian IT companies to actually do acquisitions where they can create value. And as rightly said by Kriti, that it is on-site based, and if at on-site they're making 10%, I think it is a great deal, because generally on-site doesn't make even 10%. So if you are doing 10% when you start outsourcing and you start getting the tail revenues, it can easily go to TCS level. So in short term, there could be some dilution, but I think definitely it will be EPS accretive. As I said, that what was the alternate use of that money which was there, and I think versus that, this is a much better use of that money, and it will also help them build capability, get into newer markets. So I think if all the companies, and that is the reason you would have seen that last few months, most of the companies are looking at acquisitions, whether it is Persistent, whether it is Coforge, and everyone are going on the same path.
Absolutely. Sandeep, good afternoon. This is Vinny joining in the conversation. You said newer markets as well, right? So TCS, do you think this will furthermore help them gain further inroads in the automotive market as well? And then does that in turn become actually negative for other players like KPIT Tech? Is that something that one should watch out for?
So, the market is very big. Let me put it that way. So I have never seen that, Indian company has lost a contract to Indian company. It has been very rare, barring 1 or 2 cases where there has been operational challenge or there has been some closure of some program and those programs restarted later with a new vendor. So I would say that, Indian versus Indian competition is like 2-3% cases, not more than that. So I believe that, these all things will actually improve our ecosystem in the markets, and it will help all the companies. So these all companies operate in ecosystem, and I have seen personally that 4 or 5 IT companies are working on same floor in large clients in UK and US on the same floor, in fact. So I don't see there is a challenge for any other company because of this acquisition.
Any more such deals that you expect TCS or other IT companies to sign? For example, getting an anchor client like they have in this case?
So I think, because of the growth which has come down and the pressure which is there from the from everywhere that to use the cash which is lying with these companies. I think most of these companies have now changed their philosophy from earlier distributing the cash in form of dividend or buying back companies, now to use that cash to either do accretive acquisitions or invest in AI data center and all those. So I think there is a complete shift, and they all are trying to get the growth back, which was low post COVID, also due to base effect of COVID. I think it is a very good step, and I believe that small deals will keep on happening in the space, and slowly they will move towards the Accenture model. If you see Accenture acquires so many companies every year, I think most of the Indian companies will also go into that direction, and I think it is a big value upgrade which they are doing. While people may be negative today what Indian companies are doing, and because they want the numbers to show up, and in acquisitions, numbers don't show up immediately. But I am very sure that these companies are gearing up for next 3 to 5 years. And as I mentioned earlier, I am extremely bullish since March on the whole sector, and I continue to be bullish. And we have increased our stake substantially in the IT sector in our PMS also. Okay. So we feel very positive about the sector. We believe that it is right now not seen in right format by the investor because of last 2 years of low growth. But as they start delivering, they will have a positive outlook on the sector.
Okay. Sandeep, just a quick one, 2 points. One, obviously we have NVIDIA's results which are coming out today as well. So what are you keeping an eye out on? Do we expect anything as an impact coming in for Indian IT companies? Second point, H1B visa risks seem like it's coming back, right? Some bit of an increase. As of now, it's open for comments. Though, IT companies have reduced that H1B visa dependence. But are you worried about that?
So, on NVIDIA, if you let me tell you this, the numbers will be good because, there is still a lot of demand for the GPUs. It is not going down. And they have invested a lot of money and they have done a lot of tie-ups. So I don't see anything negative there. But let me put it this way that, last 1 year, if you see NVIDIA has massively underperformed by almost 200%, not basis point, AMD. So, I think the charm of that stock probably has reduced versus what it was 2 years back or 18 months back. And I believe that, now people will take more balanced view. And I don't think IT services will be sold like that. I was listening to one of the foundational players interview 2 days back, and he was clearly saying that he overestimated the impact of AI and he overestimated he was very optimistic on the timelines it will get adopted. Versus that, there is some disappointment. So I think, AI will coexist, IT services will coexist, and enterprise AI will pick up. And second question, which I think you asked, I forgot. Sorry. Can you repeat the second one?
The other one I was asking on H1B visa.
See, already President Trump 2 years back has already said that it will be $1 lakh, and then it was turned down by a district court in US as not being passed by Congress. So I don't think, and also as you rightly said, the dependence is very low. Even in worst case scenario, it plays out, I think will be 1%, 1.5% impact for the whole Indian IT sector, which is very minuscule, and I don't think they will not be able to pass on to the client. I can say you this, that let open enterprise AI start opening up, which is happening now. You will see big relief in the whole sector in next few months.
Okay, all right. Well, it sounds like you're recommending the IT space at this point in time, Sandeep. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's the view coming in on the entire IT space. Well, we need to take a short break on that note, but we'll go full tilt on the markets. Jay Thakkar of ICICI Securities will join in. He's going to give us some trading ideas for today's session. Stay tuned. Welcome back. Well, for the markets, like we've been pointing out, 24,166 is currently where the Nifty is at. So it's just recovered above those levels of around 24,150, but nonetheless still subdued. So down around 52 odd points currently for the Nifty, along with the Midcap index, which is down around 0.2%. For the advanced decline ratio, it has been weak. So around 1,800 stocks advancing to around 2,300 stocks declining on the Bombay Stock Exchange. So it is in favor of the losing category of stocks. But a couple of stocks which stand out from the broader markets includes Vodafone Idea. So do watch out for that counter. In fact, it's up around 7.5% at this point in time. Huge volumes traded on Vodafone Idea at this point. In fact, that stock has rallied around 40% on a year-to-date basis. So great going for that one. So that stock is up and about in today's trading session. A couple of others include something like a SAIL, which is up around 3.5% odd. Godrej Agrovet, which is up another 5 odd percent at this point, and we have Grow, which is up around 4 odd percent at this point as well. So all of these stocks managing to buck the trend. But we do have Jay Thakkar of ICICI Securities joining in to discuss what he's strategizing today. Jay, hi, welcome to the show. Well, what is your call today? Because there are a lot of broader market stocks which are managing to hold their head above the water. So what is your Nifty call as well as stock specific?
Good afternoon to you, Ekta. Ekta, you are absolutely correct. I mean, since past couple of trading days or, in fact, trading weeks, we have seen that the broader markets, in fact, performing quite well, wherein the Nifty small cap and mid cap index have really outperformed Nifty or the Bank Nifty. You can see the frontline indices, and hence you see the sectors like Nifty Realty, Nifty Defense, capital markets. These are the names or sectors wherein you have seen the stocks performing quite well as against, the frontline stocks like the banking or maybe the IT or maybe something from the oil and gas. But from here on, what I think, Ekta, that it's been like the fourth or fifth expiry wherein we have seen Nifty closing around the levels of 24,100 range, which is around 0.5 to 0.6% kind of expiry to expiry closing. And based on the past data, we have seen that after 4 to 5 series, once this has happened, there is a very higher chance of at least 2 to 3% directional move. Right. So I think that for the September series, you're going to get that 2 to 3% kind of directional move with the probability of almost 70 to 80%. And when that is likely to happen, I think with a stop loss of 24,000, which is the critical support level for the Nifty, and 57,000 critical support for the Bank Nifty, till these levels are held at least, the probability of an upside breakout or Nifty moving and Bank Nifty moving higher is quite high. So I think the risk load is favorable on the long side until these critical range are held. So my buy recommendation would be on Nifty and Bank Nifty from these levels for a target of 24,600 and 59,000 respectively. And because of which I have 3 buy recommendation. I am now quite bullish on the Bank Nifty relatively, on the private sector banks. As they are outperforming. So Kotak Bank trading around the levels of 401. One can buy this with a stop loss of 394, keeping a target of 415. EU Small Finance Bank, I mean, that's trading around the levels of 1136. One can buy this with a stop loss of 1120, targeting 1170 on the upside. And the third buy recommendation would be on Bharat Dynamics, because defense as a sector, as I said, have been performing quite well. So BDL one can buy targeting around 1450. That's the target. And on the downside, one can place a stop loss below 1350. So these are the 3 recommendations on the long side.
Okay, Jay, thank you so much for joining in this afternoon, talking to us about the levels in terms of markets as well as individual stock names. On that note, we're going to step into a very short break. After the break, we'll have a commodity conversation. Manisha Gupta will take us through a conversation with Mr. Sinha of Indian Association for Gold Excellence and Standards to decode what's driving gold prices.
Welcome back, and joining us on the show now is Kaushalendra Sinha. He is CEO at India Association for Gold. It's IGS. Mr. Sinha, hi, thank you so much for joining in. First thing really is about the gold prices, and we've seen such a strong month for the month of August. And as we head into festivals, are you looking at an impact of these volatile, higher prices on footfalls already?
Hello and good afternoon, Manisha. Thank you for having me on your show. Yes, of course, the prices which were kind of stable have started moving up, and this is also creating excitement at the retail level. It has dampened over a period of time. It was stagnant, and now what we see in the month of August is started moving up and moving up quite rapidly. This is also linked to a lot of things that we are seeing globally, especially in the US. But we expect things to continue, and as we head towards the festival, we expect the demand to continue to go up. And of course, the Indian demand and linked to what is happening globally, we see the gold prices firming up and also moving up marginally from these levels.
Mr. Sinha, when it comes to buying, well, metros clearly always take lead, but we've also seen stronger numbers coming in from tier 2, tier 3 cities as well. Would you say that much of jewelry as a segment, as a trade, seems to be moving towards being organized there as well?
Absolutely. This is a trend that we have been seeing for a period of time. It's surely metros have been an important driver of jewelry sales, but the tier 1, tier 2, tier 3 small towns, there is an increasing consumption out there. And of course, as we head to the marriage season, towards the end of the year, you will see the pickup much higher. So yes, jewelry sales is not something which is limited to. Of course, when we are talking about the consumer the landscape is evolving. But yes, if you look at segregating it between the metro and the further tier of cities in India, the lower tier cities are, of course, are getting much better traction. And we are also finding that the organized retail has started reaching out to those cities, which is also driving a much higher consumer confidence in the business.
The other area that the street really seems to be looking at stronger numbers is digital gold apps. I mean, an area which is not as per se regulated, but as an association, how are you looking into this?
So absolutely. So digital gold, of course, is an important way that the consumers are looking at buying gold. And of course, there has been some comments, adverse comments which had come from the regulators and the government recently, but we haven't seen that impacting the offtake as such. So that's an important way to look at it. As a self-regulatory organization, as IAGS, we are also in our services, we are also covering the digital gold players, and we have done a few accreditation in that space. And we try and ensure that, the concern where the consumer will have, whether, we always believe that if the consumer is buying gold either on screen or is buying in a shop, the rigor and the discipline and the comfort that the consumer should have in terms of holding the gold should be same. So when we are doing the accreditations, we ensure that the seller is maintaining the same kind of stocks and inventory, and we try and match that when we are giving our accreditations. However, this remains a space where we are expecting regulations to come in, and this is a space which will continue to evolve. Of course, the past few months have shown in the indication that the consumer prefers to buy gold over digital platforms, and that's a trend which has started. We expect this to continue.
All right, Manisha, thanks very much for that. We'll take a short break. On that note, we'll get you a lot more in terms of markets on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. While the Nifty is a bit muted in today's trading session, 24,150 now is where the Nifty is trading at. But there's a stock particularly that's moving around in the trading session. Strong gains today. Nifty 500 top gainer there, and that is fact. In fact, what's happened here is the loss-making fact has now overtaken Coromandel by market cap. Let's go across to Nigel, who's here to decode all of that, what's driving the stock as well. Nigel, afternoon.
Well, here's an interesting market anomaly. Loss-making fact has now overtaken Coromandel International in terms of market capitalization. That's right. But just look beyond the market cap and the difference in fundamentals is stark. While Coromandel delivered a net profit of close to around 2,000 crores in the past fiscal, Fact reported a marginal loss in FY26. In fact, if you look at Fact's financial performance over the last few years, it hasn't exactly stood out actually. Margins, they have remained in single digits, just marginally delivering a positive number in the last fiscal itself, while profitability has been on a declining trend. So what explains the sharp move on the stock price? Well, one key factor could be the very limited free float. The Government of India owns around 90% of Fact, while the Special National Investment Fund holds another 8.5% stake. That effectively means that the free float is less than 1.5%. So Fact may have overtaken Coromandel on market capitalization, but the gap in profitability and fundamentals remains significant.
Okay, all right, Nigel, thanks very much for that. Well, on that note, we need to take a break with the news that the Nifty is down around 0.3% at this point. The Bank Nifty down around 0.2%. A couple of stocks which are managing to hold up within the Nifty space include a couple of stocks such as the Adani counters, Adani Enterprises and Adani Ports are managing to hold up with gains. We'll take a short break, but up next, a lot more in terms of stocks. Stay tuned. Indian business delegation's visit to Japan along with Commerce Minister Piyush Goyal is underway. Our colleague Abhimanyu spoke to Nippon Life Asset Management's Sandeep Sikka on the positive backdrop of the Indian market and the potential risks seen there. Listen in and we'll be back with Business Lunch.
I think clearly, if you look at the data, I think last month we have seen almost $2 billion of foreign money, FI money coming back after a backdrop of $20 billion going out. Clearly, a lot of things are looking better. The quarterly results have been good. The crude is stabilizing. The forex have been the FCNR, which what we have seen. So things seem to be getting better, and also the valuation is much more attractive compared to what it was way back in 24. Clearly, I think what we are seeing, this has to be done technology. We have to invest in technology, but one thing that we have to be careful is, I hope the investments are not more than, the returns that will get in times to come. But this is, again, we need to wait and see, but you can't ignore it. So I think, I won't use the word, we need to be worried about AI bubble, but we need to be cautious of it, how much we are investing so that there are economic gains.
Stocks trade soft after U.S. Treasury Secretary Scott Bessent unveils Operation Economic Outcast against Iran and backs bigger bond buybacks to rein in yields. Insurance and healthcare eke out gains while IT and metals drag. TCS inks a deal with Porsche to buy its consulting arm MHP for £320 million and secures a $1.25 billion pound 5-year contract for AI transformation. TCS CEO K. Krithivasan expects to scale MHP revenues to $1 billion following the deal. The government is looking to sell up to 6% stake in Hindustan Copper to mop up near 3,000 crore rupees. This marks the first divestment move after the Q1 earnings season. DPAM Secretary tells CNBC TV 18 the offer timing is opportune for investors. Rising US debt and a knee-jerk bond buyback plan revive the dollar debasement trade, sending gold prices surging past $4,650 per ounce mark. Strong central bank buying and the US-Iran standoff only fuel the frenzy. India's Unified Payments Interface, or UPI, turns 10. Since it was piloted in April 2016, the payment system has scaled to over 24,000 crore transactions and more than 300 lakh crore rupees in transaction value in FY26. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I am Arundhati Ramnin. Good afternoon, guys. The market's all in the red today, feeling some pressure there. The Nifty around that 24,130 mark, coming off some of those gains that it had clocked. We've got the Midcap index that's falling less than the blue chips, but also 0.1% in the red. We've got the Nifty Bank also falling in line with the blue chips, about 0.3% lower. If you take a look at the advanced decline ratio, we've got 1,900 stocks declining for 1,345 stocks that are advancing. So that's how the key indices are looking this afternoon. But if you take a look at the sectors, IT is the top loser. That index is down nearly 1%, about 0.8% in the red. We've got HCL Tech, Tech Mahindra and Persistent seeing cuts of over 1% in trade. As we speak, HCL Tech nearly 2% lower. Those energy stocks not doing well. Coal India down over 1%, G Vernova down 1.5%, Hitachi Energy also down over 2% in trade. What's doing well? There's very little green on the screen, but we've got those PSU banks that are helping cap those losses 0.2% higher. We've got Bank of Maharashtra, Indian Bank and PNB, all of them up between 0.3 to 1% in trade. Pharma names also managing to clock some gains. It's come off. It's about 0.1% in the green now. Come off those highs of 0.5% that we saw earlier in the day. Laurus Labs over 2% higher. Divi's Labs 1.2% higher, and Biocon 1.2% higher in trade as well. So that's how the sectors are performing this afternoon. But first up on the show, the government has launched an offer for sale in Hindustan Copper to sell up to 6% stake and raise around 3,000 crore rupees. The floor price for the offer is set at 514 rupees a share. Earlier, we spoke to Divestment Secretary Arunish Chawla to learn more about the OFS and also asked him about the government's planned stake sales. Take a look.
Hindustan Copper OFS has been announced, 6%, which is 3% base and 3% green shoe. Total 5.8 crore shares are on the table today for the investors. The timing is optimal as the commodity prices are now picking up, the metal prices are picking up, and the OFS has been designed in a way that it also leaves some room for a decent room for the investors to make money and gain profits and make money from it. And the forecasts are good. The future is even better. Team Deepam has worked very hard. We are confident of meeting our targets, and we are confident of meeting our obligations to small investors. As you know, we had a large sale offer, which is the largest sale offer on our markets ever. 31,500 crores is what investors invested, and they have not regretted it. They have already gained 10% on what they invested. And with this, we have reduced government stake in LIC to 90%, almost 1 year ahead of the deadline, which means there will be a pause and a sufficient opportunity for investors to gain from their investment.
IIFL Finance subsidiary IIFL Home Finance is on the Income Tax Department's scanner, receiving a tax demand worth 963 crore rupees. The management earlier today also spoke to CNBC TV 18 and said that they would be appealing the order. Take a look.
We will evaluate all the possible options of going to appellate authority, filing a rectification and stay of demand. So it depends on what the authority will instruct us. But largely, they go for around payment of 20% of tax demand or maybe lesser than that. We are in continuous touch with our tax advisor and the legal counsel. And all this demand, we feel that will get deleted at the first appellate authority level, and everybody understand and appreciate this point of view. Okay. So we don't think so it will have any impact on that.
The IT sector is under pressure today in yet another headwind for the sector. The United States Department of Homeland Security has proposed a $103,000 fee for H-1B visas. The proposal is currently open to public comments for a period of 1 month before it comes into effect. The proposed fee will only be applicable to new visas. Universities, non-profit organizations, research organizations, and existing visa holders will be exempt from the fee. Indians will be the largest impacted group as they form the highest share of applications. Corporate hiring strategies may also need to be reworked as companies are uncertain over how policy will pan out over the coming years. And moving on, India's GDP growth in the April to June quarter will be next week on August 31st, and a CNBC TV 18 poll sees it coming at 7.5%. Nominal GDP, which has been low for the past 3 years, is seen jumping up to a 3-year high of 13.9%. Lata Venkatesh is here to decode those numbers for us. Lata, what can we expect?
Well, our poll says that Q1 GDP will be 7.5%. Good number, you know. We were battling a war, West Asia war. And there were worries about El Nino. So 7.5 is very good. It compares with 6.8, so a slightly low base year ago. And of course, quarter ago was 7.8. And I also want to point out that at the moment, the Reserve Bank is sitting at 7%. So 7.5 is a sizable jump that the street expects over what Reserve Bank has forecast. And Reserve Bank was 6.6 2 months ago. So it's a very, very good number. Let's look at the GVA number, the gross value added number. That is expected to come even better than the GDP at 7.6% compared to 7.1 year ago. Why is it more? See, the formula for GVA is you get the GDP, you subtract taxes and add subsidies. This time you didn't have to subtract much taxes because taxes were cut. The excise duty on crude and petrol and diesel was cut very sharply. Likewise, subsidies increased because, the price of urea went up. So, because of the combination of this, GVA is likely to be a few basis points higher than the GDP growth. But the GDP may even be better than 7.5 if you go by what SBI is forecasting. It's forecasting an 8% growth. And if that is correct, then this will be the 4th consecutive quarter of near 8% growth. The poll also sees the nominal GDP very high at 13.9% compared to just 8.6 year ago. Now, the nominal GDP is important because that is the number we actually, when nominal GDP goes up, EPS, profits of companies go up, taxes go up. That is the number which is in actual use, it's current prices. Also, fiscal deficit as a percentage of GDP that you calculate is nominal GDP. So nominal GDP coming in a good 13.9% higher is good news for several constituencies. And like we said, at 13.9%, if it does come as high as that, again, SBI is looking at 14% also, then the nominal GDP would be the fastest in 10 quarters. Nominal GDP is counts growth in goods and services at current prices. That's the definition of nominal GDP. It doesn't adjust for prices. Now let's come to the full year. The poll says that the full year GDP is likely to come at 6.9% compared to 7.7 last year. But as Citi's economist points out, if the first quarter comes at 8%, then everybody's full year analysis will go up by about 20-30 basis points. So while they are now saying 6.9, chances are it is going to be a 7% plus GDP growth this year as well.
All right, Lata, many thanks for taking us through what we can expect from those numbers that are set to come out next week. Now, a decade ago, UPI set out to transform how India pays, and it has done just that. But 10 years on, the ecosystem remains heavily concentrated, with a handful of players commanding the lion's share. Here's a look at how India's UPI story has evolved. Ritu Singh is here with all of those details. Ritu, it's been quite the story for UPI in India over the last 10 years.
Well, UPI has gone from a payment experiment to one of the world's largest digital payment networks in just a decade. And as UPI turns 10, the best way to understand this transformation is to look at the growth curve. Now, transaction volumes have grown from just 1.8 crore rupees in 1.8 crores in volume terms in FY17 to more than 24,000 crores in FY26. That's nearly a 13,000-fold increase. And the value of transactions has gone from virtually zero to more than 314 lakh crore rupees annually, which puts this decade-long compounded growth rate at a staggering 188% in volume terms and 155% in value terms. Now, growth rates, of course, have slowed down as the base has exploded. So volume growth has come down from 106% in FY22 to about 30% in FY26, and the value growth has similarly eased in line. But look at the absolute scale. UPI processed nearly 2,366 crore transactions in a single month in July that was worth about 30 lakh crore rupees. That translates to roughly 76 crore transactions every day on UPI. So the scale is undeniably enormous. Now, here's an interesting split. Merchant payments make up about 63% of UPI's volume, but person-to-person payments still make up nearly 70% of the value. So in other words, UPI runs on two engines. Merchant payments give it frequency and person-to-person payments give it size. Now let's get you an even clearer picture on the scale of UPI. It now makes up 84% of all the digital payments in India. Globally, it accounts for nearly half of all the real-time payment volumes, and now it is live in 11 countries, from the UAE and France to Greece and Cambodia. But despite that massive scale, the UPI app market remains highly concentrated. The top two players, PhonePe and Google Pay, together command nearly 80% of all UPI transaction volumes. And that's precisely why NPCI has been pushing for a 30% market cap for individual third-party UPI apps to address that concentration risk. But the cap is yet to be enforced, and the compliance deadline has been pushed to the end of this year. So think of UPI story in three acts to sum up. Act 1 was adoption, Act 2 was scale, and now we're entering Act 3, which is sustainability, and that's where the merchant discount rate or the MDR fee debate comes into the picture, with the government opening the door to potentially charging select merchant transactions in the future. Because how do you make a network this big economically viable as well? That could be the defining question for UPI's next decade.
All right, Ritu, many thanks for taking us through those details. Now, on that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. On to the latest updates from West Asia. U.S. Treasury Secretary Scott Bessent announces that Washington is enacting fresh sanctions against Tehran to sever all financial support for the regime. Let's listen in to some of his comments.
Iran now faces a very clear choice with only two paths before them: complete global isolation and a subsistence economy, or a path back to normalcy with an opportunity to rejoin the global economy. Today, we are launching Operation Economic Outcast to foreclose every other option available to the Iranian regime. Beginning today, the actions of Treasury and other agencies will tighten the noose and block every potential source of revenue that funds the IRGC and the evil Iranian regime. We are enforcing a zero leakage approach. There will be no minimal breathing space for the regime to rebuild its capacity to inflict terror against America and the world.
CNBC's Dan Murphy joins us now with all of the latest updates. Dan?
While the Treasury is now threatening to sanction dozens of Iranian-linked targets, the broader threat against some major trading partners has not yet been fully implemented. So this announcement overnight, I guess you could say, was kind of long on intent, but short on detail, at least for now. Washington is going to give individual countries some timelines to end activities identified by the US, with Bessent also warning overnight that the clock has just started ticking. But you really do get the sense that we need more information on exactly how this new economic pressure campaign is going to unfold. Now, what's also interesting is that Iran has dismissed this threat almost immediately. The parliamentary speaker, Mohammad Ghalibaf, saying overnight, Americans know that no one buys their bombast, and the United States is not in an economic position to further restrict its relations with other countries. Of course, we've also heard from Iran's economy minister just a short time ago. He also weighed in. Take a listen.
Naturally, they want to carry out an economic terrorist attack against us. We have our own tools as well. We know how to play the game too. This time, they should no longer think that we will remain on the defensive and only defend ourselves. They should also expect an attack from our side. As I said, the unipolar world is over. As you saw, two of the world's major countries did not accept these new sanctions and this new plan and refused to go along with them. We are almost certain that many other countries, either officially or unofficially, will not accept them either, and God willing, they will fail.
The Treasury Secretary overnight was quick to single out countries like the UAE, for example, which have already moved in line with the US position and cut off their trade and economic ties to the regime. But you also really get the sense now that China is going to be the critical test. Beijing has rejected unilateral US sanctions in the past, and while the Treasury Secretary also insists that Chinese banks and companies will not be exempt, we have also heard from China's foreign ministry saying it is going to be business as usual on the ground. So the question now is really whether Washington is going to enforce these threats against major economic partners, whether the president has the political capital to do so ahead of the midterm elections and ahead of what is a very highly anticipated meeting with President Xi as well. And at a broader level at the moment too, the question now is whether more of this financial pressure can actually produce the kind of breakthrough that the administration wants, the kind of breakthrough diplomatically that nearly 6 months of war has not. So we're watching and waiting to see exactly how this unfolds and, of course, how the Iranians respond as well.
So Dan there with the latest from West Asia. But on that note, it is time for us to take another short break. But we'll get you all of the updates from Piyush Goyal's visit to Japan on the other side. Stay tuned. Welcome back. You're still watching Business Lunch on CNBC TV 18. Commerce Minister Piyush Goyal is in Japan, leading India's largest ever business delegation, eyeing key investments and strengthening ties between the countries. Let's go across to Abhimanyu Sharma to get us more details from the day 2 of the minister's tour. Abhimanyu?
It's the second day of India's Commerce and Industry Minister Piyush Goyal's official visit to Japan. He has already met several members of the Japanese industry. He also met several Japanese leaders till now, and in course of the day he is slated to meet more Japanese companies and their representatives, including Mitsui & Company, Mitsui O.S.K. Lines, JFE Steel Corporation, Nippon Steel Corporation, Toshiba Corporation and Toyo Engineering Corporation. Now, till now, India has been stressing on joint manufacturing initiatives, joint R&D initiatives with Japan to add more value and also to decrease cost of overall manufacturing. In course of the day, the minister is likely to meet several representatives from the Japanese industry and the leadership, and is also likely to take feedback from the Indian industry. Now, the trade deal between India and Japan is likely to be reviewed, and Indian industry meanwhile has sought recognition of Indian certification for exports of pharmaceuticals, as well as common grounds of certification and quality assurance, even as India's widening trade deficit with Japan has already been flagged as a concern by the Indian government. Now, the minister had stressed on the need to scale up Indian manufacturing, improve quality standards and increase export from India to Japan as part of increased synergy between both the sides. FICCI's president, meanwhile, has indicated the need to focus on training of Indian MSMEs by Japanese companies, the need for partnerships on critical minerals, while he also pointed to a joint focus on Africa to increase overall manufacturing and exports.
So, Abhimanyu there bring us all the details from Japan. But with that, it is a wrap on this edition of Business Lunch. Midcap Radar will take all the market action forward. Stay tuned.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vivek Iyer. Continues to be a very volatile market. We did see a recovery, but that has been sold into. Nifty is very close to the day's low, just at that 24,131 mark. Hey, Vivek.
Good afternoon, Sonal. Absolutely right. Very, very volatile, very muted is what we are seeing, especially as far as markets are concerned. The Nifty Bank continues to trend lower. But on this show, we have an important corporate conversation. We'll also analyze the telecom sector in depth. So let's start off immediately with the top headlines. Market continues to trade lower, with the Nifty trading near the day's lowest point. Auto, IT and chemicals trade with cuts. Pharma and PSU banks see marginal outperformance.
The government is looking to sell up to 6% stake in Hindustan Copper to mop up near 3,000 crore rupees. This marks the first divestment move after the Q1 earnings season. Deepam Secretary tells CNBC TV 18 the offer timing is opportune for investors.
Federal Bank slips in trade after sources tell CNBC TV 18 that the bank is looking to acquire a controlling stake in Jana Small Finance Bank. The Jana promoter family is likely to sell its entire 16.9% stake.
Rashi Peripheral slips more than 15% in trade after independent director resigns, flags concerns over governance and diligence. Okay, all right, those are the top headlines that we are tracking. It's the Bank Nifty which is putting a lot of pressure on the Nifty as we speak. Midcaps though outperforming by a wee bit, but the advance decline ratio continues to be in favor of declines.
Well, absolutely right. A lot moving in the markets. Listings, the primary market action continues to remain quite strong. Subscription, especially in some of the new listings, has been quite strong. But right now, we'll be focusing on the entire mid-cap space. We are standing by the big wall with all the top movers and shakers in the broad end of the markets. Ria, over to you.
Well, yeah, starting off with the gainers first, we have FACT, which is fertilizers and chemicals, Travancore trading with gains of nearly 18% today, and on the back of extremely strong volumes as well, nearly 180 times the monthly average volumes traded on this counter just today. There's also Paradeep Phosphates seeing a big gain in today's trading session, up nearly 4%. This one also trading on strong volumes, nearly 13 times the monthly average volumes traded today. There's also AWL Agri, Allied Blenders, as well as Grow. All three of these stocks seeing gains anywhere between 3 to 5% in today's trading session. And on the flip side, looking at some of the losers today, there's Data Patterns, one of the defense names which is seeing cuts today, but this stock has risen over 70% on a year-to-date basis. Even Netweb Technologies and Phenolics Cables, both of these stocks up anywhere between 60 to 70% on a year-to-date basis, but today seeing some profit booking. LT Foods has nearly reversed all of the gains, the 7% gain that it saw yesterday, and trading with cuts of nearly 3 to 4% today. And Minda Corp also seeing a cut of nearly 2.5% in today's trading session. And also looking at some of the sugar stocks which are seeing some cuts today, we have the likes of DCM, Shriram, Triveni Engineering, Renuka Sugar, Balrampur Chini Mills, as well as EID Parry. All of these seeing cuts of anywhere between 2 to 4% today.
Okay, all right. Thank you so much for joining us with those names, Ria. In fact, we'll do one thing. We'll slip into a short break now. When we come back, we'll get you more on the markets, talk about some stock-specific action. Stay tuned for that.
Welcome back to Midcap Radar. Well, one particular stock in focus, on the back of an announcement that it has made via its subsidiary is Nitco Tiles. The stock is gaining after its subsidiary signed an agreement with the house of Abhinandan Lodha to develop a land parcel in Alibag. We are now joined by Abhinandan Lodha himself, who is the counterparty to this particular transaction. He joins us now. Good afternoon, Mr. Lodha, and thank you so much for joining us. Well, first up, give us a sense of what exactly is this particular transaction. What is your role in this transaction? What is Nitco's role in the transaction? We understand that the gross development value is quite attractive, but what is it that you aim to accrue over the next couple of years?
Good afternoon, Vivek. So this is the second development by the House of Abhinandan Lodha in Alibag. We're just finishing delivery of our first development, which is a 20-acre plus parcel. And this development is spread over 40 acres. It's expected to generate a top line in excess of 4,500 crores for the House of Abhinandan Lodha. We expect to get approvals in 12 to 15 months' time and a 5-year development cycle after that. It's going to be a multi-phase development, including townhouses, bungalows, residential apartments, and a hotel.
Okay. Mr. Lodha, I wanted to understand some of the capital commitments that you'll be making as well. Since it's a JDA, the overall revenue potential is 4,500 crore rupees. What is the kind of investment that House of Abhinandan Lodha is making versus what Nitco is making? Is it an equal JV here? Because you will be getting a major chunk of the gross development value. Wanted to understand the capital split as well.
It's a 30-70 JV. 70% of top line belongs to the House of Abhinandan Lodha. Remaining belongs to Nitco Tiles. The initial investment from our side will be in excess of 1,000 crore rupees over the next few years. And post that, the development should take off on its own.
How much is coming in from Nitco initially? Is it 30% of what is the total capex? Is what I just want to understand.
The total capex is close to 2,500 crores. Nitco is going to be contributing the land, and we will be bringing in the capital to make the development possible.
What happens once there is development there? Does Nitco lose out every right on that property? What happens after the development is done?
So post the development getting completed, it will be moved the way normal all development moves. The whole conveyance will take place in the name of the company which takes it over, and then it will be handed over to the society which will run it. That's in our mind 6 to 7 years away from where we are. Before that, the entire monetization of the land will be finished, and Nitco should receive the revenues it's supposed to have received by that point of time.
Understood. Mr. Lodha, the other thing which we want to ask you is what we understand as far as what House of Abhinandan Lodha does is typically develop land parcels. Does this now mean that you also are entering into building of the property and developing the land parcel? Because so far, we largely understand you are looking at land itself as the final output.
That was the first phase of our growth, Vivek. We've evolved substantially since then. We are already doing a number of developments in the city of Mumbai. And even at the outskirts of Mumbai now, most of our townships have a residential and a villa component as part of what we offer. It also applies to our existing development in Alibag, where we are doing a number of villa development and monetize the value of the land as an underlying asset. And residential development and township development both will become part of our story as we move forward. In fact, we are just at the outskirts of launching our first villa-only development in the city of Mashobra, Himachal Pradesh, which is going to have an excess of 103 developed villas. So yeah, the House of Abhinandan Lodha is today doing much more than just developing land, which it was doing, say, a couple of years ago.
And any plans to list in the future? Are you working on that?
Always plans to list in the future, but nothing concrete at this point of time.
Mr. Lodha, the line is very patchy, so I would like to quickly get this out of the way. So the entire capital commitment will be done by House of Abhinandan Lodha, 1,000 crore rupees right now, and 6 to 7 years down the line is when the project comes on stream. So what is the capital investment plan over years? 1,000 crore rupees right now, what would the payment plan look like going forward?
So I think we'll be investing this capital over the next 3 years' time. So there'll probably be 15% in the first year, 25% in the second year, and remaining in the third year. Post which the development should take off on its own. The entire development cycle we believe will be close to 7 years. But post the first 3 years, we expect the development to then take a life of its own and not require any further capital investment.
Okay, thank you so much, Mr. Lodha, for joining us, and wish you all the best for this particular upcoming joint development that you have with Nitco. Thank you once again. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned in Midcap Radar. A lot of moving parts in the broader markets. Rashi Peripherals is one of them. Quite a bit of pressure on that stock as of now. Vinny's joining us to tell us what's ailing the stock as we speak. Vinny?
Hi. So yes, absolutely. Today where we're seeing this fall coming in for Rashi Peripherals, actually its independent director, Anil Khandelwal, has tendered his resignation, which is on 24th of August 2026. Now, independent director, but why is the stock falling? Because he stated some of the reasons, that have come in and why he is stepped down from this position. One, he said that, the director selection process as well as the key managerial process, which the pay is decided for these directors by the management, was rather done through an independent committee. So that process of that payment was something that there's a concern that he's finding on the governance front. Then he's raised a concern and he said that he's written this orally as well as in writing as well, several times, relevant times as well, with no actually improvement that he's seen on this front as well. Furthermore, the second important point that he highlighted was that in terms of acquisition of due diligence work went to firms which were related to two independent directors. So that is a concern, and two senior partners where these independent directors were senior partners. So more like a related party transaction is what he's calling. And he said that this was actually something that was not placed in front of the board. The approval has come in from these directors itself. So that is why he's finding a bit of a lapse coming in on this front. What is the company's position on this? The company is saying that this was the requisal by independent directors was not legally required, is what the company is saying. But these are some of the key points that he highlighted, and which is the reason why we're seeing such a sharp fall coming in the stocks. Obviously, we'll wait out for more details on this one right now, but this is why the stock is down 15%.
Well, thank you so much, Vinny, for joining us and putting the spotlight on Rashi Peripherals. That particular stock down over 15%. A mild recovery in trade, but despite that, corporate governance concern is something that the street hasn't liked. But moving on, a Business Standard report says that SBI has agreed to sanction a portion of rupees 35,000 crore consortium loan for Vodafone Idea, which it will use for network expansion. To discuss more on this, we are joined by Piyush Pandey, Senior Vice President at Centrum India. Good afternoon, Piyush, and thank you so much for joining us. Well, after a long time of will they, won't they, it finally appears as though Vodafone Idea has managed to get a loan as far as its network expansion plans is concerned. Is this because of the operational improvement it saw in Q1 FY27 and also the confidence capital coming in from the promoter group family itself, and your view on Idea going forward?
See, of course, the performance of Vodafone Idea has improved over the last few quarters. So they have started adding customers, plus ARPU has improved sequentially over the last several quarters. And they have added, like, say, 4G customers, postpaid customers, along with very stable operating margin profile. Only concern was like when this fundraise was going to complete. Now we are hearing that one of the bank has sort of agreed, but not yet confirmed. But I would say that, see, Vodafone Idea, the only concern was like its 4G coverage was just 86% compared to, say, 90% plus for Bharti and Jio. And once this fundraise program gets completed, I think it will be very helpful for Vodafone to expand its 4G, 5G network and compete effectively against Jio and Bharti Airtel.
Okay, all right. So this fundraise, of course, we've always been talking about how important that is for Vodafone Idea. Piyush, they're looking at raising 45,000 crore rupees. Do you think a bank fundraise is necessary condition for an equity fundraise? Is it largely going to be on this spectrum expansion, 4G, 5G that you've been talking about?
See, the management has confirmed that they plan to do capex of 45k crores over the next 3 years. And their current cash EBITDA is just roughly close to 10,000 crore per year. So I would say apart from current operating cash flows, they would need external support of around 35 to 40,000 crores. And if this bank funding, I would say, realize, it will be extremely helpful for them to say expand their 4G and 5G in their focus circles, which is a 17.
Necessary to get this bank funding. It is necessary for them to get this bank funding in order to ensure that equity funding is easier. Is it a fair way to, the right way to put it?
Yeah, I would say the current aim is to raise funds from the banks. So they have said that they are not looking to raise any equity funds. So whatever the amount they have raised from Aditya Birla Promoter Group and say Vodafone PLC, now the aim is to get external bank funding. And what they have said is they are more or less comfortable, and in the near term they wouldn't need to raise any fresh equity funds.
Okay. So, assuming that we now have the bank funding in place, what does this mean for the prospects of Indus Tower? This has been an overhang on the stock. They've also gone ahead and actually paid or stopped their dividend payout. Even the buyback plans is something that the street was looking forward to. So now all of those plans are back in place. What's your view on Indus Tower?
See, I would say the better way to play this bank funding can be through Indus Towers. Because for Indus Towers, what we are hearing is that, like say, Vodafone Capex can be a big way to drive growth in terms of towers and co-locations for Indus Towers. And plus, receivables from Vodafone has significantly come down. So broadly, and plus Indus Tower trades at price, say, EV of around 6 times on FY28. So very reasonable valuations. And plus, you have this growth trigger from Vodafone Idea, and plus, they have started paying dividends and foraying into Africa. So I would say Indus can be a good way to play. And Vodafone Idea, the current valuation looks expensive. So it is trading at EV of almost 13 times on FY28. So sort of bit distressed here.
Okay, Piyush, last question before we let you go. Do you think broader price hikes are coming post-Jio IPO? What's the general sense on tariffs?
See, we are expecting tariff hike of close to around, say, 12% over the next 4 to 6 months. And see, generally tariff hike happens after every, say, 2 to 2.5 years. And the last one took place in July 24. So probably we are near a broad-based tariff hike. It might happen, say, around, say, November or December.
Okay. Piyush, what is your pecking order as far as the telecom space is concerned? Which is your top pick and which is the stock that you will avoid at this point of time?
See, our top picks are like, say, we prefer Bharti Airtel and Indus Tower. So Indus Tower is sort of like a pick on, say, reviving the performance of Vodafone Idea, and Bharti remains a preferred telecom pick. And I would say there are very less number of listed stocks on telecom. So not much to say which to avoid here.
Okay, thank you so much, Piyush, for joining us and putting the spotlight as far as the telecom space is concerned. Some positive news flow as far as Vodafone India and its funding requirement is concerned. Well, in the last 25 minutes of the session, what we've seen is quite a sharp recovery as far as the broader end of the markets are concerned. In fact, if you look at the Nifty Midcap index, that particular index has almost moved to the high point of the day, moved into the green territory, and this is being led by a whole host of stocks. Some of the capital goods names like L&T, Siemens, Cummins, all of these stocks, in fact, have recovered quite sharply. Some of the other stocks doing quite well in the session today is Laurus Labs, that particular stock clearly standing out with a 3.5% uptick. And TCS, post the large order win as well as the acquisition that it has announced, did see quite a bit of a dip, but that stock too has now come back and nearing the flat line. Along with that, select real estate stocks, select names like InfoEdge. These stocks, under quite a bit of pressure. InfoEdge, in fact, has slipped quite sharply to the lowest point of the trading session. Hospital stocks, on the other hand, after many weeks of consolidation and seeing down move, today have seen a bit of a pickup. So names like Apollo Hospital, Max Healthcare, Fortis Healthcare, all of these stocks are now moving to the high point of the day. As you can see, Apollo Hospital up almost 1%, Max Healthcare too, along similar lines. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
afternoon. You've tuned into MF Corner on CNBC TV 18. I am Vinny Motiwala. Along with me is my colleague Sonal Putra as well. Sonal, a very good afternoon. And today we are discussing something interesting more in terms of individual types of funds that we've been discussing and factor funds today.
Factor funds which have been gaining some momentum, and there are of course many factors which all of these asset managers use to create these funds. Before we talk to our guest today as well, let's try and understand what have these different factors, be it quality, be it value, performed versus Nifty 50, which is the benchmark. The table should come up for you on the screen. Year to date, and this is as per the data as per 31st July 2026, and the source is NSE Indices fact sheets. These factor funds or factor indices have done really well. Nifty 50 is down around 0.4%, has been absolutely flat till July, but quality fund is up around 4.5%, alpha index is up around 4.5%, low volatility 30 is up around 4.5%. It's only the value pack which has not done so well. It has in fact underperformed the Nifty. If we talk about it on a one-year basis, quality has performed in line with the benchmark, which is up around 10.5%, but alpha 50 has outperformed with gains of around 14.5%. We do have low volatility, which is up 12%. Momentum has outperformed as well, 15% higher, and value funds have also done well, which is up around 10%. On a 5-year CAGR basis as well, good performance across. Quality has again been in line with the benchmark. We do have alpha, which has outperformed with gains of around 20% for the investors, but we do have low volatility, which is up around 17%. We do have momentum 50, which has outperformed yet again. This has been a category which has outperformed across the board, and we do have Nifty 50 value, which has done well as well. So 17.5% again there as well. There have been some new factor funds. As I said, there's been a lot of momentum there. So the new factor funds that have been launched recently, we have Nifty Alpha Low Volatility 30 Index Fund by Kotak Mahindra. The factors here that they're using is alpha plus low volatility. So of course, when there's low volatility, you talk about large caps, right? Then you have Nifty Small Cap 250 Momentum 100 ETF, which is from Grow Mutual Fund. It has momentum and quality, so it is looking at small caps for now, and it anyway talks about being a small cap ETF. We have BSE Midcap 150 Momentum Index Fund. A lot of these are passives based, basically the new launches that have come by. It's a momentum category with mid caps as the focus. So these are some of the products that have been launched, and this is how the category has panned out over the last 5 years. In fact, to understand more, who are these factor funds for? Why should one look at that? And will the outperformance continue? What should you keep in your mind when you're looking at factor funding, factor investing as one of your strategies? We are now joined by Tarun Birani, founder and CEO at TBNJ Capital Advisors. Tarun, good afternoon. Thank you so much for joining us today. Before we take a deep dive into the space itself, I wanted to understand why there's suddenly so much interest in factor funds right now. Is this a genuine structural shift in how Indian investors think about investing, or is it AMC's chasing a trend because quant capabilities have matured?
Right. So good afternoon, and thank you for having me here for this interesting topic on factor investing. I feel to your specific question, the interest is not sudden. It just looks sudden because we are now in the steep curve of adoption curve that started building from 2020-21 because a lot of forces have converged. So let me talk about some numbers and I think you already spoke about the numbers, but last 5 years we have seen a compounded growth rate of new inflows in smart beta at 100% plus, from 1,000 crore to 52,000 crore AUM, which we have seen in smart beta category as we talk right now. I think there are a lot of changes which has made this inflows in these category. A is SEBI has brought in a lot of framework as well as changes in smart beta and factor passive schemes a few years ago. And normally we see any regulatory action to come in actual play takes some time, and we are seeing the benefit of all those changes done at that time. A lot of new product capabilities have been built in, a lot of new index structures have come in, a lot of AMC structure we are talking about, which are like light models have been built in for the passive only AMC kind of model. So a lot of things have been done in last 2-3 years from the regulatory side, because earlier there only used to be factor investing used to happen through PMS and quant models, but now this is available at a very democratized 100 rupee minimum SIP model also through a mutual fund route. And apart from that, it's a investor evolution I would talk about. We have seen globally and especially in US market, adoption of smart beta funds have been very well scripted, and in India also is following a similar path. And apart from that, we have seen markets have also not done that great in last 2 years, and that is also building new product are coming into play through that thing. So I think a lot of innovation happening in the factor investing right now, and due to which we have seen this action happening. Yeah.
Absolutely, a lot of interest that's picking up in this factor investing, and you mentioned why factor investing is picking up pace as well. But Tarun, good afternoon. Let's actually talk about what exactly is factor in terms of first-time investors. Help them understand to picture, what these factors are and why should stocks, cheapness, momentum, low volatility matter more than just how good the company is actually.
So I would say the most important analogy I would like to use is cricket, which is all-time favorite for all of us. And when you look at a cricket team, you just don't look at to pick only good players. You pick up players for specific attributes. You want an informed batsman for consistency. That is for me a growth category. You want a big hitter who can score fast runs when the market is running. That's momentum for me. You want a reliable players who delivers dependable runs year after year. That's quality for me. And you want a defensive player who saves you when the conditions are against you. That's, according to me, low volatility. So every attribute has its suitable time. No single one works in every match. There is a Virendra Sehwag, there is a Rahul Dravid. All those kinds of players are required in a team. So in an entire portfolio, you have a need of many such factors. And now, talking about finance definition, factor investing is an investment strategy that selects stocks based on specific characteristics that influence return and risk. That is the most important part. And that characteristics in factor comes into the value, momentum, quality, size, and low volatility. Value category is nothing but identifying stock at a cheap level, buying stock that trade at low multiples of earnings or book value. Quality is talking about business strength, high return on equity, low debt, stable earnings. Momentum is tendency of stock that has done well over last 6 months to 1 year to continue to do well in the near term. And low volatility is nothing but counterintuitive but well documented finding that stock with steadier price behavior have historically delivered better risk adjusted return. So all these categories have a defined attributes. And I think to your question, why does a stock factor exposure matter more than a good company? Because it matters more because a good company at a bad price is a poor investment. But a mediocre company bought cheaply in a well-diversified basket but historically delivered a return. So factor takes this discipline out of the individual analyst judgment and put that into your portfolio and rebalanced every 6 months. No emotion, no style drift, and no change of fund manager. All these are some very valuable things which factor investing bring to the table.
So let me take this cricket analogy further. Now that we are creating a team, there are a lot of factors which are kept in mind, right? To take you to that 11 number in the team as well. Walk us through how one of these funds is actually built from the full stock universe down to the 30 names in an index like Nifty Alpha Low Volatility. How does that, the structuring of a fund happens?
Great. So let me take you through a four-step funnel. And this funnel starts with building a universe, then filter, then a score, and then a capitalization. So every step is a written rule, and that is what separates a factor index from a discretionary portfolio. So now you spoke about the specific Nifty Alpha Low Volatility 30 index because it's a well-known example that a viewer can look at. So let me just tell you the step one. The step one will be the universe, and universe has been identified as the top Nifty 100 stocks as well as the Midcap 50 stocks. So total 150 tradable, liquid, F&O eligible, large and mid-cap stocks. And that is the universe what is defined at the first place. Second is the filter. Step two is the eligibility filter. So stocks must be available in the derivative segment. This is to safeguard liquidity. An index or a mutual fund has to replicate. Every day cannot own a stock. That is hard to buy and sell. Step three is the scoring. Each eligible stock gets a alpha score. So alpha measures how much its return have exceeded what the market alone would have delivered. And a low volatility score, the universe of the standard deviation of daily returns. The two are combined into a composite score, and the top 30 stocks by this score make it into the index. And the step four is nothing but the weighting and the capping. Stocks are not weighted by market cap the way Nifty 50 is. They are weighted by the factors itself. The strongest combination of alpha and low volatility signal gets the highest weight with a hard cap of 5% on any single stock. So these are some of the process which all these smart beta factor index funds follow. And with that, a portfolio is created which is on a continuous basis, rebalanced on a 6-monthly basis. That's how this process works. Yeah.
Okay. Thanks so much for that, Tarun. Understanding how this process works is also important. But do wait by, because we're going to slip into a very short break. We'll come back and continue this conversation after the break as well. Stay tuned in. Welcome back to MF Corner on CNBC TV 18. We still have with us Tarun Birani from TBNG Capital Advisors. We're discussing factor funds, factor investing. And Tarun, let's take this conversation forward. While you've spoken about how, the selection is made, what are the factors that one looks at as well, there's a premium, right, for factors that is actually there. Does that hold on for a period of time, over a period of time in India? How has that worked, this premium? Or is there a risk that actually comes in because of factor crowding where, once you start losing that edge, once that money chasing is over, then there's a risk. So is there some signal for that as well then one should watch out for?
Sure. So let me try to answer this in two halves. The first is the evidence of persistence, and then the honest case of is there a crowd negative factor working on this part, right? So first talking about evidence, and that should we should talk with data, right? So we have all these momentum, quality, low volatility, value, all their data is available on Nifty index dashboard. One can go and check there the data for last 20-21 years. And when we do that rolling return study with a 5-year kind of rolling data period, it tells us that average it has given never in a 5-year instance alpha less than 0%, right? So always there is a alpha case in momentum category, and we have seen almost 88% times if you have invested with a 5-year minimum mindset, you would have got more than 5% alpha. And if more than 10% alpha, there has been a chance of 38% time. So this is a huge data, right? Which is validating that alpha creation has been done over a long period of time. Quality also giving us similar kind of numbers, though there has been some negative numbers available. For 5 years, there is 2% chance of making negative returns, but almost 49% times almost more than 5% alpha creation has been done, and 32% times more than 10% alpha creation has been done. Low volatility, there is a 8% negative, 8% chance that negative alpha can come. And apart from that, there has been also 5 to 10% alpha creation happening there. So there has been a very clear-cut data which is available and which is validating that if somebody holds this factors for more than 5 years, I think there is a very good case that they can create alpha compared to the benchmark for them. But on your second question on this, is this too much money chasing these funds, are is that the reason for all these interest or all these? To that question, I would still say we are at the very nascent level at 53,000 crore of AUM right now at the industry level, and I don't think that can manage this kind of action. So again, time will tell if we are moving there, but I would keep a eye on that part also. Yeah.
So, Tarun, now we are seeing a shift from passive single factor funds to active multi-factor funds. Is that adding complexity? Is this just mostly adding cost, or do we need different varieties in this particular category as well?
Correct. So yeah, I know there are a lot of multi-factor funds coming in the market, but there are two different types of multi-factor funds which are coming. A is the passive multi-factor indexes, and for them the data is compelling. So like the mix of low volatility plus momentum, momentum plus value, low volatility plus growth, low volatility plus quality. All these are combination which a lot of products I can see are trying right now and trying to give solution to investor based on their risk appetite. So some investor want high growth, some investors want lower risk. So based on suitability of the investor, products are being designed, and I feel this is a welcome product solution which is coming into play. So just I was researching that a low volatility plus momentum, if taken from 2016 to June 26, it is giving 1.29 times of the risk that product is giving. So it is giving very good risk adjusted return. Again, quality and momentum is giving 1.19 times compared to the risk they are taking. So this, according to me, is a very, very positive number, and this actually as a solution based on the risk appetite and suitability of client can be given. But another category which is coming very, very actively in the market is actively managed multi-factor funds, where a fund manager decides which factor to tilt towards and by how much based on the view of the market. And according to me, investor should be very clearly be aware that it is a different product. It is not a passive product. It is closer to the traditional active fund with a factor overlay. It can add value if the manager tilt are right, but the added cost, the added subjectivity, and the risk of style drift all have to be earned over a period of time. So I would be very careful on that category called actively managed multi-factor fund. Again, data suggests investors should be very careful because 1 year return between these funds have been between -2% to 24%. So the returns are quite skewed. And this is telling us the story that it is like any other active fund in the market, right? So why would I go for something like this? This need to be questioned. That is what I'm trying to say. Yeah.
Okay. Tarun, just a quick one, right? How should factor funds actually size up in one's portfolio as well? Is it meant to actually replace core index fund, or maybe sit beside it as well? A quick answer. We're almost out of time.
Right. So according to me, your core portfolio should be largely driven in diversified as well as core indexes, which are market cap driven. But your tactical portfolio, maybe 25 to 30% of your portfolio can be looked into factor style investment based on your risk appetite. So if you have a lower risk appetite, you can look at quality, you can look at low volatility, and you have a high risk appetite, you can look at momentum, alpha. All these indexes can be part of your portfolio.
At that point, Tarun, always a pleasure speaking with you. Thank you so much for breaking down this category for us. As we've been saying, there's a lot of momentum in a factor fund scene with the kind of products that AMCs are launching. Always important to understand before investing in any categories. Thank you so much for joining us with your thoughts. Okay, all right. With that, we'll take a leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Whether you look at the Taiwan index, that's down 0.6%. Hang Seng, that's down 0.1%.
Or a path back to normalcy with an opportunity to rejoin the global economy.
I mean, not just on Iran, but anyone who deals with Iran also now faces U.S. sanction.
We keep talking about acquisition, it has to be seen as a larger partnership.
Department has done certain addition on account of the notional.
24,170 on the Nifty. We are down 0.2.
My own belief is that this is not going to go very far because it is a restrictive trade practice.
Growth rates, of course, have slowed down as the base has exploded.
The timing is optimal as the commodity prices are now picking up.
Likely to take feedback from the Indian industry. Now, the trade deal between India and Japan is likely to be reviewed.
Continues to be a very volatile market. We did see a recovery, but that has been sold into. Nifty is very close to the day's low.
Okay, it continues to be a bit of a listless day. That was essentially a recap of what has happened over the last few hours since markets have been trading today. We're down about 45 on the Nifty. Coming to you from the CNBC TV 18 Motilal Oswal studios, I'm Prashant. With me, my colleagues Reema and Nigel. Guys, hi, afternoon.
Hi, afternoon.
Hi, afternoon. Here's the thing, right? Not much has happened through the course of the day. Markets once again wedged in a very tight band and now below the 24,200 mark. Midcap index as well, other than the fact that individual stocks here, Vodafone Idea, for instance, which is flying high, 8% up, that's pushed up Indus Stars. The Midcap index too is flat. The good thing is it's picked up a little bit from the day's low, though the advanced decline ratio is in favor of the stocks decline.
Well, that's right. And crude oil prices have cooled off a little bit from what we saw either yesterday morning or even this morning. And that explains why a few stocks have got excited. Something like an Interglobe Aviation, and that's currently at the high point of the day. Big pop is what you're seeing. You have other counters like an LSE Housing Finance. Yeah, that's up for you on the screen as well. It's currently at the high point of the day. So we'll have an expiry-related move as well that we'll expect on select counters. Final 60 minutes, maybe we've had a quiet trading session, but I think we're in for some action in the final 60 minutes.
Okay, all right. Well, let me just quickly, take you through what's coming up here in terms of the show. So IT and metals are under pressure. We'll talk about that. Federal Bank and Jana Small Finance Bank is a story which we will get to in just a bit. Hindustan Copper OFS, the Deepam secretary talking about the timing, the opportunities ahead, etc. IIFL Finance stock is still down off the lows, though. We had the management with us earlier today. Of course, you also have that other story, which is the DRDO, that is the Defense Research Development Organization, saying it's going to transfer some of its missile technology to the private sector. What does it mean incrementally? That's a question which we will address as we move forward. So, those are some of the things which are coming up. Okay, let me just quickly look at the broader market, right? And before we go any further, by the way, it's 2,000 down and about 1,400 stocks which are higher at this stage. NetWeb is down about 3.5%. Again, I mean, they've recently raised money. There is Data Patterns, which is down. Actually, some of the smaller defense companies are all selling off. Data Patterns and Paras Defense, etc., has been down since the morning. And the other, of course, all these, not all, but a few of these transformer companies which are taking a bit of a knock. There is Voltamp and Skipper Limited and GE Vernova was down in the morning. Hitachi was lower this morning. So just some color. Balrampur Chini, the largest sugar guy, is also down about 3.5, 671. But stocks have rallied lately on the back of very sharply higher sugar prices, which has all sort of come together lately. What we're going to do is just quickly, before we go any further, play out that soundbite from the Deepam secretary on the raise which has happened in Hindustan Copper, but not just that, more as well. This is Arunesh Chawla, who spoke with us a little while back.
Hindustan Copper OFS has been announced. 6%, which is 3% base and 3% green shoe. Total 5.8 crore shares are on the table today for the investors. The timing is optimal as the commodity prices are now picking up, the metal prices are picking up, and the OFS has been designed in a way that it also leaves some room for a decent room for the investors to make money and gain profits and make money from it. And the forecasts are good. The future is even better. Team Deepam has worked very hard. We are confident of meeting our targets, and we are confident of meeting our obligations to small investors. As you know, we had a large sale offer, which is the largest sale offer on our markets ever. 31,500 crores is what investors invested, and they have not regretted it. They have already gained 10% on what they invested. And with this, we have reduced the government stake in LIC to 90%, almost 1 year ahead of the deadline, which means there will be a pause and a sufficient opportunity for investors to gain from their investment.
Okay, those are important statements coming in from Deepam for the markets. That recovery, the pullback continues from the lows, though we're still pretty much flatlining. Dharmesh Kant is now joining in, Head of Research at Chola Securities. Dharmesh, a lot of individual movers, but which is the stock at your dealing desk today you're most excited about?
Yeah, good afternoon, Rima. Thanks for having me for the show. I mean, today we are just taking our day off. There was a lot of volatility in the market and we are watching it from the sidelines. I mean, what we are expecting is from tomorrow to market to show some, semblance and gains can be expected. Today, it's difficult to take a call for the day.
Give us some ideas though. I recall yesterday you spoke about Raymond Realty, and if I'm not mistaken, the stock I think yesterday was up 3-4% approximately. That's come off a little bit today. But any other stock you're looking at?
Yeah, I mean, Raymond Realty is more of a long-term initiating coverage kind of a call. So we did at around 570.74 and with a target price of 686 from a year's perspective. So days like this is basically to, get into it and be a long-term buyer and get new fresh investments out there. What we have been actually, holding on and looking very closely has been all the banking and stocks, be it a private sector banking space or a public sector banking space. And what we have been liking out there has been IndusInd Bank, Axis Bank from the private sector banking space. So they are in a very narrow range, but nothing doing great. But I think they should start moving up, going into the festive season. And from the public sector space, we are liking Bank of India. So these are the on the banking. We have been liking that. Metals are a play which should be bought into declines. One leg of rally has already happened over last 1.5 months. Hindalco, JSW Steel, we have been advocating that, and that has really rallied sharply. From here, we are expecting some, if 5-7% kind of correction happens, that can be bought into. Where the correction has already happened is the Vedanta Group, Vedanta Limited and Vedanta Aluminium Limited are looking pretty attractively priced to us. So that is one area where one can get a buying on declines kind of scenario. Hindustan Copper, I mean, it was very extensively covered on your channel. So we are in the camp which we think that this decline in the counter should be used to buy from a long-term perspective.
Oh.
And the copper, the entire theory stands. So nothing taking away from there.
So you're saying buy Hindustan Copper on a dip. So tomorrow when it opens up for retail, you'll advise people to go ahead and apply in that. In the non-retail, it's already got subscribed more than 1 times, X of the green shoe option. So you're saying at lower levels, you'll be optimistic, that 514, 515 kind of.
Yeah, definitely, yes, Nigel. I mean, copper as a business is going to pick up this year. Also, year till date, the copper prices in the international markets have been holding firm after the peak level correction which has happened. And we think that 20-25% CAGR going from here on the growth front is likely to be there for next 2-3 years. So copper as a metal is not losing its sheen. At the same time, more and more EV usage and the other HVDC connection. So one big part about copper is the HVDC lines, which are 765 kVA plus, has copper more into it rather than aluminum or steel as a configuration. So that is where the major traction will come from domestic consumption point of view. So this is a good discount which they have offered. However, OFS from the government, Coal India, they did, but it was not so successful. It's trading below the price, OFS price.
Okay.
LIC is successful.
Got it. All right. So you're saying that to buy it at lower levels, got that. That's Hindustan Copper. You know, the stock we should focus on is actually Paytm. It listed, I think, in November 2021. And for the first time since December 2021, the stock has crossed that 1700 odd mark. So, you know, those shareholders that have been holding since then, that is since December 2021, for the first time, Paytm is now above that 1700 rupee mark.
But still not the IPO.
No, IPO is at 2100.
Yeah.
No?
Yeah, correct. The listing, I think, happened at about 21 or maybe. But
it listed at 1950. IPO price, I think, was around 2150 approximately. November 2021 is when the listing, it gapped down, and from there, it never saw those levels again. But hopefully, you know, for the good of those IPO holders, you know, those that got allotted, hopefully, there's more in store.
So, the open was at 1950. The high was, actually the high was 1955. Yeah. So, and then of course, I mean, it had an immediate drop to about 1560 in the next 2-3 trading sessions, and taken a long time, but has had a remarkable run from those 500 rupee levels, and it all started about a year and a half ago. Well, I think we want to focus on Rashi Peripherals as well. Stock's down 9.5%. It's had an amazing run over the course of this year, and I think if you look at it, even now, on a YTD basis, it's up 100 and 110%. So it's basically been one of those, spectacular movers. But why is it down 10 now, today? Vinny's here with the details. Vinny, take it away.
Hi, so yesterday Rashi Peripheral is mainly down because we have an independent director, Mr. Anil Khandelwal, who was resigned as on 24th of August 2026. Now, he's an independent director. Normally, we would not see very big moves coming in, but he's mentioned certain reasons why he stepped down as an independent director. One of them, first one being the director selection as well as the key managerial person pay, which is decided by the management rather than an independent committee normally that decides it. So that's a concern for him. He finds that as an issue. Other than that, he said that he's raised this concern a lot of times, but there was no solution that was found to this as well, and no improvement in this process. So he doesn't find this good in terms of the governance point of view. The other important point is that acquisition due diligence work went to firms which were mainly of two independent directors, where they were senior partners. So he finds that, they should have actually gone to the board. They should have approved it in the right form and method. So he found that something as an issue coming in as well. Though what the company is saying on this front, the company is saying that the position was acquired requisite by the independent directors and was not legally required by them. So these are certain issues that he highlighted, but he didn't find any improvement in terms of the process that was going on that front. And that is why, he's resigned from his post, and we're seeing a bit of a decline coming in the stock, not a bit, 10% decline intraday in trade.
Okay, thank you very much for that. This is a company which is a distributor of IT, software and hardware companies, so typically operates at very thin margins, but the top line is very large. But for the last couple of quarters, it's been reporting very strong growth because of the surge that we've seen in memory and storage prices. So that's a direct pass-through. So the absolute value of the products that they are distributing from the US to Indian clients has gone up, which is why the numbers have been very strong in Q1, and even FY28 was strong, growth. But we'll have to get into the details about the concerns shared by this independent director's resignation. Ramesh, Rashi Peripherals, a stock that you've looked at?
No, Riba, I haven't looked at this company.
Okay. What about Vodafone Idea? Stock is almost approaching its 52-week high. There is newspaper articles suggesting that SBI could be leading the bank fundraise. And this is something that the street has been waiting for because it also clears the way for an equity fundraise. And then the expectation is that a tariff hike is round the corner. On Vodafone Idea, do you think things are turning around? And from 15, it's attractive at a price of 15 rupees?
Yeah, definitely. I mean, the way things have unfolded for Vodafone Idea for last 6-7 months, looks like things are turning around. First, it was the AGR related news where they got a relief, and now if the fundraising and everything gets cleared, then they will get ample ammunition on the cash flow side to take care of their 5G expansion. So ARPU's slightly better than what they were, but a lot of catch up to be done. But Rima, to put it in a very straightforward manner, it's a punt to be played out. So 14 rupees, 15 rupees, it looks attractive if things turn around in next 2 years time frame, which we think is likely to be the case going by the way things are unfolding for Vodafone Idea, though the entire space looks congested as of now.
Okay, all right, got that. Let's shift focus to an exclusive then. We understand from sources that private lender Federal Bank is looking to acquire controlling stake in Jana Small Finance Bank. Sudarshan is the one who's picking up that scoop. He joins us to fill us in with all of those details. Sudarshan?
So interesting things are happening in the banking space of Indian banking space, and we understand from sources that talks between Jana Small Finance Bank and Federal Bank are in advanced stages, and if the deal fructifies, Federal Bank may end up acquiring controlling stake in Jana Small Finance Bank. As of June 30th, promoter of Jana Small Finance Bank held around 17% stake, exactly 16.9% stake. Last month, if you remember, Jana Small Finance Bank had disclosed to exchanges that promoter is looking to monetize or pay its stake from 16.9% after it had sold around 4.9% stake in Q1 FY27. And also, we had reported in July that agreement or basically merger with a peer bank is a possibility for Jana Small Finance Bank. Now, another part of the story is Jana Small Finance Bank promoter, that is Jana Holding, owes 700 crore rupees to TPG Asia, and for which the payment date was June 30th. After, there was an agreement between Jana Holdings and TPG Asia, and that has been rolled over to December 31, 2026. So they still have time to make that payment. Now, another part of that story is Federal Bank. Recently, its board has given the approval to raise up to $500 million via bond, and in all likelihood, Federal Bank can use this proceed to acquire controlling stake in Jana Small Finance Bank. We are returned to both Jana Small Finance Bank and Federal Bank. Federal Bank has disclosed to exchanges saying it keeps evaluating opportunities for both growth and expansion, and from Jana Small Finance Bank, response is still awaited.
Thank you very much for that, Sudarshan. Ritu is now joining in to analyze that if this deal does fructify, how does it look for Federal Bank and Jana? Ritu?
Well, let's set the scale first. On your screens, Federal Bank's balance sheet stands at almost 4 lakh crores. Jana Small Finance Bank way under 50,000 crores, and it's the same gap on advances, deposits, branches. So Federal size clearly dwarfs Jana Small Finance Bank. So let's look at why Federal may be keen to acquire their book. Now, look at the yields to begin with. Jana's net interest margin is almost 7.5%, which is more than double of Federal's. And that's because Jana is running a fast-growing, high-yield secured book. And in its gold loan portfolio, that's growing pretty fast, 113%. But Federal's own gold book, if you look at that, it's far larger. So Jana adds some incremental scale there. It's not a step change. But on vehicle finance, where Jana's book is about 2,000 odd crores, that is a meaningful add-on to Federal's own about 5,800 crore rupee vehicle finance book. Again, on housing, Jana's affordable housing portfolio is smaller ticket, more granular than Federal's, and that opens up this new customer segment that Federal doesn't typically reach. Geographically as well, Federal is very heavily south concentrated, while Jana is spread across 23 states, and it could help add density, particularly in states where Federal Bank is thin. Then there is a funding arbitrage. Of course, there's a 200 basis point gap in their cost of funds. That could be a key re-rating lever in this story. If Jana's loan book gets refinanced on Federal's cheaper balance sheets, margins, of course, tend to expand, and Jana's CASA ratio is barely 19% versus Federal Bank's 32%. So there's real room to cross-sell into Jana's 4.7 million active customer base. For Jana Small Finance Bank as well, of course, it's an exit, from that promoter overhang, which has been hanging over the stock. There's a re-rating opportunity, and it could effectively hand Jana that universal small finance bank license it's been chasing without really actually going through the conversion process. But of course, 3 risks to flag, and I'll put some of them on the table. One, of course, the integration could slow down growth momentum, as we've typically seen with mergers of this size. 2, Jana's asset quality is a lot weaker than Federal Bank, especially on the unsecured front. And 3, we don't really know the price yet. So the swap ratio, open offer terms, all of that, that'll ultimately decide whether this creates value for their shareholders.
Got that. Ritu, thank you very much for that. So that's a story that we've sort of, broken today. Dharmesh, any thoughts on Jana or what this means for Federal?
Yeah, Prashant, I mean, as far as Federal is concerned, we had an ICICI on it around 190 rupees, and from there it has done reasonably well. The business per se has been doing very good for Federal Bank. But I mean, this kind of acquisition gives way to, low take asset quality is not that great of Jana Small Finance Bank as compared to Federal Bank. So that's the biggest, risk why they are doing so, while going for a low quality asset rather than a high quality asset. Definitely some details would be awaited on that, and at the same time the transaction price. So the deal price will be very critical to it. To my mind, the only benefit which which is clearly visible is the pan-India reach and the distribution network which Jana has across India. So maybe that can be used for Federal's outreach on a pan-India basis. Other than that, it doesn't make much of a sense for Federal to acquire Jana, just according to me.
The other transaction which perhaps may be brewing, and I think the Financial Express carried this story earlier today, which is that the Fairfax acquisition of IDBI Bank may be given a green light soon. I mean, again, here, what are the prospects for IDBI shareholders?
Yeah, Prashant, this has been hanging around for quite some time. I mean, IDBI prospects, but that has still not happened. And 87, 90 rupees kind of a stock price, it's already run up. I mean, all the benefits which can come through is already in the price. So let's first have the deal on the table before we can comment, more on that.
Another small stock, but that's moving well, is Nitco shares. I don't know if you look at it, but the company said that its wholly owned subsidiary will be developing some land parcels in Alibag with the Abhinandan Lodha Group. So that's got the stock a bit excited. It's still up close to about 4.5%. Then you've got gains coming through in names like a Genesis International. That's up nearly about 20%. Assist with Maps. Federal Mogul Goods, that's up 13.5%. FACT is now 13% up, so that's been a big mover. Borosil, Angel One, RCF, Pine Labs also all higher in trade. But let's talk about defense. That's in focus after the defense minister approved the transfer of technology of the missile production technology to defense firm. Ria joins in to tell us more about this. Ria.
Well, yes, the Defense Ministry today has approved the transfer of technology of DRDO developed missile systems to the Indian defense industry in order to bolster indigenous manufacturing in the country. Now, as per the PIB notification, this tech transfer has been approved for all conventional missile systems, and this will in turn enhance operational capability for companies and for the entire defense industry as a whole, and also reduce the import dependence of the nation. Now, keep in mind that they are yet to disclose details on which specific missile systems will fall under this, and also what the qualifications and regulatory requirements will be for the tech transfer. But in terms of the likely beneficiaries in the listed space, we of course have Bharat Dynamics, which is the largest missile manufacturer, which will see benefit from this. Bharat Electronics also will see benefit in terms of the subsystems and components, and also for systems integration. There's also companies like Apollo Micro, Astra Micro, Data Patterns, Paras Defense. All of these are present in the areas of subsystems, aerostructures, propulsion, missile dome covers, and even optics and optronics specifically for Paras Defense. Even something like an MTAR Tech, that company is present in the domain of precision engineered components and subsystems, even assemblies as well. And we also have companies like Solar Industries, Premier Explosives, Bharat Forge. They are also present in the subsystems and component space, and also for warhead materials. And a smaller company like Nibbe Limited is present in the domain of missile launcher systems. So all of these companies can see some benefit from this approved tech transfer.
Thank you very much for that. A stock we don't often talk about is Nibbe Limited. Very small. I think its market capitalization is about 2,300, 2,400 crore rupees. The trailing 12-month revenue is close to about 450 crore rupees. That's Nibbe for you. Ria was telling us could be one of the potential beneficiaries. Dharmesh, is this a stock in your coverage or too small in the defense pack?
Yeah, it remains too small in the defense pack, but I mean, this is one thing is very clear. Government of India is trying everything to get more and more manufacturing and technology transfer into the country. So this will open up doors for everyone. For the players who are not into the right now into the manufacturing or defense, they are also likely to have a ticket in like L&T and all, likely to chip in a big way. So this sector will see a lot of traction going forward. The players who are already there, they are already burdened with 5 to 6 times of their revenue potential for the next 2 to 3 years. So the execution there should be looked into. So our call has always been whenever there is a big correction, like HAL and BL have corrected quite nicely from their highs recently. So these are the times where you should be nibbling into it and buying that. So defense as a whole is a great buy for us, and the top 3 picks for our house has been HAL, BL and Marchmont.
Okay, all right. Thanks a lot, Dharmesh, for joining in and giving us all of those details. By the way, keep an eye out on Hindustan Copper. It seems the DIPAM Secretariat as well came on, sounded very optimistic that demand's going to be strong. And if I'm looking at the screen, the non-retail portion has been subscribed by more than 1 times. In fact, X of the green shoe option, it's at around 1.9, which effectively means put the green shoe option together. It's approximately 0.93 times subscribed. So it appears, at least as of now, that green shoe option could possibly be exercised going by the demand. And, when I had spoken to the DIPAM secretary as well earlier today, I was telling him that, a lot of people were waiting for the second half to come in there and participate, various compliance issues, not too many sell-side analysts as well covering the stock. So it appears by the end of today, we could probably be hearing news from the government that the green shoe option has been exercised going by the demand. Well, we'll slip into a short break, come back. The Alpha Manager of the Day, Varun Goel of Mirae Asset Mutual Fund, will be joining in. Welcome back. Well, we'll have the monthly expiry as well as the weekly expiry that takes place right now. And it's interestingly poised right now because the Nifty suddenly has taken off. And I'll tell you what, we are 20 points away from actually a bigger short covering bounce that could play out. 24,260 is the level that I'm looking at. Let me give you rationale. 24,150 put. The premium out there is down to zilch. When we started the show, it was around 11 rupees. That's come down almost to zilch. Now it's around 2 rupees approximately. It was around 40 rupees at the start. You're looking at the 24,200 call. Now, the premium out there had come down all the way to around 20 rupees. Now, that's moved up to close to around 52 rupees as we speak. And yesterday it ended the day at around 62 rupees. So, those call writers, they're playing for the 24,260 odd mark, holding out, which now looks like, in fact, it could be challenged. So that's going to be important. So the broad range comes in up for you in the screen. Support is today's low, 24,115. And now that resistance mark of 24,260, that's going to be important. We're very, very close to that mark. And that was what positioning was looking like. A couple of stocks that we're looking at, Kalyan Jewellers, that continues to see long rollover. This is the second contract where we're seeing some long rolls on that one. While on Polycab, there is some signs of weakness on that one as well. I don't know whether it's, Ultratech coming into fundamental news or whether or not there's some technical news. But that one as well, every time it goes to around 9,400, it's seeing a bit of a pullback. So I'll keep an eye out on both these two stocks going into the September series as well. For the time being, keep an eye out on the Nifty. Very, very close to that crucial resistance mark, which if it gets taken off, we could see a big spurt once that 24,260 mark gets taken out.
Yeah, well, that is the F&O picture. By the way, today, of course, is the expiry as well. The weekly options expiry for the NSE options. Look at what's happening with these oil marketing companies. I think we're finally starting to see a bit of a move on these. So BPCL, for example, when we started, was at about 3, actually, it's moved up $4, about percent or so, a little over 1% or so since that point on. But of course, I mean, if oil falls more, I think all these stocks, we've seen this play out. Even with names like Indigo, etc., we've seen very sharp moves when oil, which has been at 93 odd for a few days now, corrects. So, I mean, but of course, that's anyone's sort of call in terms of what happens there. It all is headline trading more than anything else, which is, I'm talking about oil per se. We have Varun Goyal, who's with us, Senior Fund Manager, Mirae Asset Mutual Fund. Varun, good to have you with us here. Thanks for joining in. Actually, do you have a view on aviation? There's only one name. Maybe, others perhaps will be in soon. But Indigo is by far the dominant player. So a call on aviation is basically a call on Indigo, unless you're looking at airports, etc. Do you have a view?
I think broadly, with the way crude prices have been, we have seen hardening in ticket prices, occupancy, levels have come down. So broadly, I think this is a difficult year for most airlines. It will be difficult to, make money in this environment because beyond a certain point, the volume growth starts to tapers off very meaningfully, and I think we are already hitting those kind of levels. So I think this is a year to be, cautious on the overall airline industry.
So, what about the travel platforms? Any of them? More than I think 3 or 4 now listed. I'm not talking about OTAs, but like RateGain, TBO Tech, which basically works with the booking agents. Own any? Have you looked at any of these businesses?
Not really, Prashant. I think the profit margins in the space are, very thin, especially on the airline ticket booking side. There is a little better margin on the hotel booking space, but I think that also gets impacted due to seasonality and other factors. So I know we would kind of stay away from the space for now.
So what are you doing? Give us a sense, Varun. What are you focused on?
So Prashant, we had a fairly good earnings season. If you look at large cap companies, ex of OMCs, we saw almost a 15% earnings growth. But the real story has been in the small cap space. I think we're looking at 30% plus earnings growth in the first quarter. And our sense is for the year as a whole, the space can deliver more than 25% earnings growth. So I think the small cap space continues to be very attractive. Of course, from the beginning of the year, it has outperformed Nifty by more than 18%. From January onwards. And I think this outperformance will continue considering the fact that the earnings growth has been much more robust there. There is a lot of interesting IPOs coming in, new stories, new sectors, new themes. And I think if you're willing to get your hands dirty, do bottom-up stock picking, there is enough to come by. So one really has to pick and choose in this market. And I think they're fairly decent returns.
Talk to us. You brought up small caps, but small caps, you got to talk businesses. Which are the ones you own Just disclosure-wise, I mean, I'm sure your compliance guys will be fine. In terms of what you already own, give us a sense. Give us some sense of where you are at.
Yeah, so Prashant, I will not be able to talk stock specific, but broadly from a thematic perspective, we believe the CapEx story continues to do very well. There's several interesting defense names, engineering names, and there are companies these days which sit at the intersection of auto, defense, and consumer durables, which make some key components which go in either of the three sectors, some precision engineering companies. So we have a fairly large weight on this CapEx theme, fairly positive on diagnostics, hospitals, CDMO opportunity. That's again a sunrise sector for India. I think discretionary consumption after 2.5 years of slowdown is coming back in a very meaningful manner. So be it QSRs, jewelry companies, consumer durable companies, we believe there is going to be a big growth uptick. Auto ancillary companies will do well. I think we have seen a very, very robust auto volume growth in the first quarter of this fiscal year. I think the cyclical recovery, has been pretty strong, and I think the volume numbers will continue to be positive in the remaining quarters of this financial year. So I think, while the sentiment has been, of course, muted, but I think if you look at this year, this is the exact inverse to 2024, where earnings were slowing down, but sentiment was good. And this year, if you see, earnings have been getting better and better while the sentiment is muted, and I think that's a great time to be doing a lot of bottom-up stock picking.
You said amongst the new IPOs, a lot of interesting businesses are coming up for the first time ever. Can you tell us a little bit about the ones where the business looks interesting and the market valuation is fairly attractive?
I think one really has to pick and choose, but from a thematic perspective, of course, we are undergoing a big shift in the sense that the economy is focusing more on manufacturing. So some engineering companies, EMS companies, there are quite a few defense companies coming up. I think recently some companies in the CDMO space, diagnostic space, these are all very interesting areas with 5 to 10 year kind of compounding possibilities. And I think therefore, of course, one has to really pick and choose because valuations in some case could be frothy. But I think this energy transition shift from ICE to EVs as far as auto and auto ancillary is concerned, whether it's defense, whether it's engineering, there's a lot to come by. And I think till the end of the year, there's a fairly big pipeline of IPOs. And I think there's a lot more interesting ideas which will come up.
Are you referring to names like Moblio, etc.?
So Prashant, again, I'll not be able to take any specific names, but we have been participating in select IPO companies as and when they have been coming in.
Because no two companies are similar. You can name a sector, but for the viewer, it's not as if there is one company. I mean, you say airline, there's one. With diagnostics there are 10, right? So yeah, that's the reason why I was kind of sort of maybe we should talk about some names purely from an academic perspective without really, with all the disclosures. I think that'll be useful from a viewer's perspective. But anyway, we'll do it for the next time. But Nigel, go on.
No, what about Welspun Corp? Varun, I recall, that's the one that you all held on to, right? I mean, I remember at one point of time, people were talking about not too much institutional holding, but I think you all were one of the funds, right, that had some investment in that one, Welspun Corp, and suddenly they're bagging those big orders.
I think broadly, if you see across the industry, the pipe space has been doing very well. I think a lot of orders looking at the buoyancy in the oil prices. I think there's incremental capex that is being announced in US. There's a lot of shale gas discovery, and of course, you have to take the gas.
Varun, since I've got you to talk a little bit about the sector, we'll stick to the sector. The stock that we're talking about is Welspun Corp, in terms of what you all had and what you all backed early, I think so. And the stock has been a big outperformer. How much of the good news of this pipe theme is already in the price? Because these guys have been really lucky. I mean, they've obviously done the right investments, but otherwise domestic industry is struggling a little bit. They had turned their attention, to the LSAW pipes in the United States, and that really just took off. Imagine winning a $2 billion order. It was unthinkable, say, around 3-4 years ago. How much of the good news is in the price?
So again, Nigel, I won't be able to comment on a specific company, but broadly, my view is that there is big oil and gas capex that will happen in the Middle East. I think thanks to the war, I think everybody wants a pipeline infrastructure in place so you can evacuate oil from various locations. I think in India too, there is a big water pipe capex which has been pending. I think while the Nal Se Jal program has been growing slow for some time, we hope that it will catch up, and even the water pipe companies will benefit from that.
We'll leave the conversation here. Varun, thank you very much for joining in. Would have loved to hear some ideas with you in terms of individual stocks, but hopefully next time you can share something. Get into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter, and also a few short-term technical trading ideas.
Welcome back. Well, as promised, let's get straight to our favorite segment, D Street Chatter. Nimesh is joining in to give us an insight into what's going on there. Nimesh, volatility is picking up, getting into, playing out the August contract. But what's the feedback you're getting?
Nigel, I guess for today, because it's the first expiry under cash, a lot of individual stocks may see a bit of action and volatility. So I guess this last 15-20 minutes could be quite interesting, not from a Nifty or a Sensex point of view, but more from a specific individual FNO stocks point of view. So watch out for that in the last 15 minutes of trade. From a market point of view, it's been very range bound. Again, the Nifty is clearly acting as there is a lot of resistance on the upside around 24,500 level. So that's clearly playing out on the Nifty front. Even in the broader markets, it looks like there is a loss of momentum now. We're not seeing big action. It's getting very narrower with every passing day. So not much participation coming in from broader markets as well. At least in the last many days, from an individual stocks point of view. Flow-wise, again, it's a mixed day of trade, but I guess a lot of numbers get adjusted because of the large block deals. Even today, because of Lenskart, you'll see the very high number, but that's because of some large blocks. So the supply of paper still continues, and that's going to have a bit of a cap on the upside as well. That's the feedback from market participants. So watch out for the volatility in the last 15 minutes in some individual names. But from a direction point of view, I guess 24,500 has to be taken out for a meaningful upside from current levels.
Okay, got it. What about individual stocks, Nimesh?
So the first stock is JLF. We've seen a very large consolidation in this particular name, within the real estate names. But interestingly, now at these levels, not only there is HNI interest back, but even some domestic mutual funds are active investors. I believe one large domestic mutual fund has been accumulating. It's been known for the contra bet, so that's a fresh contra bet from this particular mutual fund. So watch out for the disclosures if any that comes in. And also there is a buzz of a new launch soon for DLF. That's been the big missing point in case of DLF. So if there are large, new launches announced, you might see some traction there. So that's the first name. Second stock is LIC. Again, since the OFS, we've seen a big traction in this particular name. On Friday, there was very large delivery-based marking. Even today, I understand there is follow-up buying from larger FIs into LIC at current levels. The third is Welspun Corp. It's been the big outperforming stock of the last 2 weeks on the back of a very large order win. Now I anticipate a couple of corporate developments in Welspun Corp. One, there is a possibility of a small OFS by the promoters to sell some stake and encash money. And two, there could be some upfront payment on the large order win that the company has recently backed. So watch out for those two developments in Welspun Corp. And the last couple of names where there is delivery-based buying today, UPL and Laurus Lab, both stands out. UPL, after a very long time, some bit of accumulation has started at FI desk, and Laurus stands out in terms of very strong FI buying in today's market.
Nimish, with the first one, DLF, is it launch in, they're kind of home ground in that sense, which is Gurgaon, or, another market?
To me, it looks like there'll be a surprise, not in the hometown, but outside of Delhi market, and that could be a bit of a surprise for the market as well. I guess DLF has been missing out in the Bombay market for a very long time now, so maybe there could be something with regards to a launch outside of Delhi. Potentially, could be Bombay or Bangalore. My sense is it could be Bombay as well. So if there is any deal launch in the Bombay market, I think that will excite the investors to some extent, because even in the Q1 the numbers were flat largely because there were no new launches, and which is why the pre-sales were weak. So if there is something from a new launch perspective, that is something to watch out for in DLF.
And on Welspun, that second, the one is, of course, the OFS perhaps. The second is the upfront payment. This is for the very large order which they've gotten 2 days back, right?
Correct. So they have of course, the last one was a very large order, $1.7 billion. Maybe with regards to that, they might get some upfront payment as well. So that's one anticipation from the street. At the same time, there was an indication that maybe a small block can come by OFS in promoter stakes in.
All right. Well, Nimesh, thanks very much for that. That's chatter for you. And, those are two names, but there were two others in focus. Well, we'll, keep an eye on some of these names. Mitesh is with us with some trading ideas, what to buy or sell today for a reverse trade tomorrow. Mitesh, what do you have?
Yeah. On the stock side, there's some selling which has happened on the charts of Federal Bank. So I'll take a negative call there with a stop at 340, with a stop at 354 for a target of 332. And Cochin Shipyard is a buy with a stop at 1499. And the breakout for the Cochin Shipyard, happens above 1526. So buy above 1526, keep a stop at 1499, look for targets of 1590 thereabouts.
Okay, all right, got that. Thanks a lot for that, Mitesh. Well, earlier today we spoke to Eurasia Group's Pramit Pal Chaudhary to understand what the latest round of United States sanctions on Iran could lead to. Let's hear out what he had to say.
America has sanctioned Iran now for 40 years. So they piled sanction on sanction after sanction. So there's not very much left to sanction in Iran itself. So yes, it has to be about secondary sanctions, as Besant mentioned, that it will go after countries that do deals with and specific companies and institutions that act as intermediaries in that trade with Iran. So the expectation when he talks about the Americans have said a high target, a high value target will be selected, is that it will be a Chinese firm. It would have been a UAE firm, I would have thought, except that UAE has already announced that it has imposed its own sanctions on Iran. So I would expect a Chinese firm to be chosen. The game is that we're not going to name countries. We're going to sanctions are ultimately aimed at companies or institutions. So those are what will be mentioned. I think the Trump administration has this bullying tactic of basically making loud threats and then expecting the other side or a government to come in and say, okay, tell us what we have to do here, and we'll strike a deal. And I suspect that's at the heart of what they're doing now is really much more about trying to get China to come to the table than it is anything else. And what they will be demanding of China is much more than just Iran, but be something more to do with China's own trade practices. They may announce and then not actually impose. You look what they did with Canada. They made all these noises about tariffs, but almost all the tariffs that they mentioned only kick in about in late November. Which is after the midterm elections. So in effect, you're saying we're making this noise. Canada's making an equally sound response, but actually none of this comes into play until a few months from now. So a lot of what we're seeing with the Trump administration now is a lot of noise. And with the Trump administration, it's always important that don't look at just what they say, but really look at what they do.
Okay, the market's picked up, right? I think the 24,260 is the 315 price, which means we've kind of left off 41 points higher. And in a couple of minutes or so, we'll have the cash session, which will start. But this is, I mean, a big improvement compared to how the market's been trading for the bulk of the day, which essentially was down and out with no real momentum. I mean, actually, things started to pick up in a real way at about 1:30 or so from the 24,100 kind of levels, 125 to be precise. And, from there, we picked up almost 120, 130 odd points to that 24,260, 315 price. As I said, we should have the first cash indicative prices coming up anytime now. Jai Bala is with us. Jai, good to have you with us here. Thanks for joining in. I think no change in terms of generally the direction from the last time we spoke, Jai. Sideways and lacking momentum broadly.
That's right, Prasad. Thanks for having me on the show. The Nifty did something important, but yeah, you're right in pointing out that the markets are lackluster. I was pointing to an important support at 24,100, 24,050, and I didn't want the market to close below that. So the markets came into that region and it's bounced back from there. So far, the momentum hasn't picked up on the upside, but if the markets were to close into 24,350 or 24,500 zone, that will be a positive. And as we speak, the crude is coming down by 3.5%, and it was down yesterday by another percentage point. So, this is a bit of a positive that the markets are, from a cross markets perspective. So we are okay, and the markets haven't done much from last time, but the cross assets correlations are giving some positive signs here.
Okay, all right. Let's talk about a couple of other asset classes then. Gold as well as Bitcoin. The presumably safest that has given the best returns, which is gold, and Bitcoin, which is presumably very, very risky, and that in fact has come down. But both of them in the last few weeks have actually shown traction on the upside. Where are they both headed?
That's right, Nishal. If we recall a conversation from June, I had said Bitcoin would make a new low around the 54,000 to 52,000 mark, and then triple from there. So that move has already started. The low, although, was 57,700. And just a few sessions ago, I put out a tweet on Bitcoin that is broken out of inverse head and shoulders pattern. So Bitcoin is basically headed to 145,000, in my opinion. I think it's a formality for it to cross 82,000. That will take out the previous swing high. So I think it's already at 80,000 plus today. When it comes to gold, that also I'm extremely bullish, and I said last time to Prashant that any decline from here on is a accumulation opportunity. The June 30th low of 3945 on London spot gold, that's a very significant major low for me. And I think gold is headed to fresh record highs, but there is a slight dissonance with silver. I think silver is yet to put in the final low. So I anticipate gold to pull back deeply, but not break the June 30th low of 39.45. I anticipate silver to break the July low and then join gold and probably outperform gold later on. But right now, more bullish on gold than silver.
And you see gold going back to its record high levels of $5,600 an ounce. So that's a good $1,000 increase from here on.
Much past that, Rima. But the basic point is, the pullback that's coming for gold. It's possibly a higher high for gold, and anticipate gold to go somewhere about 6,300 to 6,800 from a 12 to 18 months perspective.
Okay, what about your stocks that you're recommending, Jay?
Yeah, I'm bullish on two stocks, and I want you to keep an eye on a couple of other stocks. First is Brigade Enterprises, and it's coming from the real estate space. I've been bullish on the real estate space from the beginning of April this year. Brigade Enterprises has broken out of an inverse head and shoulders pattern last Thursday, and I think it's aiming for a fresh all-time high. A stop loss of 560 is essential here. The second one is from pharma space, Solara Active. That's also breaking out of a short-term trend line, a stop loss of 535. Two stocks that I want your viewers to keep watch on is Maharashtra Seamless. If it closes above 650, it will be breaking out of a long-term trend line and probably aim for fresh all-time highs. The other is in the in-thing active space is sugar. So Bajaj Hindustan is the other one I want your viewers to keep track. It's already broken out. The long-term is looking fantastic here. But if it's possible to pick up this around 2120, that'll be an excellent hold for the long term. I'm anticipating sugar to do what coffee and cocoa did in 2024. That is, from here on, head to something like a fresh high that aims at about 50-year high from here on. So you heard it first on CNBC TV 18. Watch out for sugar. The move is just beginning. It's shaping up for a massive move.
Sugar is setting up for a big move, right? And and the name you like there is Bajaj Hindustan.
That's right. So the main point is sugar. There's a risk here. The government can block the international prices realization to not happen within India. But the international sugar 11 futures, that's from a 12 to 18 months perspective. I'm aiming for it to cross 28. If 28 crosses, I'm anticipating it to cross 100 per pound of sugar, 100 cents per pound of sugar.
Okay, fair enough. So we'll keep this the sugar bit and we'll track it as it proceeds. But the indicative rates are, I think, slightly lower as they're coming up. On the Nifty, the indicative price is 24,330. So it's higher by about 70 odd points or so. Nifty Bank is low. Nifty Bank is lower, right? Yeah, 454, and we are at about 390. The Sensex is also lower. So 530 and 450. So there is a bit of a difference coming through, about 70 points lower on the Sensex, but the Nifty is higher by about 70 odd points or so at this point, which is not small. And remember, this is of course an important expiry to track in that sense, and we will see what how option prices etc. behave. There was anyway a bit of a spike going into 315. But that started at about 130 or so, to be fair, about a 100-point move, 120, 130-point move from 130 to 315. And at 315, we were at 24,260, and we're at about 24,340. There is, I think, 3 minutes more to the cash session where you can put in orders. So we'll see where it finally settles at. We'll take a quick break. We are back, and we don't want to miss that. So see you on the other side.
Okay, I think we have got the rates now that should come up for our viewers on the screen. The cash session has gone in favor of the bulls, and that's why, in fact, the Nifty that's the number. It's moved up by close to around 70 points just, in this cash session. So we have recovered close to around 200 points if you counted it from the time we started the show. We were trading around the 24,150. We're ending closer to around 24,340 approximately. So that's the kind of recovery that we've seen. And the options data actually will be quite interesting, because there's a big move that's come about. And now, in fact, those data points should come up for you. I think we should pull up the 24,300. Yeah, 24,300 call. It ended at around 315 at around $5. I think if we can pull that up, it's at around 35 rupees right now, in line with, going by the adjustment out there. So that's one of the big spikes that we've seen out there. The other one will be, I think, the 24,250 call. That one, in fact, the premium as well has surged out there. It's at around 84 rupees. So from 22 to around 85. It's adjusting according to where the Nifty has ended. And if you're on the right side, which you had bought calls, then obviously you're making money because the Nifty has ended way above the strike price of around 24,250 or 24,300 as well. So the expiry session goes to the bulls, and the cash session actually was the one that drove home the advantage because the Nifty ended with a gain of around 40 points, but the remaining 74 points have come in this cash session. So that explains why the premiums on the call sides have gone up, while on the put side, they've come down to surge. Okay, all right. Well, that's the trading session that we're looking at for today. It was that sort of a session where you had the Nifty that traded in the red for majority of the trading session, but we ended higher in today's trading session because of the pullback we saw in the last 60 minutes, in the last 45 minutes, and the last 15 minutes as well did go in favor of the bulls. A few stocks just to highlight. Fact was a stock that was up close to around 11% in today's trading session. Market capitalization went above Coromandel, so that's a stock that did well. Vodafone Idea, some hope out there that something could be coming about. So that stock went home with a gain of around 8%. Pine Labs was up close to around 4%. On the flip side, you had Hindustan Copper that was down close to around 7%. All Cargo Logistics as well was down close to around 8%. And some of these sugar-related names did come in for some profit taking. We will wrap up on this edition of Closing Bell, but Markets Forward comes up next. Stay tuned.
A last-hour surge lifts the markets into the green. The Nifty ends the August series on a positive note, and both the benchmark indices gaining around 0.5% each.
The government is looking to sell up to 6% stake in Hindustan Copper to mop up nearly 3,000 crore rupees. This marks the first divestment move after the first quarter earnings seasons. DPAM Secretary tells CNBC TV 18 the offer timing is opportune for investors.
Sources say Federal Bank Jana Small Finance Bank deal talks are in advanced stages, and both banks say that they are evaluating various growth and expansion opportunities. CNBC TV 18 had first reported about the merger talks in July.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear up for the next trading day. I'm Ritu Singh, and with me is my colleague Vinny Motiwala joining in from the Mumbai studio. Hi Vinny, good afternoon. Let's just kick things off with the day's market action. I mean, it was pretty choppy as expected on the expiry day, but at least we've closed in the green. So closing with gains of about 115 points on the Nifty and about 286 points on the Sensex. That's where we're at sectorally as well. If you look at metal was one of the best performers in trade today. But other than that, the PSU banking index also did fairly well by the end of the trade. Midcaps also saw some action, but on the flip side, energy and metals, those were some of the key drags on the market. But hi, Vinny.
Hi, Ritu. Absolutely. We did see that recovery coming in, especially in the last hour of trade, right? So that's what we'll keep an eye out on. The broader end of the market, like you said, mid-cap saw recovery, but small cap, we're seeing some bit of a cut, still closed with cuts of almost 0.1% of the trading session. But a lot's that's happening overall, right, in the markets as well. The monthly expiry, the weekly expiry, and we expected this volatility. So we'll break it all down for you all through the show as well, and we'll talk to you all about what's lined up on the show for you all. First up, we'll start with the top movers and shakers of the day with Vivek Iyer. Then we'll move on and talk about Federal Bank's eyeing controlling stake in Jana Small Finance Bank deal. What's the details on that front? We'll take out through that. Then Hindustan Copper's latest OFS at the first FNO monthly expiry under CAS. We'll break all of that down for you. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But on that note, let's get started with the first segment for today. And we have Vivek, who's here to take us through all the top movers and shakers of the day. Vivek, over to you.
Well, thank you so much for that. What a recovery you saw, especially as far as the last hour of the market was concerned. Clearly, the expiry ending on a very positive note. It's the first time under the CAS rule. Now, in terms of individual stocks and sectors that we were tracking, today you can't look beyond Idea and the telecom pack. Idea, one of the top FNO gainers, almost 8% higher for that particular name. Reports indicate that bank funding is imminent for this particular company. The other stocks, or the other set of stocks that are doing very well today, was the entire fertilizer pack. So names like FACT, RCF, Paradeep Phosphates up anywhere between 4 to 12% in today's trading session on very good volumes as well. The entire NBFC pack, especially in the last hour of the trading session, all of them saw a bit of a rally. So names like Cholafin, Bajaj Fin, LIC Housing Finance, all of them, especially in the last hour after languishing in the session, actually moved higher. And Laurus Labs, again, this particular stock stood out within the pharma pack, one of the top FNO gainers in today's trading session. On the other hand, quite a few drags as well. Rashi Peripherals, midday, this particular stock at one point of time was down almost 18% before making or staging a bit of a comeback. An independent director resigned and flagged significant irregularities as far as the functioning of the company was concerned. Hindustan Copper was under pressure after the overhang as far as the OFS is concerned, almost 6% of equity up for sale, down 7%. Data Patterns, one of the top mid-cap laggards in the session, down on pretty high volumes today. And lastly, IIFL Fin, the tax demand notice coming in for this particular company, kept the entire stock or kept the stock under quite a bit of pressure throughout the trading session.
All right, Vivek, thanks very much for joining in with that. Let's move on. The government has launched an offer for sale in Hindustan Copper to sell up to 6% stake and raise close to 3,000 crore rupees. The floor price for the offer has been set at 514 rupees a share. The government held more than 66% stake, remember, in the company as of the end of June. Now, we spoke to the Divestment Secretary, Arunesh Chawla, to learn more about this OFS, and we also asked him about the government's planned stake sales. Listen in.
Hindustan Copper OFS has been announced, 6%, which is 3% base and 3% green shoe. Total 5.8 crore shares are on the table today for the investors. The timing is optimal as the commodity prices are now picking up. The metal prices are picking up. And the OFS has been designed in a way that it also leaves some room for a decent room for the investors to make money and gain profits and make money from it. And the forecasts are good. The future is even better. Team Deepam has worked very hard. We are confident of meeting our targets, and we are confident of meeting our obligations to small investors.
Okay, that's the word coming in there, and seems like, the green shoe option will also be, taken into part and will come here because the subscription is already double of that. So that'll be something to watch out for. But on that note, let's bring on board our experts for today. We have Jayabala of Cash the Chaos as well as Sudeep Bandyopadhyay from Indie Trade Capital joining us right now. Thank you so much, gentlemen, for joining us on the show as always. Jay, this is the first series that we are seeing in terms with cash coming in, the expiry today as well, and seems like the Nifty's managed to close with some gains. What are you watching out for now in terms of levels? What should we keep an eye out on?
I mean, I'd point out to 24,100 to 24,050 being a crucial support for the Nifty. The markets last week came into that zone and it's returned higher from there. So that is giving some positive signal, but it's not a convincing signal yet. But if the Nifty were to close about 24,500 or 24,500 to 24,800 zone, that will be a big positive and tell us that the bullish trend that I've been anticipating for quite some weeks, that is already set in. And we can expect a very fast move to come in for the Nifty. So holding last week's low is very important. And just as the markets were closing today, crude had dropped sharply. So that's a positive. And that decline is coming from an important trend line from the April highs. So there are cross markets positive that are perking up, but we need to see further action from the market.
Got that. Sudeep, coming on Hindustan Copper, I mean, of course, today the stock was under pressure, but, do you see some opportunity here, some near-term upside?
Well, definitely from a retail perspective, I think tomorrow the retail will get a chance to subscribe. And I think it is a good opportunity, and retail should come in and apply and try and get a piece of this divestment. It's a good company. The business cycle is right. Demand for copper is continuously increasing, and it will continue to increase with the current gadgets and current technology, the way they are adopting copper. So I'm pretty confident on Hindustan Copper, and I think it's a very good share to own or acquire even at current levels. And of course, for retail, they get a discount, further discount. I think it's a good buy for them.
Okay, point taken there, Sudeep. But let's move on and talk about a couple of other names now. This is CNBC TV 18 exclusive. Sources have told CNBC TV 18 that Federal Bank is looking to acquire a controlling stake in Jana Small Finance Bank. Both stocks were under pressure in today's trading session. Sudarshan is here to give us more details on the potential deal here. Sudarshan, over to you.
So an interesting deal is brewing up in the Indian banking space, and we understand from sources that talks between Jana Small Finance Bank and Federal Bank are in advanced stages, and if the deal fructifies, Federal Bank will end up acquiring controlling stake in Jana Small Finance Bank. Now remember, last month, in the month of July 2026, Jana Small Finance Bank had disclosed to exchanges that it's looking to monetize. Basically, promoter is looking to pay its stake in the company, and as of June 30th, its stake was around 16.9% after the promoter had sold almost 5% stake in Q1 FY27. Now, what is the reason of promoter looking to pay its stake? So the reason is promoter, that is Jana Holdings, owes rupees 700 crore to TPG Asia, and for which the payment due was June 30th, 2026. After that, there was an agreement between promoter, that is Jana Holding, and TPG Asia, and because of that, TPG Asia decided to roll over the payment date to December 31st, 2026. So there is still time for Jana promoter to sell the stake and pay to TPG Asia. Now remember, just last week, Federal Bank has got the board approval to raise up to $500 million via bond. And now we understand from sources that Federal Bank may use the proceeds to acquire the stake in Jana Small Finance Bank. We had written to both Federal Bank and Jana Small Finance Bank. They have disclosed to exchange, they have responded to our query, and both the banks are saying that for growth and expansion, they keep evaluating opportunity.
All right. Thanks very much, Sudarshan, for joining in with that. Let's move on. And the first monthly F&O expiry under CAS also saw a sharp last hour move with the Nifty gaining about 70 points between 3:15 and the close. Let's get a quick read on all of the action, and Nigel is standing by for that.
Well, that's right. The monthly expiry actually went in favor of the bulls, and you saw a bit of a surge in the last 45 minutes ahead of the CAS session. And in the CAS session, after the Nifty moved into the green, the Nifty as was up close to around 40 points. But we went on with further gains because in the CAS session itself, the Nifty went ahead and put on further weight. It was up close to around 74 points or thereabouts. Even the Nifty Bank, well, that as well pulled back some of its losses. So because we had a pullback between 2:30 and 3:15 p.m. and between 3:15 as well as 3:30, which is the CAS session, that's why the Nifty ended with good gains. When you see that sort of a recovery, the call buyers, obviously they had a blast. So just to give you a couple of data points, the 24,300 call at around 3:15, it was just around 5 rupees. So those that bought actually that for around 5 rupees, they went on with around 35 rupees. The other one is around the 24,250 call. Out there, the premium was close to around 22 rupees. But by the time you saw the close, then it went from around 22 rupees all the way to around 84 rupees or thereabouts. And obviously, the put premiums collapsed because the direction was up. So, all those put buys as well, they didn't get anything. In fact, it came down to zero. So, the monthly expiry went to the bulls, particularly the final hour, the 45 minutes plus the additional 15 minutes, both of them favor the bulls. And that's where the call buyers had a bit of a blast.
Surely, Nigel, they did have a bit of a blast, but thank you so much for breaking it down for us as well. On that note, let's go across to Sudeep also, just to understand a couple of things in terms of what Sudarshan was talking about. Federal Bank, Jana Small Finance Bank. Sudeep, are you looking at any of those?
Well, Vinny, Federal has been one bank which we have liked for quite some time. Look, I think this is a good thing to have happened if Federal Bank acquires Jana. Jana wanted to become a universal bank. For some reasons, RBI had turned down their application. The promoter needs to exit and discharge their obligation to TPG. So the sale, they have to sell their shareholding. Instead of selling piecemeal and the shareholding getting spread all across, if Federal Bank comes and acquires stake, I think it will be good for the overall industry, good for Federal Bank, and of course, Jana eventually will get merged with Federal Bank. We have to look at the value at which Federal Bank acquires Jana stake and the public offer comes before we decide whether the merger or the transaction is good for the shareholders of Jana and Federal Bank or not. But from an industry perspective, this is a good transaction. Also remember that Federal Bank's book, particularly in the automobile financing, two-wheeler financing, that space, I think, and as well as low-ticket housing financing, I think these are the spaces where Jana was good and Federal Bank wanted to expand their book. So Federal Bank will definitely gain and through this acquisition.
Well, most definitely, Sudeep. Of course, that granular book, the PSL heavy book, all of that helps. Vehicle is the biggest gain perhaps for Federal, but also the geography expansion. So all of that seems to play out well in their favor. We'll have to see if and when this deal fructifies. But let's move on. We had the shares of TCS rising in trade after it struck a deal to acquire MHP, Porsche's management and IT consulting arm, for about $373 million. Speaking to CNBC TV 18's Reema Tendulkar, TCS CEO K. Kriti Vatsan said that the acquisition will be EPS accretive from the first full year. Take a look at what he had to say.
The margin is somewhere in the range of about 10%. And also you need to keep in mind, MHP is operating completely at on-site. Now, when we are able to bring in TCS offshore capabilities, so there is a lot of headroom for margin improvement. See, we believe like there could be about 50 to 60 bips margin dilution at the TCS level for the maybe in the short term, and then we will be able to bring in the usual margin improvement measures of TCS and achieve the margin. As I said, we are looking at it more from what we get from as a transformative initiative. Okay, and eventually it will be value adding for both the organizations. I would expect like at least by year-on-year growth of at least double-digit growth from synergy should come in. And so maybe 3 years down the line, like I would definitely challenge the team to make it $1 billion business.
Okay, that's an interesting one coming in from TCS over there. But Jay, what's your thought coming in on TCS? Any of the other IT names that you're looking at?
Yeah, TCS is a bit confusing for me. In fact, that's probably the reason why the whole Nifty IT index is confusing. Because the decline from May 2026 to July 2021 doesn't look like a convincing low, but whereas the July low to the August high is looking quite bullish. So, so in that confusion in place, I'm avoiding the large cap IT for now, but I'm more bullish on another Tata name in the IT tech space, that is Tata Technologies. And I've been bullish for quite some weeks, and it's run up quite so well. So I would still continue to maintain that stance, but I would wait and watch. If TCS can manage to hold about 2160, maybe I would turn bullish on TCS. Because that is a possibility to interpret this bullishly. So watch 2160 as a very important support for TCS.
All right. Sudeep, would you have a view? And, it's not just this deal. That H-1B news coming back in again to haunt the sector. Still a proposal, but some near-term headwinds, Sudeep?
Well, I think, Ritu, for a minute, if I want to talk about the deal, I think it's a good deal from a TCS perspective. Remember, this is not a captive unit. Of roughly about 40% business comes from Porsche and the Porsche group, Volkswagen and others. And 60% comes from other automobile manufacturers. So this gives a fantastic entry to TCS into automobile manufacturing segment in Europe. So this should do well in the long term. Medium term, short term, I think there will be some margin dilution. But I think they need to do these kind of deals to scale up quickly and get into newer segments. So I kind of give thumbs up to this deal. As far as overall sector, I think there are plenty of headwinds at this stage. So I will not recommend a buy in the frontline IT companies. Some niche IT players can be looked at. But again, I think overall IT is an avoid at this stage.
All right, Sudeep and Jayad, both of you, thanks very much for joining us on the show today. As always, appreciate your time and your thoughts. And on that note, we're going to slip into a short break, but when we return, we'll get you the top corporate voices along with the key market events to watch out for, so stay tuned.
Welcome back to Markets Forward on CNBC TV 18. Now let's take you all through some of the top corporate voices that we have through the day. And first up, IIFL Home Finance is facing a tax demand of 963 crore rupees, but the company expects favorable relief coming in on the appeal. Now speaking to CNBC TV 18, the company said that it expects the demand to be deleted at the first appellate authority level, with the outcome likely in 6 months to a year.
And Ratnamani Metals and Tubes is targeting up to 100 crore rupees in dispatches this year from a nuclear export order, with long-term margins expected at around 30%. Speaking to CNBC TV 18, the company said it has cut the FY27 revenue growth guidance to 10% from 20% earlier, as demand in its core business remains muted.
Okay, those were the top corporate voices. But before we wrap up this edition of Markets Forward, let's go across to Ria, who's waiting by to tell us the key events to watch out for in tomorrow's trading session. Ria?
Well, yes, first on the global front in the US, we will have the core PCE price index as well as the sequential GDP growth rate that will be in focus. And also in the US, we have some key earnings to watch out for. There's NVIDIA, CrowdStrike, Salesforce, as well as Synopsys that will be releasing their quarterly results. Back home in India, keep an eye on Moltech Packaging as the board holds a meeting to consider a bonus issue. The OFS of Hindustan Copper will also remain in focus as retail investors as well as eligible employees will be bidding on the 26th of August. And in other news, the UN Security Council will be holding a meeting to discuss the ongoing situation in West Asia. India's Commerce Minister Piyush Goyal will continue his trip in Japan from the August 24th to 27th. And Finance Minister Nirmala Sitharaman will be on an official visit to Canada and the US from the 25th of August until the 2nd of September.
All right. Thanks very much, Ria, for joining in with that. And on that note, we've come to an end for this special edition of Markets Forward. Vinny and I take your leave. But stay with us. We'll be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening. The U.S. launches Operation Economic Outcast, threatens severe sanctions against countries maintaining economic ties with Iran. Tehran says it is fully prepared to counter the sanctions. Iran's largest trading partner, China, says economic warfare and pressure tactics will only fuel the conflict. Washington sanctions 4 Indian companies and 3 Indian nationals for their alleged role in Iranian petrochemical trade. Rice, tea and pharma exporters face more uncertainty after the UAE snaps economic ties with Tehran, cutting off a key transshipment route. Many Indian traders exploring Turkey as an alternate payment channel. A late rally lifts Dalal Street. The Sensex and the Nifty hit the highest level in the last 2 months. Rupee gains more than 30 paise against the dollar today. TCS shares rise after securing a $1.5 billion AI deal with Porsche. CEO Krithivasan expects to scale revenues from Porsche's IT subsidiary to $1 billion after acquiring it for $370 million. The U.S. government proposes a new fee of more than $103,000 on H-1B visas, which are widely used by Indian tech workers. This comes just months after a federal court struck down President Trump's executive order imposing a $100,000 fee on the same visa. Federal Bank is looking to acquire a controlling stake in Jana Small Finance Bank. Sources say a deal is likely in the advanced stages. Both banks say they are evaluating various growth and expansion opportunities. CNBC TV 18 had first reported about merger talks in July. The government's offer for sale for Hindustan Copper is fully subscribed. Hopes to raise nearly 3,000 crore rupees from the 6% stake sale, taking the mop up for this financial year to more than 55,000 crore rupees. DPAM Secretary is confident of achieving the full year target of 80,000 crores. Food giants revise their packaging after the food regulator cracks the whip on misleading claims. Absolute terms like 100% pure, natural, pulled off labels of several products. FSSAI says it has issued over 150 notices to companies over alleged violations in the past few days. And India's unified payment interface turns 10. UPI transaction volumes are up a staggering 13,000-fold. Transaction value has seen a compounded annual growth rate of almost 200%. Well, let's go straight to the top story this evening. The U.S. has launched a new wave of sanctions against Iran and warned countries and companies that still do business with Tehran not to do so. Iranian officials have hit back, saying they are fully prepared to deal with these measures. Here's what the Trump administration has announced. Now, in a press conference overnight, U.S. Treasury Secretary Scott Bessent unveiled sanctions under the name Operation Economic Outcast. Now, Bessent claimed that Washington has mapped, in his words, every node, every facilitator and every network that Iran has used to smuggle oil and evade sanctions, end of quote. As part of the U.S. effort, Washington has identified over 60 entities that it claims enable the Iranian regime to procure nuclear and missile technology, earn revenue from oil trade and carry out cyber operations. The U.S. has threatened to sanction Iran's trading partners but has not imposed a timeline for compliance. U.S. Treasury Secretary Bessent said U.S. President Trump is making calls to world leaders, urging them to stop doing business with Iran. Now, Iran is playing down the impact of the U.S. measures. Iran's economy minister said neither China nor Russia have accepted the U.S. measures and predict that other countries would also resist them. Here's Scott Bessent on the new economic measures that the U.S. has announced against Iran.
The president is making phone calls to world leaders with specific requests to cease their interactions with the regime. We are already seeing results. No one is above the reach of U.S. sanctions. That if they facilitate transactions and are part of the ecosystem that turns Iranian oil into money, into repression, they will be targeted.
Well, that is the U.S. Treasury Secretary on Operation Economic Outcasts. But crude oil prices have actually declined in trades as investors appear to shrug off the new U.S. sanctions on Iran. In fact, many brokerages view the economic pressure poses less risk to oil supplies than a military escalation. So how will these new sanctions impact Iran? The answer does not lie in Washington or Tehran, but in Beijing. Aishwarya is standing by to explain. Aishwarya.
With its latest round of sanctions under Operation Economic Outcast, the US is threatening what it has called an economic asphyxiation of Iran. However, how this works out depends less on Tehran and more on Beijing. The US has immediately sanctioned 60 individuals, companies and vessels and identified 5 sectors that it's called the vital lifelines of Iran. These are digital assets, technology, gold, shipping and aviation. It's also targeting those supplying Iran's military and missile program. But the larger move here is the threat of secondary sanctions against countries and institutions that continue to do business with Tehran. Washington is not imposing these penalties across the board just yet. Bessent said that countries are first being approached with what he called quiet diplomacy and given time to shut down identified activities in a given time frame. The biggest test here will be China. Beijing is Iran's largest trading partner, buying upwards of 90% of Iran's crude. It's also reported nearly $10 billion in bilateral trade with Iran in 2025, excluding an estimated $31 billion in unreported Iranian crude purchases. That makes China Iran's most important economic lifeline. Previous US attempts to disrupt oil trade have created some difficulties, but they have not been successful in stopping the flow of Iranian oil into China. This time too, Beijing has rejected the measures as illegal and unilateral sanctions, with its foreign ministry saying that economic warfare and maximum pressure tactics fuel conflict and disrupt global and economic financial order, and insists on calling for de-escalation and dialogue. Asked whether China could face secondary sanctions, Bessent said that no country or entity was above or beyond Washington's reach. However, the US has not yet targeted major Chinese financial institutions. Separately, however, Bessent did say that a major financial institution could be sanctioned later this week. Iran, meanwhile, insists that it was expecting these sanctions and is prepared. Iran's economic minister Ali Madanizadeh said that Tehran has drawn up a 2-year plan to manage the country's economic affairs and said that Americans have done all they could to test Iranian patience, but have repeatedly failed to do so. So, Operation Economic Outcast may not just be a new confrontation between the US and Iran, but it's also likely to test how far the US is going to push China. And this is going to happen just weeks ahead of President Xi Jinping's expected visit to Washington.
Absolutely. That is going to be crucial, Aishwarya. Many thanks for joining us. So what exactly do the US sanctions mean for Indian exporters? Santya is standing by to explain. Santya, what's the likely impact on Indian exporters?
So the US claims it has targeted 60 Iran-linked entities, individuals and vessels across Iran's nuclear, cyber, missile and oil networks. And importantly for India, 4 Indian entities figure in this list. Gujarat-based Poti's Partners, Faridabad-based PP Softech, Karwar-based Prakriti's Infra Impex and Delhi-based Sadashiv Overseas. All 4 are linked to trading in petroleum and petroleum products. 3 Indian nationals linked with these entities have also been named. But the bigger concern for India is the impact on the wider India-Iran trade. India's trade with Iran stood at around $1.63 billion in 2025-26 up to 25th of August, with exports at around $1.26 billion. This comes at a time when Indian traders have already started facing the payment intermediary challenge. India has been using the UAE as an intermediary for India-Iran trade, with payments from Iran routed through the UAE to Indian traders and vice versa. But the UAE suspending trade activities with Iran last week, traders say this route is now under pressure. Many are already exploring Turkey as an alternative. The second challenge is logistics. Indian exporters fear shipments to Iran could increasingly have to be routed through another country if that country agrees to act as a transit destination. Turkey, once again, is one option which is being explored. But that could significantly increase both travel time and costs. Industry estimates suggest the overall travel time could increase 3 to 4 times, with the route potentially involving the Red Sea, Turkey and then land transit into Iran. And this is particularly important for rice traders. Rice remains one of India's biggest exports to Iran. India exported rice worth around $810 million in 2025-26 and around $383 million in the first half of 2026. Tea is also an important trade commodity between India and Iran. In 2025-26, India exported tea worth $52 million to Iran. With the US widening the sanctions on Iran, exporters are facing more uncertainty now.
Yes, that certainly is the case. Santya, many thanks for joining us. That is the impact, or the likely impact, of economic outcast on India and its exporters. Let's talk about the markets now. The Wall Street ended the August F&O series on a positive note, with the Nifty gaining about 1.5%. And this was the first monthly F&O expiry since the new closing auction session was introduced. A last hour surge today lifted the Nifty, closing about 115 points higher, 0.5% gain there. Reliance Industries up by about 0.5%, as was ICICI Bank. So that took the markets to the high point of the day. That is the kind of uptick that we saw for our markets this afternoon. But let's talk about a CNBC TV 18 exclusive. Shares of Federal Bank and Jana Small Finance fell in trade today. This after CNBC TV 18 reported that a deal between the two is likely to be in advanced stages. Sources say Jana SFB's promoter is likely to sell the entire 16.9% stake to Federal Bank, triggering an open offer. Sudarshan is standing by with the details. So take us through the likely contours of this proposed deal, if at all it does go through, and what are both Federal and Jana saying?
So an interesting deal is brewing up in the Indian banking space, and we understand from sources that talks between Jana Small Finance Bank and Federal Bank are in advanced stages, and if the deal fructifies, Federal Bank will end up acquiring controlling stake in Jana Small Finance Bank. Now remember, last month, in the month of July 2026, Jana Small Finance Bank had disclosed to exchanges that it's looking to monetize. Basically, promoter is looking to pay its stake in the company, and as of June 30th, its stake was around 16.9% after the promoter had sold almost 5% stake in Q1 FY27. Now, what is the reason of promoter looking to pay its stake? So, the reason is promoter, that is Jana Holdings, owes rupees 700 crore to TPG Asia, and for which the payment due was June 30th, 2026. After that, there was an agreement between promoter, that is Jana Holding, and TPG Asia, and because of that, TPG Asia decided to roll over the payment date to December 31st, 2026. So there is still time for Jana promoter to sell the stake and pay to TPG Asia. Now remember, just last week, Federal Bank has got the board approval to raise up to $500 million via bond. And now we understand from sources that Federal Bank may use the proceeds to acquire the stake in Jana Small Finance Bank. We had written to both Federal Bank and Jana Small Finance Bank. They have disclosed to exchange, they have responded to our query, and both the banks are saying that for growth and expansion, they keep evaluating opportunity.
All right, so many thanks for joining us. That's the CNBC TV 18 exclusive. Now, the government's offer for sale in Hindustan Copper saw strong demand. The offer to sell up to 6% stake was fully subscribed within a few hours. The stake sale is likely to fetch the government close to 3,000 crore rupees. With this, the disinvestment mop-up for this financial year will cross 55,000 crore rupees in just the first 5 months. Speaking to CNBC TV 18, DPAM Secretary Arunish Chawla says he's confident of hitting the budget target of 80,000 crores.
Since Government of India has around 27.9% stake, I know they are not a promoter entity, so there's a possibility that Hindustan Zinc could be the next asset that you're looking at.
Not immediately, not at the moment.
Target for this year is around 80,000 crores, right? In terms of a divestment target.
Yes, please.
You think you get there, or is that? Do you think a more realistic number will be a little bit lower?
Team DPAM has worked very hard. We are confident of meeting our targets, and we are confident of meeting our obligations to small investors.
Well, that is the DPAM Secretary. Now, TCS will acquire 100% of MHP, that's Porsche Management and IT Consulting arm, for $373 million. The acquisition will strengthen TCS's manufacturing, automotive and AI capabilities. It would also help the company expand its footprint in Germany and across Europe. Speaking to CNBC TV 18's Reema Tendulkar, TCS's CEO K. Krithivasan said the acquisition would be EPS accretive from the first full year, adding that the long-term aim is to scale MHP's revenues to $1 billion. Take a look.
I would expect, at least by year-on-year growth of at least double-digit growth from synergy should come in. And so maybe 3 years down the line, I would definitely challenge the team to make it $1 billion business.
Well, that is TCS on the deal just done. The Trump administration has proposed a fee of over $103,000 on the new H-1B visa. Trump's earlier attempt to impose a $100,000 fee on select H-1B visas was struck down by a U.S. federal judge citing illegality. Remember, Indian IT professionals and companies account for a lion's share of H-1B visas. Reema is standing by now to take us through the details. Reema, this is a proposal at this stage, but tell us more about the implications if this were to go through.
You're right. Once again, a $100,000 H-1B visa fee has been proposed. It's a proposal right now. There is a 30-day window for public comments to come in, but the proposal of a $100,000 H-1B visa fee is back on the table. If you remember, it was there even in September of last year. So the first question I had was, isn't this already there? Because the Trump administration last year in September had proposed a similar thing. But at that time, it was struck down by the courts. They said it was not, they needed a congressional approval, and therefore that appeal in front of the court was struck down. So as of now, there is no $100,000 H-1B visa fee, but the proposal to bring it on is back on the table. But this time they're adopting a different route, through the executive route rather than the legislative route. By doing so, they don't need the congressional approval, but the court can still come in and give its opinion or strike it down. But what it does create is a lot of uncertainty. This is the second time this proposal of a very large H-1B visa fee has been proposed. One, it's the size of it. Employers are going to think twice on whether they want to pay. They want to bring on a person who's on an H-1B visa fee. Is he worth it? Do you want to pay that $100,000 extra for him? But even for many of the Indian students who go abroad to study to US universities, and then they work on that OPT program and then eventually start working there on that H-1B visa, this is creating a lot of uncertainty. So in that sense, it's negative. So we don't know for now whether it's going to go through. There is a 30-day window, but it's back on the table and it's creating a lot of uncertainty.
Rima, many thanks for joining us. Food giants rework their packaging as the food regulator, the FSSAI, cracks down on misleading claims. Terms like 100% pure and natural are being dropped from labels after over 150 notices went out to companies. That and more when we return. Several food giants have revised their packaging after food regulator the FSSAI cracked the whip on misleading claims. The FSSAI has issued over 150 notices to companies over alleged violations in the past few days. Rachna is here with that and more. Rachna, which companies have relabeled their products after the FSSAI cracked the whip?
Well, you know, India's entire packaged food industry is right now in the middle of a labeling overhaul, and it's happening pack by pack. The claim 100% is being withdrawn across categories. So Amway has removed it from its coconut oil. Imami has revised the claim on Zandu honey. Bon Biscuits, Juza Foods and Master Chow have taken it off packaging and advertising. So it isn't only purity claims that the FSSAI had an issue with, but also let's look at PepsiCo's new Sting cans that no longer carry the word energy. Heritage Foods has dropped fresh from its paneer packet. The Whole Truth has changed no added sugar claim to sweetened with dates. Behind all of this is a shift in how FSSAI is reading the law. A food label is not advertising copy, it is consumer information. If a claim can't be proved scientifically, it can't be printed on the pack, and the regulator has now extended that logic to alcohol as well, with United Spirits and Inbrew getting notices over flavouring and age declarations. But not everyone is falling in line quietly. Dabur has 7 products barred from sale, including honey, ghee, apple cider vinegar and coconut oil, and is taking legal advice even as it strips these claims off its website. United Spirits has moved the Bombay High Court. Red Bull and Monster have made no visible pack changes yet, with the 90-day energy drink deadline running down. The precedent for all of this was set last year with ORS drinks, where the courts backed the regulator and refused companies even a sell-through of old stock. For the industry, that is the real signal. Marketing language that survived for decades is now a compliance risk, and the cost of rewritten label is far smaller than the cost of a product being pulled off the shelf.
All right, Rachna, many thanks for joining us. Now, India's Airport Economic Regulatory Authority has cut the user development fee for domestic passengers at the Hyderabad airport. This comes just days after a similar cut at the Bengaluru airport. The regulator has now implemented a new tariff framework. Madhya joins us now with the details. Madhya, typically it is higher UDF charges, which means that impacts consumers like you and me. But this time around, it's actually good news for passengers. Will we see more UDF cuts coming in for other airports too?
Possibly, yes, because that's the model that ERA wants to follow now. So higher user development fees or UDF have increasingly become a concern for air passengers as it adds to their airfare. The UDF has also evolved from charging just departing passengers to charging arriving passengers as well. And then came differentiated UDF, with Delhi becoming the first airport to charge international business and economy passengers differently. So now ERA has changed the tariff playbook, and under this model, it has reduced the UDF at Bengaluru and Hyderabad airports that you mentioned. And I'll explain why they've done that. So airports have large capital expenditure plans, new terminals, runways, aprons, and other infrastructure projects. Now, these investments form part of an airport's aggregate revenue requirement, or ARR, the revenue that the airport is allowed to recover through charges like the UDF. Now, ERA is moving from a model where airports recover projected costs upfront through passenger tariffs to an approach where passengers pay when that infrastructure is actually ready for use. So this is also reducing the risk of over-recovery if projects are delayed or not executed. Now, last week, Bengaluru was the first airport to come under this new approach. ERA reduced the domestic departure UDF from 550 rupees to 300 rupees, while international departure UDF is reduced from 1500 rupees to 997 rupees. And today, Hyderabad is the second airport to follow this model. The airport had sought an aggregate revenue requirement of 27,850 crore for the 2026-31 control period. ERA approved a baseline ARR of 11,600 crore, and that has translated into lower UDF for departing passengers, with domestic UDF falling from 750 rupees to 515 rupees and international UDF falling from 1,500 rupees to 1,030 rupees. The important point here is that airports' future infrastructure investment has not disappeared. What has changed is when passengers pay for it. In Hyderabad, for instance, future projects including the Northern Runway have additional tariffs attached to them, but those additional charges will kick in only after that respective assets are completed, commissioned and put to use. So the principle is simple here. Passengers should not pay today for infrastructure they cannot yet use.
Well, that is important and certainly is good news for consumers. And this is something that I had spoken to Indigo's CEO Rahul Bhatia about. And this is something that they were concerned about, the higher UDF charges and what that was doing as far as ticket prices are concerned. Now, Mumbai's airport braces for a major reshuffle. 1 in 3 international flights from Terminal 2 will shift to the Navi Mumbai airport starting October. According to an email accessed by CNBC TV 18, some domestic traffic from the older Santa Cruz terminal will move to T2 to compensate. Adani-run Mumbai Airport will also begin demolishing part of Terminal 1 from January 15th next year. But with that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta and the festive season is here and so is India's love affair with precious metals. But will gold and jewelry demand accelerate this festive season? We'll have to wait and watch. Before we get our guests to give us their outlook, let's first take a look at where gold prices are positioned right now. It's safe to say that the gold is heading for its best month. The prices have seen a sharp rally this month and they are currently hovering near 3-month highs at around $46.50 an ounce. So what's driving this sudden move? Well, gold was already finding support from rising geopolitical tensions in West Asia and then higher crude oil prices. But now fresh triggers have added to the momentum, including liquidity support in US markets and continued strong buying by the global central banks. So what does road ahead look like for gold in 2026 and 27? Forecasts remain widely divergent. JP Morgan sees gold heading towards $6,000 an ounce, while ING's target is closer to $4,600 mark. So is there more room for gold to shine, or are precious metal prices already pricing in a best case scenario? To discuss this, we are joined by Nirmal Bang Securities Kunal Shah, Anand Rathi Shares and Stockbrokers Naveen Mathur, and Kedia Advisories Ajay Kedia. Also joining us on the show is Pro IntelliTrade Services Dinesh Somani. Gentlemen, hi, thank you so much for joining in. And the month of August clearly has been very, very positive, with gold prices up by nearly 17% and silver is up by 23% as well. Some profit taking on the higher side, but then again, we are looking at 3 weeks of constant gains and multi-month highs for many of these commodity prices. Let me come to you first, Naveen. And how are you looking at the gold prices to begin with? Let's divide this conversation. Let's talk about gold first and silver later in the second half of this show. I'll start with gold first. How are you looking at these current 4,600 kind of levels, 15 to 17% of gains in the month of August? Would you say it is sustainable as we get into September?
Thank you very much, Manisha. And thank you for having me on the show after a long time. It was a long break on the show. So I think very relevant question, as you started off talking about the festival season. I would say that there were a couple of fundamental factors which have seen the rally from the lows of less than $4,000 per troy ounce, currently at around $4,600 to $4,700. Let's talk about why the gold prices have moved downside over the last couple of months. One was definitely the dollar index, which was appreciating. At the same time, the dollar-denominated commodities, therefore, their values decreased. Therefore, the gold prices touched the lows of around $3,700 to $3,800 levels too. The dollar index was gaining strength. It did hit a, I won't say record high, but a high in the recent years at around 101.64 on the 28th of July. So I would say many fundamental factors were pulling down the prices of gold from the highs of 5,600, which we saw in January last week. So I would say, the dollar, I would say appreciation, the hawkish stance expectations from the central banks because of the geopolitical risks. The crude oil prices were moving up. They did touch $100 barrels plus, both the Brent and the WTI. So I would say all of these factors were negative for gold, in spite that it's an inflation hedge. But the other fundamental factors were taking a roast on the inflation hedge positions. So therefore, I would say those were the factors which created a downside pressure on the gold. But recent rally is again, we have seen what you have said is absolutely right. We are 7% plus on the international markets as far as the gold prices are concerned for this particular calendar year. And we are around 4% plus on the MCX gold. So I would say that largely it is the Federal Reserve stance, the dollar index stance. I would also say the US fiscal and the currency debasement concerns are surging back into the markets, and that's also pushing up the prices, what we have seen over the last week or so. So I would say these changes are largely dependent upon how the markets, how the fundamentals behave in times, or I would say in certain weeks to come. But largely, Manisha, it would be around 4,600 to around 5,200 levels, which I feel in the immediate to the near term, where the prices should consolidate on the basis of the dollar index and the Central Reserve policies.
All right, so another bullish view coming in then, $4,600 to $5,000 an ounce is what we could be looking at. Well, yes, Naveen, you mentioned that it's been a volatile year. We've seen all-time highs, we've seen a sharp dip and then buying come back yet again into the markets. Kunal, hi, we've recently spoken and you mentioned on how bullish you are in gold and silver both. But gold first, and what's your sense? At these current levels where we have seen 15% of gains already for the month of August, would you still advise a buy?
Yeah, I would still be a buyer in this market. Most of the people have missed out on this rally. So I believe that going forward, the trend from here is definitely going to be bullish. Key factor to watch out for, most of the money managers have remained underweighted on gold after the kind of downfall what we've seen from $5,400 to almost $4,000. And post that, what we are seeing is unprecedented level of debt and unprecedented level of rise in bond yields. So these two factors makes me believe that the Federal Reserve has to, no matter what, Federal Reserve has to has to debase the currency gradually, and hence there is a strong case for holding on to the to the precious metals and or other commodities. So I believe that commodity has more wings to fly, and I believe that from here gold should continue to move up with the bouts of volatility, with the bout of ups and downs. The trend is directional view from here is bullish, and we have done an upward revision to our targets to $5,200.
$5,200 an ounce, a possibility as well. Well, absolutely. The kind of world or scenario that we are in right now, there is no reason to go short for sure. Of course, buying on dips continues to be a strategy there. Mr. Kedia, what's your sense? How are you looking at gold prices? What is your justification to keep buying?
First of all, golden evening. 2026, we have started with a weakness. We have seen a tremendous fall in gold prices as the factor was overdue. But now, second half is going to be a very, very fiery. We can see 5,100 by this year end only. As central bank continues to add, and important was the interest rate scenario. As we have already spoken on interest rate, now September seems to be with a no rate hike, and maybe possible in December also we see no rate hike in from the US side. Important one more thing will be the dollar bond buying program, and also the dollar is trading very well below 900 level marks. Physical demand from India and China is going to be very strong. And also, as Kunal rightly pointed out, financial players were actually reduced their position in first half, but now they are back in the market. So I think there could be a fiery jump in next 6 to 8 months. Why I'm telling 6 to 8 months? Because the same pattern has been seen in 2008, 2022. Whenever crude prices gain beyond $100 mark, initially for 6-7 months, prices generally for gold correct, and afterwards bull run starts. So this time we expect by December itself we can see a 5,100 level mark, but maybe possible by next Diwali we may cross 6,000 level mark also. So I am very much bullish on gold. In fact, recently we have seen gold silver ratio that has given a very good breakout. So I think gold from current level also it is very attractive and may test 5,100.
All right, 5,100, 5,200, 5,000. Mr. Somani, we've heard all of those figures there. So 5,000 seems like an absolute possibility. Are you in the same category where you also believe that the gold prices can go much higher?
Was there actually. So we've seen a high of $5,600 and a dip towards $3,940 and a sharp rebound of 17% in last 35 odd candles. So a sharp recovery, a good recovery. The major resistance was 41.40, that breakout, and we have seen $4,700 right today. Again, the reasons remain the same, which everyone spoke about: the central bank buying, the dollar index, and the bond buying by the US government, long-term bond buying. So these are all the reasons. Beside these, the amount of money that is getting infused in ETF is also an added advantage right now. Overall, I see a support at 45.10. There could be a dip of 2-3% from here. I say 45.10 should be the best investment levels for the investors as well as for the traders. Upside I see by Diwali, $51.20 mark.
All right, so buying gold is an absolute thing to do right now. We've seen the prices gain up quite strongly from its lows that we saw in the month of July at around 39.70 or so. But from there, it has been a very strong rise in last 45 days. And all our experts believe that the rally or the momentum just about could perhaps continue. And these are good times to buy in case you were planning to invest or buy during this festival season. But the run-up in gold also has spilled over to silver. And that's exactly what we will be talking about after this very short break. Welcome back, and you're watching Commodity Champions. The rally is not limited to gold alone. Silver too is surging. The white metal has seen a sharp move higher this month, hitting around 2-month highs. So what's driving the rally? The recent boost to liquidity in the US markets has given precious metals a fresh leg up. But silver also has some strong structural tailwinds of its own. The global silver market is expected to remain in deficit for a 6th straight year in 2026. And demand from new age industries, including data centers, AI-related technologies, and the automotive sector, continues to support the longer-term story. And then there's India. As one of the largest consumers in the world of silver, Indian market is heavily dependent on imports. The higher global prices combined with policy changes and higher import duties can add further pressure to domestic prices. So with supply constraints, strong investment interest and structural demand all in the mix, where is silver heading next? Well, let's take a look from our guests on the same as well. Mr. Somani, let me come to you first. And what's your sense also on silver? Because for the month of August, if gold is up 15%, silver is up by 22% as well. We've come all the way from $54 to almost $70 for this month.
Indeed, a very sharp recovery. And we have always seen silver to be too volatile. We have seen last year, we have seen this year. prices moved up from almost $50 to $120 and back again to $55. So I think the volatility is going to continue, but since we are already 50% from the highway mark, we see a sharp recovery in line with gold as well here. I think $64-65 should act as a good support from here onwards. Upside potential, we see at least minimum $83 and up to $88. So from here onwards, we see a move up close to 23 to 25% till Diwali.
Mr. Somani, would you favor silver more than gold?
Manisha. So I won't prefer anything about gold.
All right, gold it is then. Kunal, how are you looking at the silver prices from here on? Are you also anticipating that before we end this year, it's going to be another 20% of gains?
Yeah, so if you ask me, $75 to $80, that seems quite realistic. But we have the headwinds from the demand side, especially from the photovoltaic sector, where 2026 is the year where the demand for the PV cells are expected to decline by 15 to 18%. So this was one of the major catalysts, when silver prices tested 4 lakh rupees. At that time, the solar demand was at its peak. And after the kind of abrupt move what we saw, so I think net annually the demand of PV, which is the major demand growth driver, is likely to be little timid. And after the humongous run rate from last 3 to 4 years, so that is slight negative. So that's the reason why we are not expecting any major alpha to be delivered by silver as compared to gold. So whenever historically we see the bull run in bullion, silver tends to outperform gold, and I don't believe that that's going to be the case from this point onwards. So $75 to $78 on the upside looks very realistic, and maximum $80. I do not see silver trading below $80 until there is any major $3-4 trillion stimulus which US is throwing up. Otherwise, $78 to $80 seems the maximum upside. And supply side, we have not seen any significant improvement in terms of the silver supply after this kind of humongous bull run. So the reason why silver is holding on to these levels is because the supply side, even though where we've seen some moderate increase, but the sharp increase has not been witnessed. So we believe that now $60 will act as a strong floor, and $75 to $78 is what one should expect silver to perform.
That point is well taken. So more gains coming in for silver, and apart from industrial, it has been the investment demand that we saw in 2025, which took silver to those dizzying heights there. But Naveen, what is your sense? And are you favoring silver over gold or vice versa? But to be to the point, where are you looking at silver prices before this year ends?
Manisha, just a point to be added for gold. The number 47 tons of ETF buying has happened recently. In value terms, this would be approximately $6 billion US. So for gold, the gold ETF particularly is seeing the investment demand picking up. And that is also one of the reasons for me to pick up gold rather than silver. The deficit story, the 6th-year story, the EV demand, the AI, everything, I would say kind of discounting. People know that silver is required and this is a 6th year of a deficit. But overall, I still think that that's more than silver, the gold would be better in terms of returns. Inflation, maybe the West Asia crisis continues to build up the inflationary pressures. The dovish stance can be the other factor by the central banks. The debasement, the liquidity aspect on the US markets is the third aspect. And the fourth aspect is, which is positive for gold, is the global ETF buying. So we have seen the global ETF buying since mid-October 2025, the highest one in the recent time. So I would prefer gold than silver. As of now, the international markets are at around $67, $68 levels. I would agree with Kunal to a large extent and Somaniji also to an extent. That doesn't see too much on the upside. $80 would be something that we would look forward to. We would be looking forward to have that kind of levels to be done. But then I would say gold would be my preference out of the two bullion commodities.
All right. And Naveen, I missed your levels. What were you saying on where can we see the prices on the higher side for silver?
I'm sorry for missing out that. So $75 kind of levels on the upside, and the downside is restricted to the current levels of around $65, $67, Manish.
All right. So $75 an ounce on the higher side. Mr. Kedia, where are you looking at the prices? We have a big range from 75 to 88 as a target for silver by the time this year ends. Where are you? Where are you in sense of numbers?
So already we have got a 2 vote for gold, but I think panel should be a balanced one, so I will go with the silver.
Okay.
See, one thing is very much clear, this supply is been not at all up to the mark since COVID. Even we have seen the cases in base metal like copper and zinc where the supply comes. It is not at all making up what the demand has been there. As the Kunal rightly said, the deficit continues to be there. Immediate coming up of supply doesn't look like. One more thing is the investment demand, because up till now, we were consuming gold and silver, but now it's a financial product. We have seen much of the fund houses, family houses are now behind the silver and gold both. So I think the volatility is going to be there with silver. We have seen almost 56% correction, but I think it should outperform gold. By this year end, we expect $90 should be the level we can see. To confirm this, we can use gold-silver ratio. Last year, the ratio was around 105. That has crashed down to the level of 44 in Feb 2026. And from there, it has recovered sharply to the level of 72, which we were admiring. But now, from 72, we are expecting by this year end, it should come down to the level of 60, 62, which means silver should outperform gold. No doubt, we are more bullish on gold also. But silver as an industrial metal, critical metal, and shortage, all these three things will support silver, and maybe $90 by this year, and next year we may see a new high coming back in silver.
All right, that's the most bullish view coming in for silver till time. So $90 an ounce a possibility, and a three-digit not ruled out as well for the next year. I quickly want to come to each one of you and talk about the dollar index as well, because that is where we are getting a lot of support coming in from, whether it has been about treasury buyback, and that has led to a decline in US dollar index, the US debt. We've been talking about all of those things. An interest rate hike perhaps may not happen in this year. That in turn also has been quite supportive. But dollar index, in the narrative clearly seems to have changed. There's more bearishness coming in for this one right now. Kunal, how would you look at the dollar index now in the next quarter perhaps?
I believe that looking at the recent developments, the dollar index is likely to decline going forward. But what I'm expecting is not the sharp decline. The gradual deceleration in the pace of decline is what I'm expecting. And it should test, somewhere about 97, 96 and a half. And it will happen very gradually. I'm not expecting it to, abrupt crash, because the thing is, it is not just the US. At some point, the other economies also, who are the constituent of the dollar index, even they will have to print because there's nothing else the Western central bankers are likely to do in this kind of scenario. So Japan is the only country which the possibility of rate hike is very high. That is in Japan. But even if that do so, that is going to sharply lead to decline in the dollar index. So the rate hike in Japan, that means sharp decline in dollar index. So that is not my base case scenario. So I'm expecting dollar to remain weak. And like I said, 96 and a half looks very much realistic levels going forward.
All right, so weakness in dollar index not ruled out. There are various scenarios that seem to be playing out right now, and a weakness in US dollar index will just about add to further gains when it comes to precious metal prices. Well, gentlemen, thank you so much for joining in today with your sense on gold and silver, all of those commodities. And as you've mentioned, there is more bullishness, and Indians would absolutely go out buy bullion. That is what always happens during the festival season, the wedding season. And with the price expected to go higher from here, there perhaps is some neat profit coming their way as well. But with that, that's all the time that we have on this edition of Commodity Champions as well. Thank you for watching.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, the United States has launched a new wave of sanctions against Iran and warned countries and companies that do business with Tehran. Iranian officials have hit back saying that they are fully prepared to deal with them. Here's the Trump administration has announced in a press conference overnight. U.S. Treasury Secretary Scott Bessent unveiled sanctions under the name Operation Economic Outcast. Bessent claimed that Washington has mapped, in his words, every node, every facilitator and every network that Iran has used to smuggle oil and evade sanctions. End of quote. As a part of the U.S. effort, Washington has identified over 60 entities that it claims are enabling the Iranian regime to procure nuclear and missile technology, earn revenue from oil trade, and carry out cyber operations. The U.S. threatened to sanction Iran's trading partners, but has not imposed a timeline for compliance. U.S. Treasury Secretary Scott Bessent said that U.S. President Trump is making calls to the world leaders, urging them to stop doing business with Iran. Iran has played down the impact of the U.S. measures. Iranian economy minister said that neither China nor Russia have accepted U.S. measures and predicted that other countries would also resist them. U.S. Treasury Secretary Scott Bessent said that President Trump has already started dialing world leaders and that the request for support for their campaign will continue.
The president is making phone calls to world leaders with specific requests to cease their interactions with the regime. We are already seeing results. No one is above the reach of U.S. sanctions. That if they facilitate transactions and are part of the ecosystem that turns Iranian oil into money, into repression, they will be targeted.
Well, to discuss what this could mean for India as well as the world, I'm now joined by Mr. Shashank, former Foreign Secretary. Also with me, Mr. Sanjeev P. Yadav, former diplomat and the founder of Banyan Tree Global. Also with us in a bit will be Dr. Thomas Matthew, retired IS officer and strategic affairs analyst. To all of our panelists, thank you so much for joining us. Mr. Shashank, let me come to you first. We've seen some strong words from Scott Bessent there. In his exact words, he said that no one is above the reach of U.S. sanctions, importantly going on to say that they will be taking action. Secondary sanctions will be imposed on all countries, companies that are assisting Tehran. But no sanctions on Chinese banks. This was the one question that reporters had grilled him on. He didn't quite have an answer to that. Give me your thoughts on that. No action against Chinese banks. There are critics who are saying that Donald Trump seems more keen on sanctioning Canadian hockey sticks rather than actual Chinese banks facilitating oil transfers.
Well, China is a very special case because President Xi is likely to visit America in the next couple of weeks. And then later on, President Trump would be visiting China. So I don't think they would like this relationship to be muddied at this stage. Maybe later on they will take action against the Chinese institutions also. For the time being, I think this really they are trying to enlarge it from the direct sanctions on Iranian entities to third country entities, which are already listed earlier, but now I think they are going to make it more specific. And they're not talking about any principles or anything. They are simply saying that nobody is beyond the American arms or American laws. So that is the important thing, that they are trying to say that if you are not with us or if you are with Iran, then you should be liable to be sanctioned and punished by the Americans. I think that is the important new development in the Gulf affairs. And the Iranians have said that, okay, the naval blockade, which has been there now in view of this additional economic regime, they are going to take preemptive action against the American ships. Secondly, they say that they will take action against the American economic interests in the Gulf. That means that they want that the Gulf countries, which are friendly to America, they should be also on notice. Of UAE, of course, has said that because their largest trade partner is UAE. So UAE has already said that, well, because of some Iranian attacks, they will not be doing any trade with Iran.
Let's in fact, but of course, China is the key pillar of this strategy. Bear in mind that there's a fact sheet released by the US that itself says that over 90% of Iranian oil is being bought by China. Mr. Yadav, let me get your thoughts on that. Again, just to draw a parallel, when it came to Russian oil, there was a unique situation where Donald Trump slapped a 25% tariff on India. There was no such tariff on China for purchase of Russian oil. So we've already seen in the past that there are limits to how much influence the US can exert, especially when it comes to China. Is that the case in this situation as well? China is already threatening retaliation. Is this the situation here as well, that barring China, nobody else buy Iranian oil?
Well, yes, I think there's mixed messaging coming out in terms of what the main focus was here. But I think from yesterday to today, we've seen a little bit of an increase in the rhetoric in terms of the Chinese response from sanctions are not helpful to, in essence, a more aggressive statements coming out today. Obviously, the main target here was China. It is, part of this new framework from the US that is in this mid phase of the conflict where we're in a no war, no deal limbo until the midterms. And we're moving forward until the midterms. We're going to see this policy shift towards secondary sanctions being the main lever of pressure. But yes, I think the surprise here is this not pushing after the Chinese banks and the so-called shadow fleet transactions that are taking place. But I think let's keep an eye on what happens in advance up to the September summit, because I think the one area where we haven't seen a timetable is about when these so-called secondary sanctions will go, as President Trump is calling world leaders, trying to exert some pressure and get folks on board. It's a wait and see to see, is there a timetable? Because right now it's a gray area.
Let me just labor on that point a little further. You mentioned Xi Jinping traveling to the US. He's scheduled to travel on September 24th. Reportedly, he'll be taking a big business delegation with him. Just want to get in on the Chinese response. Now, bear in mind that initial statements coming in from Beijing suggest that economic wars are not the answer. China has defended its cooperation with Iran and has said that that could trigger an escalation. Now, in the recent past, we saw what China did with weaponizing of supply chains, what they did with critical minerals. Is this a conflict that the US, that Donald Trump is prepared for, that the world will have to pay for if China were to aggravate this issue, like they've hinted, that this issue will only be escalated from here?
I think what the U.S. is trying to do here is do a little bit of a balancing act, which is very difficult, where they're trying to put some pressure behind the scenes on the Chinese. And obviously, the Chinese are reliant on the Straits of Hormuz for significant oil and gas energy flows. So the Straits of Hormuz relative to Iran is a point of pressure and leverage, and it is in the Chinese interest to get the straits open, one. But I think, two, the U.S. is trying to mitigate any significant response from the Chinese that would ratchet up something in advance of the summit. I think post-summit, we may see, depending on how things go, a little bit more significant action.
Right. I also have with me Dr. Thomas Matthew. Doctor, thank you so much for joining us. I just want to get your thoughts. Iran has been seeing sanctions since 1979. They have more than 4 decades of experience on how to evade these sanctions. Tell us, this move towards sanctioning of Iran as well as countries and companies that are working with it, will it only further the momentum that Tehran has in fact sought to build, whereby there are shadow fleets, there are shell companies, there are non-dollar trades that are done with the help of, say, Chinese banks? Is that the only trend that will go ahead from here on the back of these latest sanctions from the US?
Yeah, thank you for having me on this show. I have a different perspective to this. If you look at the Chinese-Iranian relationship, it's not a core relationship of a Chinese foreign policy realm. First, you see China used to import almost 1.4 million barrels per day oil from Iran the last year. Now it has been reduced to more than 65% reduction, and Chinese are importing only about 500,000 barrels per day. So you see a significant reduction. Now, there is an opinion that the Iranians are masters at cracking or breaching economic sanctions. This is a whole different realm or architecture. Let me take this point further. Until now, there was only economic sanctions. Today, it's a double pincer movement. You have a complete naval blockade, which is reduced to a trickle, any flow of oil, and this is combined with the economic sanction. So let's not underestimate the power of the American foreign policy and not underestimate the impact it will have. For instance, you may have shadow fleets, but can the shadow fleet breach the American blockade? The answer is no. Can they go back to the southern ports of Iran to pick up oil? The answer is no. The only option Iran has is to go through this, land route, which is not pragmatic, which is not practical. Oil cannot be shifted to the land route. What they can do is probably about $50 billion, which they have trade over land, which is non-oil. Even that is well nigh impossible for the simple reason that the increase in the cost would be around $16 to $17 billion. Now, can they afford it? The answer is no. Now, you need to understand the economic impact on Iran. You are looking at about 90% inflation. That is chicken and meat, about again 190% inflation. Then cost of vegetable oil has gone up by about 400%. Egg and rice by 211%. Can Iran sustain it? For how long can Iran sustain it? Please understand, according to me, my understanding of international relations, that there is no way
the
you
Iranians
can
find
breach.
themselves in. A very difficult situation is what you're saying Tehran finds itself in.
It is absolutely impregnable, according to me. You may have trickles of trade, but that's not going to change the fate of the 90 million Iranians are today facing acute food shortage and commodity shortage in Iran.
Sure. We're completely out of time, but I'll just come for a quick 30 seconds to Mr. Shashank. Mr. Shashank, how do you see India navigating this situation? You believe there is capacity, there is appetite for perhaps a carve-out for India, like we saw exemptions in the case of purchase of Russian oil. Do you think India can negotiate a similar carve-out here?
Well, India must try to negotiate with the United States that right from the very beginning, India has been working in a manner so that the U.S. policies in the Gulf are not breached by the Indian side. We have got some exemptions we got for Chabahar. We also got some exemptions for some trading to Afghanistan and other places. So I think we should try to find out whatever is possible. And at the same time, to find alternative means of getting our energy resources, fertilizers, and all other requirements for India, because our population is high and the government has a responsibility to take care of our people.
Right, Mr. Shashank, again, that's what energy experts are saying. As per the US, can't buy Russian oil. As per the US, can't buy Iranian oil. And that is what leaves our energy matrix in a bit of a bind. But I'd like to thank all of our panelists for joining us, Mr. Shashank, Mr. Yadav, Dr. Matthew, for being a part of this conversation. With that, we're slipping into a very short break, but don't go anywhere. Coming up next, a bedroom with a private Shah, a living room customized with gourmet food. All of that at 40,000 feet. We take you inside the world's most exclusive seat on a commercial flight. Welcome back. Now, commercial aviation is usually a battle over price, but at the very top end, there is a very different kind of passenger. A passenger who's willing to spend thousands of dollars for more space, privacy, and personalized service, even on a commercial aircraft. Etihad Airways is betting on that market with the residence. A 3-room suite in the sky, complete with a living room, separate bedroom, and a private shower. But who's actually paying for this level of luxury? Well, and how much does it cost? And is there enough demand to make this business case work? Well, Madhya Mujawar takes us inside Etihad's ultra-luxury proposition and looks at the economics behind it.
Commercial aviation sits at two completely opposite ends of the spectrum. On one side, it's a constant battle to save every 100 rupee on a ticket. You're fighting for an extra inch of legroom, a slightly wider seat, a little more recline, and eating a meal off a tray table barely bigger than your iPad. And then there's the other side. Today, we are stepping inside to see what that other side actually looks and feels like. I'm not talking about a bigger seat, not a flat bed, not even a private cabin. I'm talking about a 3-room apartment in the sky. A living room, a separate bedroom with a double bed and your own private shower at 35,000 feet. It's called the Residence, and Etihad is the only airline in the world to have a 3-room suite in the sky. The Residence Suite is only available on routes where Etihad operates its A380, the world's largest commercial passenger aircraft. It currently flies on routes including London, Paris, Toronto, Singapore, and Etihad has now brought the Residence to Tokyo as well. Tonight we are flying on this ultra-luxury product, but for the Residence passenger, the experience doesn't begin when you step on board. It starts right from your doorstep. From complimentary airport transfer to dedicated check-in, a private lounge and even spa services is all you get even before you board the plane. Etihad had grounded the A380s during the pandemic and has now brought them back to meet what it says a strong demand for premium travel. And waiting for us at the aircraft is Etihad's Chief Commercial and Revenue Officer, Arik Dey.
Hello.
Hi,
Welcome.
Arik.
How are you doing?
I'm good,
Great seeing you. Welcome to your 380.
Thank you.
Let me walk you to the residence.
Are you seeing that kind of demand for luxury air travel that you felt that this plane has to come back?
Look, absolutely. I mean, you've been on this flight, you're on this flight. Every seat is taken. Every seat in economy class is taken. All the 10 first class apartments are taken. The residence is taken. And the 70 business class seats are taken. So premium demand has come back very strongly, right? Premium demand is strong across the board and the numbers are very robust. If I look at first class, and we are carrying 40% more first class guests now than we did last year.
But the Residence Suite takes that proposition much beyond the first class. This is the living room. Walk through another door and there is a separate bedroom with a double bed. And then perhaps the most striking feature, a private shower. All of this occupies 125 square feet of space inside the A380. But this is where the luxury proposition meets the business case. An airline is dedicating 125 square feet of aircraft real estate to just 1 or 2 passengers. So who is willing to pay for it, and does the economics of the Residence actually work?
Capacity on our planes are around 25-30% in the premium segments, and our revenue production does better than that. 80% of residents are full. The Residence is a very profitable part of our network. So if this didn't make sense, we wouldn't bring things back, right?
Do you see competition coming from other commercial carriers?
Not really.
Then is your competition the private jets?
It's honestly, there is some competition with private jets, but the competition is really with a set of people who are flying first and want something extra and special. We've had people propose on the residence. We've had marriages in the residence. So it really is a once-in-a-lifetime kind of thing.
So if I have to compare the residence from a price point with private jets, where does it stand?
Look, it's, I would say, 25% cheaper than a private jet. Because unfortunately you cannot change the time of the flight to Tokyo or London or any of the cities. So that flexibility the private jet gives you. Most private jets don't have a personal shower. Most private jets don't have the twin bed that we have that you're going to see.
The residence, however, isn't just about selling one of the most expensive seats on a commercial aircraft. Etihad says the bigger opportunity is the growing appetite for premium experiences, which is why it is investing across the premium cabin spectrum.
So how much has the residence helped you fill in the rest of the premium segments? Is there a behavior that I'm going to fly on the plane that has the residence? Has it helped you?
I think it definitely has helped, right? I think that any brand having a halo product like the residence, it helps. But I think what really helps is the ability of us to deliver consistent, great customer service, right? I think the residence helps, but I always say marketing without having substance will never get you to create a long-term brand.
Give us some color on who are these people who fly on the residence.
I can tell you that in the last 3 months itself, famous Bollywood celebrities have flown the residence. A couple of India's who and who cricketers have been on the residence. And then for a lot of people, it's an aspiration product that they save up for.
How much would the residence cost for someone traveling from Mumbai to Tokyo?
So Mumbai to Tokyo would be, roughly speaking, it could be anything from a base first class fare for around $6,000, and then you would have a residence top up of around $2,000 to $3,000 per segment.
What is the most expensive residence? So is it the London route?
Toronto.
How much does it cost?
You can get a residence in Toronto for. We've seen people buying for $20,000 US. It's an upsell from first, so you can buy a first class ticket using your Etihad guest points or your partner airline points, or you can buy a ticket, right? And then after that, we give it to you as an upsell for an ancillary. And that could be anything from roughly $2,500 in a short segment all the way up to $5,000.
When you say the load factors are at 90%, how much of your load is filled by Indian passengers?
Our Indian load factors remain well above 90%. India is one of the top 5 segments for us. Premium segment in the top 5, Indians are there.
You have so many HNIs in India?
I think so.
At one end of aviation, passengers are trying to save every rupee on a ticket. At the other end, there are passengers willing to spend thousands of dollars for an entirely different way of flying experience. And at 40,000 feet, this is what that price ultimately buys you. Breakfast in bed, in your own private apartment, in the sky. Madiha Mujawar for CNBC TV 18.
And with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Well, hello and welcome to this special show on 10 years of UPI. I'm Ritu Singh. UPI has gone from being a payment experiment to one of the world's largest digital payment network in just a decade. And as UPI turns 10, the best way to understand the transformation is to look at the growth curve. Now, transaction volumes have grown from just 1.8 crores in FY17 when it started to more than 24,000 crores as of FY26. That's nearly a 13,000-fold increase. And the value of transactions has also gone from virtually zero to more than 314 lakh crore rupees per annum. That puts the decade-long compounded growth rate at a staggering 188% in volume terms and 155% for value. Now, growth rates, of course, have slowed down because the base has exploded, but look at the absolute scale. UPI processed nearly 2,366 crore transactions in a single month, worth about 30 lakh crore rupees as of July. Now, that is roughly 76 crore transactions on UPI every day. So the scale is undeniably enormous. Here's another interesting split. Merchant payments make up 63% of the volumes. That gives it the frequency. But person-to-person payments account for 70% of the value to give it the size. Let's get you an even clearer picture of the scale. UPI currently makes up more than 84% of all digital payments in India. Globally, it accounts for half of all real-time payment volumes, and it is now live in 11 countries. But despite that massive scale, the UPI app market remains highly concentrated, with the top two players, PhonePe and Google Pay, together handling nearly 80% of all transactions. And that's exactly why NPCI has been pushing for a 30% market cap. But, to address this concentration risk, but the cap is yet to be enforced, and the compliance deadline has been pushed to the end of the year. So to sum up, think of the UPI story in three acts. Act 1 was adoption, Act 2 was scale, and now we're in Act 3, where sustainability is the question. That's where the MDR fee debate also comes into the picture, with the government opening the doors to potentially charging select merchant transactions in the future. Because how do you make a network this big economically sustainable? That could be the defining question for UPI's next decade. So with that, let me welcome our guests on the show, Mr. Dinesh Khara, former chairman of State Bank of India, Amrish Rao, CEO of Pine Labs, and later we will also be joined by Mr. A.P. Hota, former CEO of the NPCI. Gentlemen, thanks very much for your time here on CNBC TV 18. Mr. Khara, just the lay of the land here. What to your mind has been the biggest success and the biggest failure of UPI? I mean, for instance, sure, it's doing 23 billion plus transactions a month, but currency in circulation is also hitting record highs, growing in double digits year on year. So, the achievement sort of is clear in terms of formalization, but what do you think have also been the drawbacks to focus on?
Well, I think the major aspect is that the penetration of UPI across the country. And it goes to the extent of, say, tier 3, 4, 5, 6 cities. And also the other aspect is the trust which has created. I think it is quite phenomenal. Because, today when it comes to, when you go for the transaction, you can simply push your QR code and you can go ahead in terms of transaction. And that gets accepted even by the auto rickshaw driver and even by the vendor, vegetable vendor also. So that is a very clear reflection that it has actually enhanced the trust in the payment system, and which goes a long way in terms of building up any digital rail. I think when it comes to the challenge, of course, we have seen that very significant number of transactions are up to 500 rupees. So naturally, the volumes which have gone up, it actually leads to the pressure on the system. And I think now with the MDR enablement now in place, perhaps it will probably support the building up of the technology rails and ensure the sustainability of the platform also in the days to come. While I'm saying so, I'm very mindful of the fact that the UPI MDR may be for the high value transaction, may not be required to be levied for the low value transaction. But nevertheless, that will ensure the equity, that will ensure that the players who are already there in the system, they can invest in the technology. So that is something which is there. And also, when you said that what will probably make it even more robust, I think it is the grievance redressal mechanism, which has to be significantly more robust, considering the volumes and the value which is being transacted on the UPI.
Well, thanks for setting that up for us, Mr. Khara. There's lots to cover, across those points you've raised. But Amrish, let me bring you in as the voice of the industry in the show here. UPI has become so dominant that for a fintech or a merchant, not being on UPI is almost not an option today. To your mind, has it created this new problem where everybody depends on the same payment rail, but few are actually able to make any kind of money from this?
I've thought about this topic a lot. The way I would say this is, in any other country, most fintechs have to first build out the infrastructure for payment systems to run on, and then actually build applications on top of that. I think this is a gift that we've got, where the rails for payments infrastructure has been developed by NPCI, by the support through the government. And we as fintech founders have to pretty much just build on top of that infrastructure and on the highway. Of course, there are some areas which will then be quote unquote negative for us, but there are way more positives associated with it. So I have to say, as a fintech founder, somebody who actually started off almost 25 years back in the Indian payments industry, to get to see that almost 30% of all retail payment transactions are happening digitally because of UPI is absolutely stunning. So quite appreciative of these last 10 years.
Well, completely take your point, Amrish, appreciative of the last 10 years, but then you've also had exactly a 10-year period to build a business on top of UPI. Why, to your mind, has no one been able to crack a really big, a profitable business model around it yet? And we'll get to the MDR in just a bit.
I think it's a very, very important point that you raise out there, right? Right now, the way NPCI has operated and scaled, you have to remember that there has been significant investment which have gone in by the banks, by the government, and also fintechs. I've said this on record many, many times. I think when you consider for what banks have done and fintechs have done, and VC investors have done for the UPI ecosystem, almost 50,000 crores has been invested in growing this UPI infrastructure and getting it to where it is right now. For us to scale from this 30% number to 80% number, I think we're going to have to look at this mechanics in a slightly different way. Now, we as fintech operators, there have been many, many interesting ideas which we have run on top of UPI. I'll give you one small example and allow me to do that. There's an influencer, digital influencer. What she does is she runs classes purely for, well-being on a regular basis, charges 49 rupees per day for those classes. She takes all the payments on UPI. 10 years back, this business model wouldn't have existed. When you look at what's happening with insurance and how insurance premiums are being paid today, there's zero cost of receiving that insurance payments. That model did not exist 10 years back. I can rattle up literally 50 examples when new business models have got created. What we as fintechs make, let's leave it for another topic.
Well, Amrish at least is lifting 50 business models that wouldn't have existed had it not been for UPI. But Mr. Khara, the other side of this success story, for every one of those supposedly free transactions, it's cost someone money at the end of the day, even if the merchant or the customer was not paying for it. Banks, for instance, they've carried a large part of that cost for 10 years. So if you look back now, how big a bill, if you could put a number to it, have banks effectively picked up for this ecosystem to grow and for someone else to really be riding on that network?
No, I think when it comes to the contribution of the banks, we have to see it that it is more in terms of formalizing the economy to a greater extent. So I think when we started UPI, it was essentially perceived that it will probably help in integrating the smallest of the smallest wages person with the formalization of the economy. And also, the banks will have a very clear visibility of the cash flows of such entities also. So, which eventually helps in terms of lending. So, I think that's a collateral gain which all of us have got, and no doubt about it that it has certainly helped in terms of the growth of the economy too. But I think when it comes to what was being said by Amrish in terms of the newer business models which have come into existence. Of course, I think it's more like a tectonic shift in the economy, because many of the e-commerce transactions, and particularly if at all, I will draw your attention to the year when the COVID actually hit. the whole of e-commerce was actually riding on the UPI, and also post demonetization, the way there was currency was some of the issue. So I think the UPI was something which was at the rescue. And the other piece which you also mentioned in terms of the currency in circulation, you said that the currency in circulation, of course, has gone up, but we have to see it in the context of the GDP growth also over all these years. If at all the UPI would not have been there, the currency in circulation would have gone up significantly higher. So I think these are some of the aspects which cannot be lost sight of. But nevertheless, for any such activity to be sustainable, it should be on its own, which means that there has to be some kind of a cost which can be recovered through this mechanism.
Well, let me bring in Mr. A.P. Hota into this conversation as someone who was helming the NPCI when the UPI was launched in 2016. So, just put some historical backdrop to this, Mr. Hota. UPI was deliberately built around interoperability and this low-cost payment model. Now the government, of course, is talking about bringing back MDR to sustain this ecosystem. Do you think the industry underestimated the cost of sustaining a network at that scale, or what really was the thinking behind the economics of this when it was launched?
Till 2020, MDR was very much in mind, and it was prevalent also. In 2020, during the Corona period, and the government stepped in. The government could see the power of UPI in digitization of payments, and when physical contacts was less, and e-commerce was the best way to really order things and make the digital payments. The government thought it appropriate, and justifiably so, to really do away with the MD. And economics was very much in the mind, and even after that also, not that there is no economics. NPCI gets the money. The players also get a part of it. Really, the people who do not get that much compensated are the banks and certain intermediaries who do not get as they were getting earlier. Not that it is totally free. Obviously, banks take the load. Now the public policy is as to whether the bank should take the load of this expenditure, and the intermediaries should get well compensated to the point of making profit in payments. So that is the question. I support MDR for certain categories of transactions, but not that it should be really paid for all the transactions.
All right. So, Amrish, if you could come in on this, the elephant in the room, MDR. So, if eventually it does have to, UPI eventually does have to carry a price, what is the right price to keep the ecosystem viable? And I'm only asking because, the conversation has been around charging only transactions above, say, 2,000 or a certain amount. That barely makes, less than 10% of the total UPI volumes. Is a 30 or even a 50 basis points there going to be enough?
See, I'm going to be completely honest on this topic, and I'll be a consumer first.
We hope you've been, Amrish. Yes, go on.
As a consumer, there is no way a consumer should, first of all, get charged for UPI transactions, and that should remain consistently the same. That's point number one. Point number two, when it comes to small merchants who are barely getting their economics right, I think there should not be any cost associated to those. However, when you look at large merchants and merchants which are operating at scale, I think they will have to participate along with fintechs and banks to grow this whole UPI infrastructure. And hence, MDR for that category seems to be an obvious thing to do. Now, when it comes to pricing, it should also not be in a range where it becomes prohibitive for that number to grow. My guess is somewhere the right weighted number is between a 25 basis points to about a 35, 40 basis point. That's the range in which I think the market will have to operate on. As scale increases, these 25 to 40 basis points can become significantly larger, allowing us to go into a tier 5, tier 6 cities. You asked, Sir just now the question about why is that cash is still running in the economy. Cash is not running in the economy in tier 1, tier 2, tier 3 city. It's really much beyond that where cash is running there. I think that is what we really need to target. And for going into those markets, there has to be an economic infrastructure which allows us to operate in those markets, but not at a prohibitive rate. So a direct answer to your question would be somewhere between 25 basis to, let's say, 35 basis would be an appropriate number to work with.
So, Amrish, just a quick follow-up, 25 to 35, 40 basis points. Do you think that would impact merchant behavior in any way? I mean, will it slow adoption? Will it push them towards other firms? Or will they just accept the cost and move on simply because of the ease of doing business here?
Ritu, I've been in the payment space for the last 25 years, and I'm going to say this once again. I have never seen a merchant refuse a commerce transaction because of 1% being charged on it. A merchant, a businessman always wants to complete a transaction, and for that, they are ready to pay a fee. I think this is just hype that merchants will not want to take up a fee. I have never seen a merchant refuse a payment transaction. So you have to believe me, as a practitioner here, I don't think so there is any merchant in India which is going to refuse a transaction fee of something around 25 basis points or 30 basis points.
All right, take that point. Mr. Dinesh Khara, just quickly coming to you about what next do you think is something at this scale that UPI can solve? For instance, it's all the payment problem. It's also taken away a lot of the payment part of the rail from banks to fintechs. But what about credit? What about credit on UPI? Why do you think that's not picked up to the extent it was supposed to? And what's the next big issue that something of this scale could solve for?
I think before I get into this question, I would like to add to what Amrish just mentioned. Particularly when it comes to merchant, we have to recognize the fact that if at all they would have been dealing with cash or checks, there would have been some costs they would have incurred. So I think it is actually this 30 basis point and not cost is nothing very significant. And secondly, what has happened is that UPI has now become a part of the behavioral aspect of the customer. So I think the merchant will actually welcome this kind of a situation. That is one. Secondly, the next step which is going to happen is with the help of UPI, since we have got a very clear visibility of the credit history or maybe the transaction volumes of the SMEs and also the small businesses, it's very easy to lend to such businesses because all this while they were excluded from the formal financial system of the country. And I think this is the best way to include them into the formal financial system. And maybe with the help of UPI, it's very easy to really visualize the cash flow and the cash flow gaps and fund those cash flow gaps. And that too digitally is something which is going to happen. We will get to see that soon. I think it should be within a year or so. We have already started experiencing it, but I think it will actually become quite popular across the country. This is what my reading is.
Well, and we hope that does come true. Mr. Khara and Amrish, both of you, thank you so very much for joining us here with those valuable thoughts. Lots more to cover, but, we'll thank you at this point of time, and always a pleasure having you on CNBC TV 18.
Thank you.
Thank you.
Well, we'll slip into a short break, but don't go anywhere. We'll continue this discussion with Mr. A.P. Hotha when we return. Welcome back to this UPI special show. It's 10 years of UPI it is. Mr. Hota, before we end the show, I finally wanted to ask you, if you were back in the NPCI office today and had to redesign UPI for the next 10 years, is there something you would do differently?
Obviously, we would canvass a great deal for the banks to get involved much more and invest in UPI. That what benefit they get. You know, had there been no UPI, would the banks have been able to sustain this much of transactions? Their counters should have been full, cash counters should be still, chaotic or really disbursement of cash and receipt of cash. So moving away from cash, and going for digital payments is good for the banks, and they must invest in that. If we have to redesign, or we'll have to do what we need to do, we'll have to get ready for very large at the bank level. And obviously, the consumers should have to be, consumer concerns would have to be addressed. A lot of, fraud issues are there, for which a new institution has already been set up. Thanks to RBI, they have set up a committee. I had the privilege of chairing that committee. As per that committee, a new institution specializing on intelligence, digital payment intelligence, that is also coming up. So this consumer awareness and fraud mitigation would also be the areas where we will have to work.
All right. Interesting thoughts there, Mr. A.P. Hota. Thank you so very much again for joining us here on CNBC TV 18. And with that, we'll wrap up this UPI special show. But don't go anywhere. News and updates will continue on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening. The U.S. launches Operation Economic Outcast, threatens severe sanctions against countries maintaining economic ties with Iran. Tehran says it is fully prepared to counter the sanctions. Iran's largest trading partner, China, says economic warfare and pressure tactics will only fuel the conflict. Washington sanctions 4 Indian companies and 3 Indian nationals for their alleged role in Iranian petrochemical trade. Rice, tea and pharma exporters face more uncertainty after the UAE snaps economic ties with Tehran, cutting off a key transshipment route. Many Indian traders exploring Turkey as an alternate payment channel. A late rally lifts the Lal Street. The Sensex and the Nifty hit the highest level in the last 2 months. Rupee gains more than 30 paise against the dollar today. TCS shares rise after securing a $1.5 billion AI deal with Porsche. CEO Krithivasan expects to scale revenues from Porsche's IT subsidiary to $1 billion after acquiring it for $370 million. The U.S. government proposes a new fee of more than $103,000 on H-1B visas, which are widely used by Indian tech workers. This comes just months after a federal court struck down President Trump's executive order imposing a $100,000 fee on the same visa. Federal Bank is looking to acquire a controlling stake in Jana Small Finance Bank. Sources say a deal is likely in the advanced stages. Both banks say they are evaluating various growth and expansion opportunities. CNBC TV 18 had first reported about merger talks in July. The government's offer for sale for Hindustan Copper is fully subscribed. Hopes to raise nearly 3,000 crore rupees from the 6% stake sale, taking the mop up for this financial year to more than 55,000 crore rupees. DPAM Secretary is confident of achieving the full year target of 80,000 crores. Food giants revise their packaging after the food regulator cracks the whip on misleading claims. Absolute terms like 100% pure, natural, pulled off labels of several products. FSSAI says it has issued over 150 notices to companies over alleged violations in the past few days. And India's unified payment interface turns 10. UPI transaction volumes are up a staggering 13,000-fold. Transaction value has seen a compounded annual growth rate of almost 200%. Well, let's go straight to the top story this evening. The U.S. has launched a new wave of sanctions against Iran and warned countries and companies that still do business with Tehran not to do so. Iranian officials have hit back, saying they are fully prepared to deal with these measures. Here's what the Trump administration has announced. Now, in a press conference overnight, U.S. Treasury Secretary Scott Bessent unveiled sanctions under the name Operation Economic Outcast. Now, Bessent claimed that Washington has mapped, in his words, every node, every facilitator and every network that Iran has used to smuggle oil and evade sanctions, end of quote. As part of the U.S. effort, Washington has identified over 60 entities that it claims enable the Iranian regime to procure nuclear and missile technology, earn revenue from oil trade, and carry out cyber operations. The U.S. has threatened to sanction Iran's trading partners, but has not imposed a timeline for compliance. U.S. Treasury Secretary Bessent said U.S. President Trump is making calls to world leaders, urging them to stop doing business with Iran. Now, Iran is playing down the impact of the U.S. measures. Iran's economy minister said neither China nor Russia have accepted the U.S. measures and predict that other countries would also resist them. Here's Scott Bessent on the new economic measures that the U.S. has announced against Iran.
The president is making phone calls to world leaders with specific requests to cease their interactions with the regime. We are already seeing results. No one is above the reach of U.S. sanctions. That if they facilitate transactions and are part of the ecosystem that turns Iranian oil into money, into repression, they will be targeted.
Well, that is the U.S. Treasury Secretary on Operation Economic Outcasts. But crude oil prices have actually declined in trades as investors appear to shrug off the new U.S. sanctions on Iran. In fact, many brokerages view the economic pressure poses less risk to oil supplies than a military escalation. So how will these new sanctions impact Iran? The answer does not lie in Washington or Tehran, but in Beijing. Aishwarya is standing by to explain. Aishwarya.
With its latest round of sanctions under Operation Economic Outcast, the US is threatening what it has called an economic asphyxiation of Iran. However, how this works out depends less on Tehran and more on Beijing. The US has immediately sanctioned 60 individuals, companies and vessels and identified 5 sectors that it's called the vital lifelines of Iran. These are digital assets, technology, gold, shipping and aviation. It's also targeting those supplying Iran's military and missile program. But the larger move here is the threat of secondary sanctions against countries and institutions that continue to do business with Tehran. Washington is not imposing these penalties across the board just yet. Bessent said that countries are first being approached with what he called quiet diplomacy and given time to shut down identified activities in a given time frame. The biggest test here will be China. Beijing is Iran's largest trading partner, buying upwards of 90% of Iran's crude. It's also reported nearly $10 billion in bilateral trade with Iran in 2025, excluding an estimated $31 billion in unreported Iranian crude purchases. That makes China Iran's most important economic lifeline. Previous US attempts to disrupt oil trade have created some difficulties, but they have not been successful in stopping the flow of Iranian oil into China. This time too, Beijing has rejected the measures as illegal and unilateral sanctions, with its foreign ministry saying that economic warfare and maximum pressure tactics fuel conflict and disrupt global and economic financial order, and insists on calling for de-escalation and dialogue. Asked whether China could face secondary sanctions, Bessent said that no country or entity was above or beyond Washington's reach. However, the US has not yet targeted major Chinese financial institutions. Separately, however, Bessent did say that a major financial institution could be sanctioned later this week. Iran, meanwhile, insists that it was expecting these sanctions and is prepared. Iran's economic minister Ali Madanizadeh said that Tehran has drawn up a 2-year plan to manage the country's economic affairs and said that Americans have done all they could to test Iranian patience, but have repeatedly failed to do so. So, Operation Economic Outcast may not just be a new confrontation between the US and Iran, but it's also likely to test how far the US is going to push China. And this is going to happen just weeks ahead of President Xi Jinping's expected visit to Washington.
Absolutely, that is going to be crucial, Aishwarya. Many thanks for joining us. So what exactly do the US sanctions mean for Indian exporters? Sandhya is standing by to explain. Sandhya, what's the likely impact on Indian exporters?
So the US claims it has targeted 60 Iran-linked entities, individuals and vessels across Iran's nuclear, cyber, missile and oil networks. And importantly for India, 4 Indian entities figure in this list. Gujarat-based Potis Partners, Faridabad-based PP Softech, Karwar-based Prakriti's Infra Impex and Delhi-based Sadashiv Overseas. All 4 are linked to trading in petroleum and petroleum products. 3 Indian nationals linked with these entities have also been named. But the bigger concern for India is the impact on the wider India-Iran trade. India's trade with Iran stood at around $1.63 billion in 2025-26, up to 25th of August, with exports at around $1.26 billion. This comes at a time when Indian traders have already started facing the payment intermediary challenge. India has been using the UAE as an intermediary for India-Iran trade, with payments from Iran routed through the UAE to Indian traders and vice versa. But the UAE suspending trade activities with Iran last week, traders say this route is now under pressure. Many are already exploring Turkey as an alternative. The second challenge is logistics. Indian exporters fear shipments to Iran could increasingly have to be routed through another country if that country agrees to act as a transit destination. Turkey, once again, is one option which is being explored. But that could significantly increase both travel time and costs. Industry estimates suggest the overall travel time could increase 3 to 4 times, with the route potentially involving the Red Sea, Turkey and then land transit into Iran. And this is particularly important for rice traders. Rice remains one of India's biggest exports to Iran. India exported rice worth around $810 million in 2025-26 and around $383 million in the first half of 2026. Tea is also an important trade commodity between India and Iran. In 2025-26, India exported tea worth $52 million to Iran. With the US widening the sanctions on Iran, exporters are facing more uncertainty now.
Yes, that certainly is the case. Sandhya, many thanks for joining us. That is the impact, or the likely impact, of economic outcast on India and its exporters. Let's talk about the markets now. The Lal Street ended the August F&O series on a positive note, with the Nifty gaining about 1.5%. And this was the first monthly F&O expiry since the new closing auction session was introduced. A last hour surge today lifted the Nifty, closing about 115 points higher, 0.5% gain there. Reliance Industries up by about 0.5%, as was ICICI Bank. So that took the markets to the high point of the day. That is the kind of uptick that we saw for our markets this afternoon. But let's talk about a CNBC TV 18 exclusive. Shares of Federal Bank and Jana Small Finance fell in trade today. This after CNBC TV 18 reported that a deal between the two is likely to be in advanced stages. Sources say Jana SFB's promoter is likely to sell the entire 16.9% stake to Federal Bank, triggering an open offer. Sudarshan is standing by with the details. So take us through the likely contours of this proposed deal, if at all it does go through, and what are both Federal and Jana saying?
So an interesting deal is brewing up in the Indian banking space, and we understand from sources that talks between Jana Small Finance Bank and Federal Bank are in advanced stages, and if the deal fructifies, Federal Bank will end up acquiring controlling stake in Jana Small Finance Bank. Now remember, last month, in the month of July 2026, Jana Small Finance Bank had disclosed to exchanges that it's looking to monetize. Basically, promoter is looking to pay its stake in the company, and as of June 30th, its stake was around 16.9% after the promoter had sold almost 5% stake in Q1 FY27. Now, what is the reason of promoter looking to pay its stake? So, the reason is promoter, that is Jana Holdings, owes rupees 700 crore to TPG Asia, and for which the payment due was June 30th, 2026. After that, there was an agreement between promoter, that is Jana Holding, and TPG Asia, and because of that, TPG Asia decided to roll over the payment date to December 31st, 2026. So there is still time for Jana promoter to sell the stake and pay to TPG Asia. Now remember, just last week, Federal Bank has got the board approval to raise up to $500 million via bond. And now we understand from sources that Federal Bank may use the proceeds to acquire the stake in Jana Small Finance Bank. We had written to both Federal Bank and Jana Small Finance Bank. They have disclosed to exchange, they have responded to our query, and both the banks are saying that for growth and expansion, they keep evaluating opportunity.
All right, so many thanks for joining us. That's the CNBC TV 18 exclusive. Now, the government's offer for sale in Hindustan Copper saw strong demand. The offer to sell up to 6% stake was fully subscribed within a few hours. The stake sale is likely to fetch the government close to 3,000 crore rupees. With this, the disinvestment mop-up for this financial year will cross 55,000 crore rupees in just the first 5 months. Speaking to CNBC TV 18, DPAM Secretary Arunish Chawla says he's confident of hitting the budget target of 80,000 crores.
Since Government of India has around 27.9% stake, I know they are not a promoter entity, so there's a possibility that Hindustan Zinc could be the next asset that you're looking at.
Not immediately, not at the moment.
Target for this year is around 80,000 crores, right? In terms of a divestment target.
Yes, please.
You think you get there, or is that? Do you think a more realistic number will be a little bit lower?
Team DPAM has worked very hard. We are confident of meeting our targets, and we are confident of meeting our obligations to small investors.
Well, that is the DPAM Secretary. Now, TCS will acquire 100% of MHP, that's Porsche Management and IT Consulting arm, for $373 million. The acquisition will strengthen TCS's manufacturing, automotive and AI capabilities. It would also help the company expand its footprint in Germany and across Europe. Speaking to CNBC TV 18's Rima Tendulkar, TCS's CEO K. Krithivasan said the acquisition would be EPS accretive from the first full year, adding that the long-term aim is to scale MHP's revenues to $1 billion. Take a look.
I would expect, at least by year-on-year growth of at least double-digit growth from synergy should come in. And so maybe 3 years down the line, I would definitely challenge the team to make it $1 billion business.
Well, that is TCS on the deal just done. The Trump administration has proposed a fee of over $103,000 on the new H-1B visa. Trump's earlier attempt to impose a $100,000 fee on select H-1B visas was struck down by a U.S. federal judge citing illegality. Remember, Indian IT professionals and companies account for a lion's share of H-1B visas. Rima is standing by now to take us through the details. Rima, this is a proposal at this stage, but tell us more about the implications if this were to go through.
You're right. Once again, a $100,000 H-1B visa fee has been proposed. It's a proposal right now. There is a 30-day window for public comments to come in, but the proposal of a $100,000 H-1B visa fee is back on the table. If you remember, it was there even in September of last year. So the first question I had was, isn't this already there? Because the Trump administration last year in September had proposed a similar thing. But at that time, it was struck down by the courts. They said it was not, they needed a congressional approval, and therefore that appeal in front of the court was struck down. So as of now, there is no $100,000 H-1B visa fee, but the proposal to bring it on is back on the table. But this time they're adopting a different route, through the executive route rather than the legislative route. By doing so, they don't need the congressional approval, but the court can still come in and give its opinion or strike it down. But what it does create is a lot of uncertainty. This is the second time this proposal of a very large H-1B visa fee has been proposed. One, it's the size of it. Employers are going to think twice on whether they want to pay. They want to bring on a person who's on an H-1B visa fee. Is he worth it? Do you want to pay that $100,000 extra for him? But even for many of the Indian students who go abroad to study to US universities, and then they work on that OPT program and then eventually start working there on that H-1B visa, this is creating a lot of uncertainty. So in that sense, it's negative. So we don't know for now whether it's going to go through. There is a 30-day window, but it's back on the table and it's creating a lot of uncertainty.
Rima, many thanks for joining us. Food giants rework their packaging as the food regulator, the FSSAI, cracks down on misleading claims. Terms like 100% pure and natural are being dropped from labels after over 150 notices went out to companies. That and more when we return. Several food giants have revised their packaging after food regulator the FSSAI cracked the whip on misleading claims. The FSSAI has issued over 150 notices to companies over alleged violations in the past few days. Rachna is here with that and more. Rachna, which companies have relabeled their products after the FSSAI cracked the whip?
Well, you know, India's entire packaged food industry is right now in the middle of a labeling overhaul, and it's happening pack by pack. The claim 100% is being withdrawn across categories. So Amway has removed it from its coconut oil. Imami has revised the claim on Zandu honey. Bon Biscuits, Juza Foods and Master Chow have taken it off packaging and advertising. So it isn't only purity claims that the FSSAI had an issue with, but also let's look at PepsiCo's new Sting cans that no longer carry the word energy. Heritage Foods has dropped fresh from its paneer packet. The Whole Truth has changed no added sugar claim to sweetened with dates. Behind all of this is a shift in how FSSAI is reading the law. A food label is not advertising copy, it is consumer information. If a claim can't be proved scientifically, it can't be printed on the pack, and the regulator has now extended that logic to alcohol as well, with United Spirits and Inbrew getting notices over flavoring and age declarations. But not everyone is falling in line quietly. Dabur has 7 products barred from sale, including honey, ghee, apple cider vinegar and coconut oil, and is taking legal advice even as it strips these claims off its website. United Spirits has moved the Bombay High Court. Red Bull and Monster have made no visible pack changes yet, with the 90-day energy drink deadline running down. The precedent for all of this was set last year with ORS drinks, where the courts backed the regulator and refused companies even a sell-through of old stock. For the industry, that is the real signal. Marketing language that survived for decades is now a compliance risk, and the cost of rewritten label is far smaller than the cost of a product being pulled off the shelf.
All right, Rachna, many thanks for joining us. Now, India's Airport Economic Regulatory Authority has cut the user development fee for domestic passengers at the Hyderabad airport. This comes just days after a similar cut at the Bengaluru airport. The regulator has now implemented a new tariff framework. Madhya joins us now with the details. Madhya, typically it is higher UDF charges, which means that impacts consumers like you and me. But this time around, it's actually good news for passengers. Will we see more UDF cuts coming in for other airports too?
Possibly, yes, because that's the model that ERA wants to follow now. So higher user development fees or UDF have increasingly become a concern for air passengers as it adds to their airfare. The UDF has also evolved from charging just departing passengers to charging arriving passengers as well. And then came differentiated UDF, with Delhi becoming the first airport to charge international business and economy passengers differently. So now ERA has changed the tariff playbook, and under this model, it has reduced the UDF at Bengaluru and Hyderabad airports that you mentioned, and I'll explain why they've done that. So airports have large capital expenditure plans, new terminals, runways, aprons and other infrastructure projects. Now these investments form part of an airport's aggregate revenue requirement, or ARR, the revenue that the airport is allowed to recover through charges like the UDF. Now ERA is moving from a model where airports recover projected costs upfront through passenger tariffs to an approach where passengers pay when that infrastructure is actually ready for use. So this is also reducing the risk of over-recovery if projects are delayed or not executed. Now, last week, Bengaluru was the first airport to come under this new approach. ERA reduced the domestic departure UDF from 550 rupees to 300 rupees, while international departure UDF is reduced from 1500 rupees to 997 rupees. And today, Hyderabad is the second airport to follow this model. The airport had sought an aggregate revenue requirement of 27,850 crore for the 2026-31 control period. ERA approved a baseline ARR of 11,600 crore, and that has translated into lower UDF for departing passengers, with domestic UDF falling from 750 rupees to 515 rupees and international UDF falling from 1500 rupees to 1030 rupees. The important point here is that airports' future infrastructure investment has not disappeared. What has changed is when passengers pay for it. In Hyderabad, for instance, future projects including the Northern Runway have additional tariffs attached to them, but those additional charges will kick in only after that respective assets are completed, commissioned and put to use. So the principle is simple here. Passengers should not pay today for infrastructure they cannot yet use.
Well, that is important and certainly is good news for consumers. And this is something that I had spoken to Indigo's CEO Rahul Bhatia about. And this is something that they were concerned about, the higher UDF charges and what that was doing as far as ticket prices are concerned. Now, Mumbai's airport braces for a major reshuffle. 1 in 3 international flights from Terminal 2 will shift to the Navi Mumbai airport starting October. According to an email accessed by CNBC TV 18, some domestic traffic from the older Santa Cruz terminal will move to T2 to compensate. Adani-run Mumbai Airport will also begin demolishing part of Terminal 1 from January 15th next year. But with that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Arundhati Ramlin, and with me as always is Shruti Mishra. These are the top headlines from the startup world. Carbon Strong raises 12.5 crore rupees led by IAN Angel Fund to scale low-carbon cement substitutes, targets 1 lakh ton annual capacity in 2 years.
Kedara Capital invests $200 million in Tynor to fund expansion in India and global markets and scale its orthopedic supports and rehabilitated business.
Commercial property insurer FM acquires wildfire intelligence firm Fortress Fire to bring its physics-based wildfire risk modeling technology under FM.
Germany's Infineon acquires C2I, a 2-year-old Bengaluru-based semicon startup, also a beneficiary of the government's design-linked incentive scheme. The deal is expected to close before the end of September.
And India's unified payments interface turns 10. UPI transaction volumes are up a staggering 13,000-fold. Transaction value has seen a compounded annual growth rate of nearly 200%.
Those were the headlines we've been tracking for you this evening. On what's brewing today, learning systems company Lead Group has delivered a strong year of growth and profitability, with operating EBITDA having risen 7-fold to 30 crore rupees in FY26, while revenue grew 10% to 387 crore rupees. The school-focused edtech company now reaches nearly 41 lakh students across more than 9,000 schools and is betting on AI-led products for its next phase of growth. Joining me now is Sumit Mehta, the co-founder and CEO of Lead Group. Sumit, welcome to Startup Street. Your operating EBITDA has jumped 7-fold from 4 crore rupees to 30 crore rupees now, while revenue grew a relatively modest 10% to 387 crore rupees. Tell us what drove this improvement in profitability, and can you also give us a sense of where you stand on PAT and cash flows today?
Actually, we do something that nobody in India does, which is transform schools, and we've been doing it well before School Theek Karo started trending on Insta. It is hard work because changing mindsets and habits of teachers takes time. But we've been chipping at the problem. And as you can see from our FY26 results, revenue is up, EBITDA has grown dramatically. And being a positive CM business, as revenue grows, we are at a place where the operating leverage is kicking in. So most of the revenue growth has translated into EBITDA.
Okay.
And we're on track to become PAT positive and cash flow positive in FY27.
All right. And, like I mentioned earlier, Lead now works with over 9,000 schools, reaching nearly 41 lakh students and 65,000 plus teachers. Sumit, how much headroom is left within your existing school network versus adding new schools? And what are your school retention and revenue per school metrics looking like?
Well, like any SaaS company, we land and we try to expand. So there is definitely headroom in expanding amongst our existing schools by adding more grades and adding more solutions. But look, we are only at 9,000 schools. And in India, English medium private schools of our fee range are about 1.8 lakhs. So we are just about 5%. So there's a lot of headroom in adding more schools.
Yeah.
In terms of retention, because of our great results, retention has been close to 100%. And if you look at student results, both in CBSE board results and now in IIT, they have been fantastic.
Okay. AI is now your big bet for the next phase of growth, but schools already have access to ChatGPT and a growing number of AI education tools. So what are you building that a teacher or student can't simply get from a general purpose AI assistant? And where is, basically Lead's moat?
I never get tired of answering this question, but as an educator, we know that a chatbot is not a tutor and an 11-year-old is not an adult. So we got to design AI solutions which sit at the intersection of curriculum, pedagogy, and technology. Because see, a chatbot can answer a question, but somebody has to tell the student what questions to ask and what questions to cover. And that's the role of a teacher and curriculum. So we are designing AI solutions which actually complement and work in conjunction with a teacher and are able to help the student learn and not just provide ready answers.
Okay. But picking up from what you just said, there is, of course, a lot of excitement around personalized AI tutors that can potentially adapt to every child's learning level. Sumit, how close are we to that becoming mainstream in Indian classrooms? And could an AI tutor eventually become as important to a student as the textbook or even the teacher?
Well, it depends. I imagine a future where two kind of things are going to happen. One is for your core subjects, a teacher would teach and introduce the topic and teach a 1:40 classroom. But at the end of the day, the student will sit with the AI tutor to check for their understanding and do any remediation for any topics they don't understand. And the second thing is, in a country like India, where teacher skill is still in shortage in small towns, skills which are not available with the local teacher, like English speaking or test prep, AI tutors can actually supplement local teachers to provide that. When we introduced Miss Curie, our AI tutor, and we've seen results in students improving their spoken English.
All right. Again, picking up from what you just mentioned, tell us, where can AI genuinely make teachers more effective, and where should it not replace human judgment? Are teachers embracing these tools or are worried about them? Also, one challenge with AI in education is proving that it actually improves learning rather than, simply making content easier to generate. So what metrics, Sumit, will you use to judge your AI products? How do you demonstrate that technology is improving student outcomes, not just engagement or productivity?
Well, I must say that currently we are living in a fog where it is required for schools and teachers to be able to discern what is the good and true use of AI and what is not. What will actually result in students just producing AI slop. So when you ask what is the outcome, it's simple. Student learning has to improve by the use of AI tools, and if it doesn't, then it is not going to benefit. So two uses that we see. One is, if I look at a teacher's life, there is about 40% of their time which goes into non-teaching tasks.
Yes.
And AI tools can really help teachers improve their efficiency in terms of lesson plan preparation, assessment correction, giving students answer-wise feedback, which a teacher cannot do for 40 students in a 20-mark paper. So those are areas where AI can really help. And research has shown that if a student gets feedback by their question, within a day of the assessment, it can actually help learning. And the second area where, like I said earlier, local teacher skill is not present, whether spoken English or test prep, AI tutors can supplement teachers in those schools. So those are two areas where we see a definite role of AI.
So, Sumit, you mentioned earlier that Leeds' first batch of grade 12 foundation students has now secured admissions to IITs, while you've also highlighted CBSE board results. Now, does this signal a broader push into test preparation and competitive exams? And how large can that opportunity become for you without losing focus on the core school learning business?
Well, we try to serve a student from nursery to grade 12. And in primary, pre-primary and middle, what is really important is building deep conceptual foundational learning. But as the student graduates to high school, 9th, 10th, 11th, 12th, what starts to become important for them is board results and college admissions. So it is just natural progression that as our students have become older with time, we start developing solutions which help them score good in board results and then into college admissions.
Okay, so that's an area that you will definitely looking into, and you are already looking into that. But one final question before I let you go, Sumit. What's the next financial milestone for the company? Do you see another fundraise ahead? And at what point does an IPO become part of the conversation?
Look, our mission is to provide excellent education to every child. We are only serving 4.1 million students. India has 120 million students going to private schools. So our aim is going to be to just keep on adding more and more schools and serving more students. And of course, the financial metrics will follow. We want to ensure we become PAT positive. We continue on this path of profitable growth.
Okay. All right, Sumit. On that note, I'll have to wrap up our conversation. Many thanks for joining us on Startup Street, and wish you the very best.
And moving on, from flowers and cakes to personalized gifts and now quick commerce, Ferns and Petals has built a 1,000 crore rupee celebrations business over 3 decades. The company grew revenue 25% in FY26 and is now targeting 1,400 crore rupees this year, with its sights set on a potential IPO by 2028. Quick commerce is also emerging as a key growth driver while F&P continues to expand its store network and international footprint. So what's next for one of India's best-known celebrations brands? Let's ask Pawan Gadia, the Global CEO and Director of F&P. Pawan, thank you so much for taking time out and being here with us on Startup Street. You know, it's been a long journey for you guys. You've gone from flowers to so many more things and pivoted to becoming a full celebrations company, right? And you've added all the right benefits to your company. 1,000 crore rupees is a significant milestone. What has sort of been the biggest driver of the 25% growth that you saw in FY26? And where do you see the next leg of growth coming from?
So, F&P on an average in the last 2 decades, we have been growing by somewhere around 30% CAGR year on year. So 25% growth is not something abnormal for us. And a majority of the growth has been coming in through the consistent activity which we are doing across all these years, and especially being either creating curated products or for expanding our distribution, going deeper into the categories and flowers and cakes which we already do, and of course expanding into newer countries. These are the couple of legs on which the growths are coming, and these continue to be important for us in coming times.
Absolutely. And you're targeting this 1,400 crore rupee revenue in FY27 and then 2,200 to 2,400 crore rupees by the time you go public, right? What sort of needs to go right for you to hit all of those numbers?
So the only thing I believe is the execution, the customer experience. We need to maintain what we are doing today, in fact excel beyond that, followed by ensuring that our entire discipline before we enter into a public market, whether it is governance, predictability, capability led long-term unit economics are there in place, is what is going to be the important factor for us to continue to monitor and closely focus upon before we go for an IPO.
Absolutely. And you've guided to an IPO by 2028. That's what you're looking at. That's what you're eyeing. How far along are you in that process? And what are the key metrics you want to improve before you approach the public markets?
So the public market dynamics, what we hear from our investment bankers have changed from what it was a couple of years back. So today the market embraces predictable growth and, more importantly, profitability. And that also being demonstrated quarter on quarter. So that being our most important metric here in terms of ensuring that that is at least in 3-digit plus, so that whenever we hit the market on the forward-looking numbers, we can showcase that in the last 8 or 12 quarters, this has been our consistent achievement on our top line, bottom line. And this is what thereafter we can expect from the market. So the multiples of the EBITDA slash PBT is what we are aiming for. That will remain our North Star.
All right. And another play that you've jumped on to is the quick commerce play, right? And that revenue alone for you has jumped from 8 crores to 65 crore rupees in just a year. Can quick commerce really become 20 to 25% of F&P's revenue? And what will it take to make that business profitable at this point?
Sure. So in GCC, F&P's revenue comes half and half from India and half from the overseas market. In GCC, we are already at a 30% contribution for quick and food commerce in GCC. And India, we are currently sitting at somewhere around 20-odd%. Going forward, this number is only going to increase. Say, for example, this year we'll be aiming in India alone around 125 crores from quick and food commerce. This business is already profitable for us. It's a matter of ensuring our efficiency of scale, our back-end preparation is what is falling into place, and also the integrated back-end supply chain to ensure that the profitability continues to remain and grow. So we have embraced quick commerce and quick commerce or food commerce likes us, and we believe that this is one of the very important channels where the customer discovers us. Of course, the customer segmentation is different in quick commerce versus D2C. This will continue to remain an important, one of the very important channels for us to grow.
Absolutely. A very important channel there to also get onto for people to discover you and your customers to discover you. You now have over 300 stores and want to get around to 350 by FY28, right? How do you sort of balance company-owned and franchise-led expansion while protecting margins and the customer's experience?
Very clearly that in Tier A and maybe all the state capitals is where we would want to continue to have our own company-owned outlets, wherein we can further control, much better control than what we do in these top tier cities. And Tier B and C cities always will be focused with franchisee business. So these two, and then there is a team in place to ensure that the entire store units economics, or for that matter, the store operation reports are there in place to ensure that the customer has a consistent experience. But 300 to 350 is not a very huge jump for us. And ensuring this mostly by a 60-40, that 60% is going to be our COCO outlets and 20%, 20 odd stores will be our franchisee outlets increase is what we are aiming for.
All right, and you're expanding, and you've spoken big about your global expansion plans. You're expanding in the UAE, Singapore, Qatar, and Saudi Arabia, and you are eyeing other markets. What's the biggest international opportunity for F&P, and can India's celebrations model travel globally at this point?
Absolutely, it is already. So as I shared, 700 crores of India revenue, 700 crores of overseas revenue. In UAE and Singapore, we are already the biggest celebration brand. And we have expanded into Qatar and Saudi. Saudi, we are barely there for a year and a half back. And this again is growing at somewhere around 100+% year on year. So Saudi is going to be our next big bet. And I believe that in the next 3 years, it is going to be bigger than UAE business. Followed by, of course, the entire coverage of GCC countries. And in Southeast Asia, we would want to expand in Malaysia and Indonesia.
Absolutely. And, quickly before I let you go, in 30 seconds, what's the big next milestone? Are you looking at, acquisitions or any of those targets in your milestones?
The biggest milestone, as we already discussed, is going to be an IPO. But then acquisitions and thereafter are the smaller legs on which we can further build up. So whether it is an acquisition of a plant company or a gourmet company, or for that matter, a gift card company, are going to be on our radar. And we are evaluating a few opportunities, but then very clear-cut state focus as to how do we hit IPO in FY29 or the calendar year 28 itself.
All right, so a strong focus there on the IPO. All right, Pawan, we wish you all the best on that journey. Thank you so much for taking time out and being here with us on Startup Street.
Thank you for having me.
With that, it's time for us to head into a short break. But coming up next, Commerce Minister Piyush Goyal's visit to Japan has put the spotlight on deeper investment ties with Japan, looking at new opportunities in India. A special conversation with two startups on the other side. Stay tuned.
Welcome back. You're still with us on Startup Street. Commerce Minister Piyush Goyal is in Tokyo holding talks with Japan's leading financial institutions to deepen long-term investment in India as Japan looks to explore more opportunities in the country. Snabit is also looking to tap into this growing investor interest. Abhimanyu Sharma spoke to Ayush Agarwal, founder and CEO of Snabit, about the India-Japan Startup Connect, growing investor interest and the company's expansion plans. Take a look.
I think India and Japan's partnership is one of the most stable in the Indo-Pacific. Japan is India's fifth largest source of FDI, and given the category creation journey that we are on, we see this as a very, very important milestone in deepening ties with the country of Japan, which is now looking at additional new investment opportunities in India. And I think as new startups that are creating this hyper-local disruption in every household, I think my personal motive behind this visit is to obviously meet with investors and introduce this category to this part of the world, which we think is, a very India first category.
What kind of investment opportunities are you looking at? What kind of opportunities are you looking to get investors, as well as expand your category towards more value addition? Because already you are generating jobs in India, but more value addition is something which has been not just the government's focus, but also the industry's focus to increase overall revenue generation.
We currently have roughly around 35,000 experts across 3 categories working on Snabit, and the long-term goal for us in 5 years is to create 1 million jobs here. And we think that, if you look at our last round, one of the participants of the last round was Mirai, which has its roots in Korea. So we do see this part of the country, this part of the world, as a very, very important source of capital. As for this trip, no particular agenda. These relationships are formed over years, not over weeks and months. So we're here to just introduce the category and talk more about it.
Any view on increasing your overall profitability moving ahead, which is possibly going to make the company more attractive for potential investors, and any investors you're going to speak with personally, or either on a B2B basis or otherwise as part of the roundtables to raise investment, to raise capital? Any particular funds or investors you're going to meet?
We're actually meeting most of the prominent funds in the country over the next couple of days.
Any names if you can take?
Not right now, but I think obviously, even without this meeting, I think a core focus for our business, given the kind of growth that we've seen over the last couple of years, has been to now explain and demonstrate what a sustainable business model looks like. So we're maintaining aggression in building this category, launching new categories such as beauty, and ensuring that our old micro markets and our core categories start showing early signs of profitability.
India-Japan automotive ties could also see significant synergies, with Cars 24 seeing an opportunity to combine Japan's engineering expertise with India's software technology and AI capabilities. We also spoke to Cars 24 co-founder and CEO Vikram Chopra to understand where Japan's automotive expertise and India's tech capabilities could come together and what that could mean for the sector. Take a look.
I think this is a historic visit. It's the largest delegation ever to come to Japan from India, and I think the partnership between India and Japan is only deepening. Specifically to our category, automotive, I think there are huge synergies. Japan for the longest time has been an expert in engineering, in the width and the breadth and the depth of their mobility industry. But at the same time, India mobility is growing very rapidly. Plus, we have huge talent and huge capabilities on software side, on technology, and now increasingly in AI. So I think combining their engineering capabilities with India's talent and AI and software skills, I think we can create a huge outcome in everything.
Any cost optimization plans in course of your visit, in course of the meetings you are holding with different stakeholders from the value chain to overall rationalize costs across your entire operations, maybe to grow well? Any targets you're looking at for overall growth and moving ahead? Any expansion you're targeting in other markets apart from India?
We are growing as a company at 30% plus. And we believe that growth will continue to be there for several years given the depth of the India market. But not just in India, we are present in UAE and Australia, and both the markets are growing very rapidly for us. In fact, UAE has turned out to be a big market for us, way bigger than what we had anticipated earlier. And that's where we are constantly looking to find more partnerships in the entire value chain. And that's exactly why I'm excited to be here.
Greening is something which is being looked upon by all manufacturing sectors, and your company also deals with such a sector. Japan, of course, is a front runner in automobiles, as India's minister also pointed out that several Japanese companies have their subsidiaries which have grown much larger than even the parent companies, while he gave an example today, and he said that there are much more Suzukis which are possible to be created in the Indian market. What kind of plans moving ahead do you envisage exist for overall greening opportunities across the value chain, across the sector you work in, and any further collaborations which you are looking at with Japanese automotives or any other Japanese companies across the value chain to grow your operations?
I think greening, India also is focusing significantly on it with the whole effort on the creation of more RVSFs and how more end-of-life vehicles get properly scrapped and not just left alone. So we are we already move a significant volume of cars through us, which are end of life, and we try to work with our RVSF partners.
You're also using a lot of AI for that, possibly?
Yes.
Yeah.
We're working with a lot of RVSF partners to ensure it's done properly. And I think that's where, again, a lot of learnings, a lot of exchange is possible on the technology and the engineering part of how you can do effective greening.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching.
Very few of the NTLFs, and I've always been virtually a permanent fixture there. So it's great to be back here in partnership with NASSCOM to address an issue that is causing significant anxiety at this point in time. But as Naushir was pointing out, it is also an era of opportunity. The question, though, is will Indian IT services make the pivot that is necessary as of today? There's been a lot of talk around the market cap erosion that we've seen from the 2024 peak. We're down 15 lakh crore rupees for the IT services industry in terms of market cap. And the question that's being asked is the market mispricing the anxiety at this point in time? Is there something that Indian IT knows that the market doesn't seem to know? Because when you talk to these guys, they're all basically telling you there is that $300-400 billion opportunity, and that's the kind of value creation that we hope to accrue. So where is the dissonance is the question that we want to talk about. The other aspect that we do want to address is that if there is this $300-400 billion opportunity that opens up by 2030, which is estimated, where does the value creation lie for the Indian IT services sector, and what changes will they need to make structurally in order for them to be able to leverage and gain momentum of that market opportunity that presents itself? There is, of course, the issue that Naushir mentioned, and that is the decoupling that we are seeing between revenue as well as headcount growth, and that has been something that we've seen accentuate and accelerate over the last few years, and it is flat, as Naushir pointed out, at this point in time. The other big question, though, is growth, and are we in this single-digit growth trap for the foreseeable future? Are the double-digit days, is that era a thing of the past, and do we need to recalibrate the growth aspiration that we have? There is, of course, the global story that's playing out, the OpenAIs and the Anthropics of the world, and what that potentially means in terms of this industry specifically. AI monetization, how quickly will that be able to outpace seat cannibalization? I think that's one of the big issues up for debate and discussion. Well, I've got a fabulous panel here to address those issues. So without further ado, Rajesh, I want to start by talking to you. 15 lakh crore rupees gone in market cap erosion since the 2024 peak. What is the market not appreciating about the story? Indian IT, as Salil Parekh told me in our interview recently, Indian IT abhi zinda hai. Why is the market not appreciating that?
Absolutely zinda hai, but I think it's important for us to note a couple of things. One, if you ask anybody in the room, and if you look at the last quarter results of all the companies, the top one included, the medium ones, of course, grew. When you look at the top ones had about 3% year-on-year growth, the medium tier, and many of the companies which actually did fairly well at 9 to 12% of growth, and the smaller ones actually even had higher growth. But more importantly, when you go back and look at the order books, almost all of them had the largest order book ever in the history of this industry. So they've all been doing really well. On the contrary, as you rightly mentioned, all of them had a headwind from the stock market point of view. I do not know how the stock market valuation happens, so I can't really comment on what they do. But I can always tell you one thing. They always price for the worst case, and then when they look at the terminal value, they want to make sure that whatever they are seeing on the order books, whatever the story that we've been sort of saying for the last, 1 or 2 years, holds good for the long term. I know that they're sort of looking at these numbers, and occasionally you'll find that because of the green shoot that we produce as an industry, there's suddenly a sort of a shoot up of our numbers and so on.
Yeah,
but that is what
you're
it is.
18% off your lows.
There
so,
you go.
Yeah.
There you go. So that is, in some sense, so I think quarter on quarter, if they are able to put the proof points on the board, I personally believe that. Will you see an aberration? Absolutely, yes. I think there is going to be a bit of an aberration when you see that this industry will go through bad times before it gets better, as I always say. So I think we're going through that turf at this point in time. But I think in my mind, if you're what we are seeing around the order books and the opportunities that we are seeing, and of course we'll talk a little bit more in detail as to what exactly is the opportunity. And Noshed put some really good data around. People always ask me, will the industry pivot? The industry has nothing to pivot here. I think the individual companies will pivot. Will all the industry players will pivot? Probably not. 80% of them will pivot. Maybe some of them will not pivot. But the opportunity you saw in those charts, the TAM that we are talking about, the opportunities that for the services company to truly cross the chasm, if you may, that's for real. And I don't believe that the markets have actually priced in yet.
Okay, so that opportunity is real. Amit, let's talk to you now in terms of recalibrating growth. And as I said, is the era of double-digit growth something behind us? Do we need to recalibrate ourselves into appreciating the fact that at least for the foreseeable future, for the industry, for companies like yours, it's likely to be low single-digit? And what does that then mean for the next 5 years as far as this sector is concerned?
I think I tend to take a pretty bullish approach on things, and possibly by nature an optimist. But if we look at how things are shaping up, we look at a few transitions, and possibly our industry is experiencing one right now. And it's a transition of two pivots. I think that was also spoken about in the first presentation, of what's under pressure and what's new. And the growth of opportunity in the new is something that we have been reporting quarter on quarter. It's been last 3 quarters we've been reporting, and that's a mark of confidence and conviction. The path that we have taken, the path that we have chosen. The transition on anything to do with operations is expected to be pushed for efficiency and productivity always, with or without AI. That has always been the candidate, and it will always remain a candidate. But the pivot towards new opportunity is what we are seeing more and more. What used to be an industry known for effort, largely our industry has always been known for how much effort we have put in. I think that pivot is moving from effort to intelligence. Our industry is getting redefined for intelligence. Our industry is getting recalibrated for intelligence, and that's a transition that we are all experiencing right now. But a huge opportunity ahead of us.
So let me double down on that. If you're making this transition from, to intelligence, what then happens as far as pricing is concerned? And I think that's the question. And Noshir mentioned that you're moving now to outcome, and everybody's talking about the outcome model and outcome pricing. What does it mean in terms of pricing deflation at this point in time? And, how quickly are you likely to see this model shifting? And two, on the headcount front as well, as we move into this agentic future that everybody is talking about and so on and so forth, what will it mean essentially as far as the current model of headcount is concerned?
I think second question first. If we look at operating model, headcount has been part and parcel of an operating model to deliver services to a customer enterprise. Deliver services in an output, in an effort, or an outcome-based model. It's been a combination of all three. The percentage variation has been very different. Now, when you look at the operating model shift, you'll have a human and AI agent collaborate and coexist in different capacities, in different natured roles, and different skill sets. The ability to price for outcome becomes more profound now because you're committing to what the end experience the customer will gain, rather than the effort that you'll put in. But hand on heart, I don't think so the industry has transitioned to an outcome as yet. We are clearly seeing a shift of effort moving to output, but very small percentage still moving to outcome. But that's a big opportunity in front of us.
And the timelines that you believe that you are likely to see the inflection point as far as this shift is concerned?
Tough to predict. I think if we go back in history, we always take inspiration from history. So if you go back in history, when the mobile era was introduced, say, the consumers have huge excitement around it. Enterprises took a long, long time to come come around that space. I don't think so it will be any close to that lead time, but there is a lead time that is always expected from consumer excitement to being ready for enterprise grade.
Okay, Arundhati Bhattacharya, let me address the big question with you. And I think every headline has been screaming about the SaaSpocalypse. Now, how do you, sitting at Salesforce, deal with this?
I think, our results are expected very shortly. So really can't speak about that in as clear a language as I could. But I think that that narrative has already been proven false. The thing is, we are all in a stage of transition. And let me make this comment regarding this outcome-based pricing. When this outcome-based pricing really starts working, they want to go back to the license-based pricing, okay? Because the outcomes are so many, they don't like it then. Then they want to go back to the early one. But having said that, this is a real case.
Yeah.
So, but having said that, on the SaaSpocalypse, you have to understand one thing. The frontier models, you just can't put them somewhere and expect the entire enterprise problems to be solved, okay? Whenever you're deploying something new, there has to be governance, there has to be auditability, there has to be observability, there has to be, the various regulatory and other compliances have to be correctly recorded. Not only that, in the architecture that you already have, you don't have a clean slate. You're putting in something where something else is already working. So putting all of that together in order to have the best outcomes, it needs a lot of engineering. It's not something that happens on its own. Neither is it something that, any of the frontier models will resolve on their own. And therefore, the requirement for companies such as either ours or even the service companies, that requirement still remains. And the fact is the industry is beginning to realize that piece of it is still very, very important. And therefore, I don't really think the SaaSpocalypse stuff was sort of, I don't know, it was stocked up maybe a little because there was so much investment going into the other companies and they had to take it out from somewhere and probably we were sitting ducks on it. But whatever it is, I don't think that narrative really makes sense. And I've not been seeing that in actual on-the-ground requirement or even in the order books like Rajesh said. We are not seeing that anyway.
Well, the narrative was built by the stock market enthusiasts.
The narrative was built by the stock markets, but you're right in saying that you did see these massive amounts of capital going into companies like OpenAI, Anthropic, and of course, but what I do want to understand from you is what are you seeing in terms of demand? Because I understand that you're in a silent period, so you cannot comment or make any future projections, but look at your agentic ARR, up 200%. What is the sense that you're getting in terms of demand at this point in time?
So, let me just talk about our own company. We are, by the way, customer zero. Like Noshir said, we are not holding back. We are willing to cannibalize ourselves. We are customer zero on our own platform. And even there, if you see, I had started with my own vertical with a project for creating 3x productivity. In a matter of 90 days, I had 99 applications, okay, where in certain cases, they were giving as much as 27x productivity. Some cases, it was lower, it was as much as 1.5, but it depended from case to case. So the fact remains that there is definitely a huge amount of demand. But I think even if there is demand, people have a lot of queries still. The queries on trust, queries on security, queries on cost. There is something that has evolved called token economics.
Yes.
Okay, so that's an entirely new field of expertise.
We've gone from token maxing now to token impacting.
Exactly.
Token impacting is the buzzword today.
That's right. So that's an entirely new area. And in fact, Noshir didn't mention some of the roles. Some of the roles are in that area. How do you maximize the usage of tokens in order to ensure that you get maximum impact and lowest costs? So there are a lot of things that people are still trying to get their arms around. If you ask me whether there is more interest, yes, hugely so. If you ask me, have we seen that actually come down to numbers? I think we are getting there, but not yet there.
Puneet, as I was saying, the only person on this panel who doesn't have a stock problem is Puneet. Microsoft is still
so glad.
is still holding up. But, the massive CapEx spends that we're seeing globally at this point in time, almost $700 plus billion between the, hyperscalers put together, almost $200 billion for Microsoft alone. Now, when we look at this CapEx build-out, and I'm asking this in the context of what the opportunity is for this sector here in India, how does this sector benefit from this kind of massive CapEx build-out that we're seeing happen globally? Where does the value creation for this sector lie when we talk about this CapEx build-out?
Listen, I think first up, the reason for the amount of investments that you're talking about is, and we were having this discussion outside, this is unlike anything else we've seen in our lives. It's the most consequential technology of our lifetimes. And a lot of this CapEx is going into manufacturing intelligence. And intelligence has always been linked to biology. We've always carried intelligence in our small heads. For the first time, we're making compute become cognition, right? For the first time, we're manufacturing intelligence. So that is the race we're on, and that's the reason the investments will continue to go on. To your question on where the value is, and I was with a client recently, and he said, some of these frontier models that I'm working with, they're like brilliant strangers. I said, can you explain this to me? He said, they're brilliant strangers. They know everything about the world. They know nothing about me. Can you get me a familiar friend? Can you get me a child who grows up in my organization, understands my context, the knowledge turns, what does a good work look like, and then get that to answer questions or do work for me, which is where the new value pool is, and Naushir spoke about, right? Which is translating this enterprise ontology, the enterprise context into these frontier models, and getting these models to work for you on your own terms versus the other way around. Satya spoke about the reverse information paradox. Don't pay for these models twice. So I think that is where the real value pool is, and I don't think there's anybody better positioned than the services companies in India who have the context, who have the domain knowledge, who know how to do this at scale.
But let me push back, because this is the fear, right? That given the intelligence that these guys are sitting on, how quickly can the beautiful stranger become your beautiful friend? I think that's the concern, that's the anxiety.
I think the transition from this brilliant stranger to a familiar friend has to be done by the Indian IT services companies, because this is not trivial. We've all seen this, and Naushir spoke about the three things that are true in life. The fourth thing is the enterprise tech debt. There's a ton of tech debt that's sitting there, and it needs to be modernized. It needs to be translated into these models. And again, I'm sure we'll talk about ROI, right? But eventually it comes down to two things, Shireen. First is intelligence, which is intelligence in your own context. Second is trust, to Arundhati's point. We all have agent sprawls in our organization. How do we make sure that we get the intelligence that we want in on our own terms in a trusted way, which is where the service providers are best positioned to go and play. And I didn't pay him to say that, so I'll still charge you later. You can buy me a dinner, Rajesh. No, but I mean it. I genuinely mean it. I think this is where there's a massive opportunity for all of us.
No, and I think Satya has been on the forefront of this business of the limits as far as renting intelligence is concerned, and something that Palantir, Alex Karp has also been carping about, particularly on CNBC. So we'll get into that discussion in a second. But Srikanth, regretting listing?
Not yet.
Not yet. But would it have been better? Were you still private?
See, I think this, like Puneet has just mentioned, this is the most transformational tech that we have seen in our living memory. And to think of this as just one more small wave that'll pass by is, I think, a big mistake. I think whether this on this panel or anywhere else, if you're making that assumption, it's going to change the world in very significant ways. And 2026 is just the beginning. We are at that point where recursive self-improvement is beginning to happen in the models. These models are already building the next wave of the models. The models are getting better at a rate that's unimaginable. They're doing long horizon tasks. So they're not just being part of your tech budgets. Tech budgets are increasing, as Naushir was saying. Yeah. They're going from 4.5% of revenue to 6% of revenue. So there is a certain increase in tech spends that's happening, and many of the service providers can benefit. But if you look at the other side, the labor budget, 20 to 40% of revenue of a company is the budget on human resources. And that budget can also be now exposed to tech disruption, which means that the overall pie that a tech company, whether anybody on this panel or anywhere in this room, can address is a much larger number than ever before. With that massive addressable market, the sky is a limit in terms of how companies like Fractal can perform, and or even any of the people in this room can perform. So eventually the world is moving to more tech dependence.
Yeah.
Now, coming to the tech services companies that are currently struggling a little bit for growth, it's also something we have to understand as a S-curve that is saturating. So if you look at all the tech companies, tech always goes through these S-curves. We have completed the previous S-curve, the era of, sort of doing social, cloud and stuff like that. That S-curve is saturating. The next S-curve comes with the AI wave, right? And companies like here have to reinvent themselves to be relevant in the new S-curve. Fractal is natively there. And secondly, all the companies that are potentially clients of this have to also reimagine their work and workforce with AI, right? So whether it is transforming every business process with AI, building the ontological foundations in their data to be ready for that transformation, or reimagining the talent and workforce so that they are relevant for the new generation. This is not just a tech services or tech companies problem or a SaaSpocalypse problem. It is all companies in the world will have to address this sooner than later to be relevant in the next 20 years.
So that's what I want to double down with each one of you. Let's pick up on this issue of reinvention. And as you pointed out, everybody needs to reinvent, everybody needs to rewire, everybody needs to reimagine. Now, at this point in time, if I were to ask you to pin down for me the 3 strategic imperatives of where this reinvention ought to start, what would you put down?
I would say pick the place where you have the greatest inefficiencies in your organization, or which is your North Star, or where you feel like an important metric that you chase. You pick that part in your organization and see if you can work backwards and redesign the processes to gain traction. That's number one. Number two is that you must look at your the data that you're collecting, the system that you've created, and how to harness that data, create that layer of context in your organization so that you can leverage it. And 3, you must activate your talent to think AI native. Everyone in the organization. It's not just tech people who need to learn AI and get better. It is every employee in the organization has to start using AI in a much more effective way. So I would look at these 3 massive opportunities inside every large company, and you can see that the ones who have cracked this problem are already moving faster than the others.
Rajesh, let's pick up on that. The NASSCOM strategic review said that the need of the hour is to focus on value and innovation. Now, those are large, generic terms. What does that mean specifically as far as the actionables for Indian IT services? Naushad talked about R&D. R&D spends have been woefully, abysmally low, less than 1% or just about 1% as far as the industry is concerned. The big criticism is you guys keep doing dividends and buybacks and so on and so forth. You're not spending enough as far as IP creation is concerned. Does that need to be the big shift? Does that need to be the big priority at this point in time? If so, on what exactly?
So first of all, I'll give it that there is a serious issue with R&D spend. Overall in India, as you know, that as a country we spend 0.7% of our GDP, whether an advanced nation would spend something like a 2.6 to 2.7% of the GDP on the R&D. So there is no question that as a nation we are spending less, as an industry we are spending less, as companies we are spending less. But having said that, for the tech services company, what gets counted as R&D is often, when we talk about R&D, there's always a product mentality around some of this. And I want to put that rest once and for all if I can. See, when you have products and services, the traditional way of looking at what is innovation is a little different, right? I mean, of course you need to spend on building IP and all of that, but let's not forget that, let me see if I can give you an analogy. I mean, I think flying is a great analogy. To have a great flight, you need to have a good aircraft and you have a good airline. The aircraft manufacturers have never been able to run an airline, and the airlines have never been able to build an aircraft. So Boeing makes the aircraft, let me pick a good airline here. Singapore Airlines probably flies it nicely.
I like the fact that you dumped all of the Indian carriers, right?
I don't want to say anything at this stage, but especially given where we are today, I want to be very careful. But that experience, so you have a product plus service combination, if you may, delivers that kind of experience for the end user. So being that the case, of course you need to have core products. I'm not arguing by any means that you have to do less of R&D. You need to do more of this. Tech services companies have really not spent enough. They're beginning to realize that. They're beginning to create a lot more IP. I think it'll improve over a period of time. So that's one. I think they'll have to be a lot more innovative. But let's not forget that what is the biggest, Arundhati and I were together in a different podcast this morning, and we were talking about the enterprise context which the services companies have today are valuable so much that, post starting all the way from Y2K and today, if you really see, they understand this enterprise context of all the corporations around the world, especially the Fortune 1000 and so on. They need to leverage that fully at this point in time, because to truly deploy AI, and then we all talked about as to how critical it is for them to sort of truly get into the bandwagon and take advantage, not just for productivity gains, but also to enterprise transformation. So the second piece of the, how do you really move the needle? These companies have phenomenal opportunities. So all of them, I mean, TCS is on the panel and many of the other companies are not. But if you really see the AI services service line, if you may, is actually focusing on that aspect of it. But you have a lot more coming around that as well.
Ladies and gentlemen, thank you so much for joining us here on this panel. Appreciate your time. Thank you very, very much for joining us here this evening.
What can we say about India's fintech story that hasn't already been said? It's been one of the most extraordinary ones, and we built our digital payments for hundreds of millions of users. UPI is pretty much a global benchmark. Fintechs have moved far beyond payments as well. They're talking about lending, wealth, insurance, financial services, you name it, and giving our banks a run for their money, if I may say so. But the big question, of course, now hinges around sustainability. Now, who pays for this huge infrastructure that has been built, that powers this kind of a growth? The government, of course, has opened the doors to MDR, which is a little fee that merchants will have to, start paying to ensure that this massive UPI ecosystem that we've built continues to live. So, we're here to talk about what that means, whether that makes the system sustainable, and what the next leg of opportunity for scaling fintechs would be. So, again, gentlemen, and Sohini, thank you so much for being with us here. And Sohini, since we're on the topic of UPI, and, we recently just heard from the RBI Deputy Governor that it is very much in your hands, how the whole system gets shaped up, what the fee structure would look like. So just start by giving us a lay of the land. What kind of a fee would make the system sustainable? And, what happens to merchant adoption? Do you expect some resistance to begin with?
Thank you, Ritu. So, while I won't comment on exactly how this is going to shape up, because there is time and there's a process for that, but I think the important thing is to first take a look at how far we've reached, right? Like in July alone, there were about
24 billion,
23.66.
Yeah.
So we will not round that off since it's in billions. Transactions and nearly 30 lakh crores, again 29.8 lakh crores. Roughly 1 lakh crore is what is being transferred using UPI on a daily basis, right? We are at that scale, one would think that you actually just reach saturation, but it's not true. We have a really long way to go. Like UPI, though it seems ubiquitous to us sitting in this room, we're only about 240 odd daily active customers, 240 million, about 500 million monthly active customers. That is still a very, I would say, much lower than the number of people who have bank accounts, number of people who have access to internet, and number of people who have mobile phones. All the three things that are needed for a digital payment. In fact, I can tell you anecdotally, I have taken an auto in Mumbai where the driver said, I don't have a smartphone, I don't accept UPI, so give me cash. So there is a long way for us to go. There's
he
a lot.
He didn't even use UPI Lite?
No, he didn't. He didn't. And I'm telling you, that's why there is a lot of work for us to be done. Because, when people say UPI penetration, it's very easy. And I think it's the lazy thing to do to say, let's look at tier 3 or, back of beyond or something. No, it's in cities. If you take the gender diversity there, you will find that there are more women who need to be on UPI. So there's a lot of work for us to do on getting the basics right, and then marry that with what is required in terms of dealing with the new cybersecurity, the new innovative use cases. We need to get to agent tech. There's that whole spectrum that needs to be covered.
That's a very interesting insight that, even the urban metros are not saturated and there's more work to be done. Anirban, let me quickly come to you since you look at this from a payments point of view as well. I mean, for someone like you, does this create an interesting paradox. You can simply choose to shift the customer away from UPI or the merchant in this case to maybe card if there's a fee and there's some hesitation to it. Or do you think merchants would think of it as, the cost of doing business and move on?
Look, there is always an adoption curve. There's always a conversation to be had. But even if you take the largest of e-commerce merchants and we serve them, take a guess at what is cash on delivery today.
The bulk of your transactions? The bulk of the payments go into cash on delivery, yes. I know, but I don't know what the number is.
Yes, it's about 30%. In many cases, it's north of 30%. After all of our efforts, that costs a lot of money. In some cases, it costs a merchant 400 basis points, right? Because with COD comes higher returns, higher frauds, lots of things. So when you just think of even a large merchant who will end up paying for this, there is benefit, first order direct benefit for them. And then there is massive second order benefits for the whole system, right? I think India is 30%, 35% digitized, much more to go, especially when you think of B2B payments. If you think of all kinds of payments, as Sohini said, we are year 10 of a very long journey. It's a very long test series. We are in innings 2, maybe, right? So from that perspective, some amount of revenues in the system that helps make up for the charges, that helps make up for the costs, for the significant more investments, I think it goes around in everybody's case. And if the whole country is digitized, we'll actually grow much faster as an economy.
Well, Akash, do you have a number that you think would make it sustainable? Because you, again, interact with merchants on a daily basis. And also this interesting question that some people seem to be bringing up, because we're a Jigaru nation, right? So if you say 2,000 is the cap, will you split the bill into 1,999 and the rest to avoid it? I'm just saying there's a way around it. Well, hello and welcome to this special show on 10 years of UPI. I'm Ritu Singh. UPI has gone from being a payment experiment to one of the world's largest digital payment network in just a decade. And as UPI turns 10, the best way to understand the transformation is to look at the growth curve. Now, transaction volumes have grown from just 1.8 crores in FY17 when it started to more than 24,000 crores as of FY26. That's nearly a 13,000-fold increase. And the value of transactions has also gone from virtually zero to more than 314 lakh crore rupees per annum. That puts the decade-long compounded growth rate at a staggering 188% in volume terms and 155% for value. Now, growth rates, of course, have slowed down because the base has exploded, but look at the absolute scale. UPI processed nearly 2,366 crore transactions in a single month, worth about 30 lakh crore rupees as of July. Now, that is roughly 76 crore transactions on UPI every day. So the scale is undeniably enormous. Here's another interesting split. Merchant payments make up 63% of the volumes. That gives it the frequency. But person-to-person payments account for 70% of the value to give it the size. Let's get you an even clearer picture of the scale. UPI currently makes up more than 84% of all digital payments in India. Globally, it accounts for half of all real-time payment volumes, and it is now live in 11 countries. But despite that massive scale, the UPI app market remains highly concentrated, with the top two players, PhonePe and Google Pay, together handling nearly 80% of all transactions. And that's exactly why NPCI has been pushing for a 30% market cap, but to address this concentration risk, but the cap is yet to be enforced, and the compliance deadline has been pushed to the end of the year. So to sum up, think of the UPI story in three acts. Act 1 was adoption, Act 2 was scale, and now we're in Act 3, where sustainability is the question. That's where the MDR fee debate also comes into the picture, with the government opening the doors to potentially charging select merchant transactions in the future. Because how do you make a network this big economically sustainable? That could be the defining question for UPI's next decade. So with that, let me welcome our guests on the show, Mr. Dinesh Khara, former chairman of State Bank of India, Amrish Rao, CEO of Pine Labs, and later we will also be joined by Mr. A.P. Hota, former CEO of the NPCI. Gentlemen, thanks very much for your time here on CNBC TV 18. Mr. Khara, just the lay of the land here. What to your mind has been the biggest success and the biggest failure of UPI? I mean, for instance, sure, it's doing 23 billion plus transactions a month, but currency in circulation is also hitting record highs, growing in double digits year on year. So, the achievement sort of is clear in terms of formalization, but what do you think have also been the drawbacks to focus on?
Well, I think the major aspect is that the penetration of UPI across the country. And it goes to the extent of, say, tier 3, 4, 5, 6 cities. And also the other aspect is the trust which has created. I think it is quite phenomenal. Because, today when it comes to when you go for the transaction, you can simply push your QR code and you can go ahead in terms of transaction. And that gets accepted even by the auto rickshaw driver and even by the vendor, vegetable vendor also. So that is a very clear reflection that it has actually enhanced the trust in the payment system, and which goes a long way in terms of building up any digital rail. I think when it comes to the challenge, of course, we have seen that very significant number of transactions are up to 500 rupees. So naturally, the volumes which have gone up, it actually leads to the pressure on the system. And I think now with the MDR enablement now in place, perhaps it will probably support the building up of the technology rails and ensure the sustainability of the platform also in the days to come. While I'm saying so, I'm very mindful of the fact that the UPI MDR may be for the high value transaction, may not be required to be levied for the low value transaction. But nevertheless, that will ensure the equity, that will ensure that the players who are already there in the system, they can invest in the technology. So that is something which is there. And also when you said that what will probably make it even more robust, I think it is the grievance redressal mechanism, which has to be significantly more robust, considering the volumes and the value which is being transacted on the UPI.
Well, thanks for setting that up for us, Mr. Khara. There's lots to cover, across those points you've raised. But Amrish, let me bring you in as the voice of the industry in the show here. UPI has become so dominant that for a fintech or a merchant, not being on UPI is almost not an option today. To your mind, has it created this new problem where everybody depends on the same payment rail, but few are actually able to make any kind of money from this?
I've thought about this topic a lot. The way I would say this is, in any other country, most fintechs have to first build out the infrastructure for payment systems to run on, and then actually build applications on top of that. I think this is a gift that we've got, where the rails for payments infrastructure has been developed by NPCI, by the support through the government. And we as fintech founders have to pretty much just build on top of that infrastructure and on the highway. Of course, there are some areas which will then be quote unquote negative for us, but there are way more positives associated with it. So I have to say, as a fintech founder, somebody who actually started off almost 25 years back in the Indian payments industry, to get to see that almost 30% of all retail payment transactions are happening digitally because of UPI is absolutely stunning. So quite appreciative of these last 10 years.
Well, completely take your point, Amrish, appreciative of the last 10 years, but then you've also had exactly a 10-year period to build a business on top of UPI. Why, to your mind, has no one been able to crack a really big, a profitable business model around it yet? And we'll get to the MDR in just a bit.
I think it's a very, very important point that you raise out there, right? Right now, the way NPCI has operated and scaled, you have to remember that there has been significant investment which have gone in by the banks, by the government, and also fintechs. I've said this on record many, many times. I think when you consider for what banks have done and fintechs have done, and VC investors have done for the UPI ecosystem, almost 50,000 crores has been invested in growing this UPI infrastructure and getting it to where it is right now. For us to scale from this 30% number to 80% number, I think we are going to have to look at this mechanics in a slightly different way. Now, we as fintech operators, there have been many, many interesting ideas which we have run on top of UPI. I'll give you one small example and allow me to do that. There's an influencer, digital influencer. What she does is she runs classes purely for, well-being on a regular basis, charges 49 rupees per day for those classes. She takes all the payments on UPI. 10 years back, this business model wouldn't have existed. When you look at what's happening with insurance and how insurance premiums are being paid today, there's zero cost of receiving that insurance payments. That model did not exist 10 years back. I can rattle up literally 50 examples when new business models have got created. What we as fintechs make, let's leave it for another topic.
Well, Amrish at least is lifting 50 business models that wouldn't have existed had it not been for UPI. But Mr. Khara, the other side of this success story, for every one of those supposedly free transactions, it's cost someone money at the end of the day, even if the merchant or the customer was not paying for it. Banks, for instance, they've carried a large part of that cost for 10 years. So if you look back now, how big a bill, if you could put a number to it, have banks effectively picked up for this ecosystem to grow and for someone else to really be riding on that network?
No, I think when it comes to the contribution of the banks, we have to see it that it is more in terms of formalizing the economy to a greater extent. So I think when we started UPI, it was essentially perceived that it will probably help in integrating the smallest of the smallest wages person with the formalization of the economy. And also the banks will have a very clear visibility of the cash flows of such entities also. So which eventually helps in terms of lending. So I think that's a collateral gain which all of us have got. And no doubt about it that it has certainly helped in terms of the growth of the economy too. But I think when it comes to what was being said by Amrish in terms of the newer business models which have come into existence, of course, I think it's more like a tectonic shift in the economy, because many of the e-commerce transactions, and particularly if at all, I will draw your attention to the year when the COVID actually hit. the whole of e-commerce was actually riding on the UPI. And also post demonetization, the way there was currency was some of the issue. So I think the UPI was something which was at the rescue. And the other piece which you also mentioned in terms of the currency in circulation, you said that the currency in circulation, of course, has gone up, but we have to see it in the context of the GDP growth also over all these years. If at all the UPI would not have been there, the currency in circulation would have gone up significantly higher. So I think these are some of the aspects which cannot be lost sight of. But nevertheless, for any such activity to be sustainable, it should be on its own, which means that there has to be some kind of a cost which can be recovered through this mechanism.
Well, let me bring in Mr. A.P. Hota into this conversation as someone who was helming the NPCI when the UPI was launched in 2016. So, just put some historical backdrop to this, Mr. Hota. UPI was deliberately built around interoperability and this low-cost payment model. Now the government, of course, is talking about bringing back MDR to sustain this ecosystem. Do you think the industry underestimated the cost of sustaining a network at that scale, or what really was the thinking behind the economics of this when it was launched?
Till 2020, MDR was very much in mind, and it was prevalent also. In 2020, during the Corona period, and the government stepped in. The government could see the power of UPI in digitization of payments, and when physical contacts was less, and e-commerce was the best way to really order things and make the digital payments. The government thought it appropriate, and justifiably so, to really do away with the MD. And economics was very much in the mind, and even after that also, not that there is no economics. NPCI gets the money. The players also get a part of it. Really, the people who do not get that much compensated are the banks and certain intermediaries who do not get as they were getting earlier. Not that it is totally free. Obviously, banks take the load. Now the public policy is as to whether the bank should take the load of this expenditure, and the intermediaries should get well compensated to the point of making profit in payments. So that is the question. I support MDR for certain categories of transactions, but not that it should be really paid for all the transactions.
All right. So, Amrish, if you could come in on this, the elephant in the room, MDR. So, if eventually does have to, UPI eventually does have to carry a price, what is the right price to keep the ecosystem viable? And I'm only asking because, the conversation has been around charging only transactions above, say, 2,000 or a certain amount. That barely makes, less than 10% of the total UPI volumes. Is a 30 or even a 50 basis points there going to be enough?
See, I'm going to be completely honest on this topic, and I'll be a consumer first.
We hope you've been, Amrish. Yes, go on.
As a consumer, there is no way a consumer should, first of all, get charged for UPI transactions, and that should remain consistently the same. That's point number one. Point number two, when it comes to small merchants who are barely getting their economics right, I think there should not be any cost associated to those. However, when you look at large merchants and merchants which are operating at scale, I think they will have to participate along with fintechs and banks to grow this whole UPI infrastructure. And hence, MDR for that category seems to be an obvious thing to do. Now, when it comes to pricing, it should also not be in a range where it becomes prohibitive for that number to grow. My guess is somewhere the right weighted number is between a 25 basis points to about a 35, 40 basis point. That's the range in which I think the market will have to operate on. As scale increases, these 25 to 40 basis points can become significantly larger, allowing us to go into a tier 5, tier 6 cities. You asked, Sir just now the question about why is that cash is still running in the economy. Cash is not running in the economy in tier 1, tier 2, tier 3 city. It's really much beyond that where cash is running there. I think that is what we really need to target. And for going into those markets, there has to be an economic infrastructure which allows us to operate in those markets, but not at a prohibitive rate. So a direct answer to your question would be somewhere between 25 basis to, let's say, 35 basis would be an appropriate number to work with.
So, Amrish, just a quick follow-up, 25 to 35, 40 basis points. Do you think that would impact merchant behavior in any way? I mean, will it slow adoption? Will it push them towards other firms? Or will they just accept the cost and move on simply because of the ease of doing business here?
Ritu, I've been in the payment space for the last 25 years, and I'm going to say this once again. I have never seen a merchant refuse a commerce transaction because of 1% being charged on it. A merchant, a businessman always wants to complete a transaction, and for that, they are ready to pay a fee. I think this is just hype that merchants will not want to take up a fee. I have never seen a merchant refuse a payment transaction. So you have to believe me, as a practitioner here, I don't think so there is any merchant in India which is going to refuse a transaction fee of something around 25 basis points or 30 basis points.
All right, take that point. Mr. Dinesh Khara, just quickly coming to you about what next do you think is something at this scale that UPI can solve? For instance, it's all the payment problem. It's also taken away a lot of the payment part of the rail from banks to fintechs. But what about credit? What about credit on UPI? Why do you think that's not picked up to the extent it was supposed to? And what's the next big issue that something of this scale could solve for?
I think before I get into this question, I would like to add to what Amrish just mentioned. Particularly when it comes to merchant, we have to recognize the fact that if at all they would have been dealing with cash or checks, there would have been some costs they would have incurred. So I think it is actually this 30 basis point and not cost is nothing very significant. And secondly, what has happened is that UPI has now become a part of the behavioral aspect of the customer. So I think the merchant will actually welcome this kind of a situation. That is one. Secondly, the next step which is going to happen is, with the help of UPI, since we have got a very clear visibility of the credit history or maybe the transaction volumes of the SMEs and also the small businesses, it's very easy to lend to such businesses because all this while they were excluded from the formal financial system of the country. And I think this is the best way to include them into the formal financial system. And maybe with the help of UPI, it's very easy to really visualize the cash flow and the cash flow gaps and fund those cash flow gaps. And that too digitally is something which is going to happen. We will get to see that soon. I think it should be within a year or so. We have already started experiencing it, but I think it will actually become quite popular across the country. This is what my reading is.
Well, and we hope that does come true. Mr. Khara and Amrish, both of you, thank you so very much for joining us here with those valuable thoughts. Lots more to cover, but, we'll thank you at this point of time, and always a pleasure having you on CNBC TV 18.
Thank you.
Thank you.
Well, we'll slip into a short break, but don't go anywhere. We'll continue this discussion with Mr. A.P. Hotha when we return. Welcome back to this UPI special show. 10 years of UPI it is. Mr. Hota, before we end the show, I finally wanted to ask you, if you were back in the NPCI office today and had to redesign UPI for the next 10 years, is there something you would do differently?
Obviously, we would canvass a great deal for the banks to get involved much more and invest in UPI. That what benefit they get. Had there been no UPI, would the banks have been able to sustain this much of transactions? Their counters would have been full, cash counters would be still, chaotic, or really disbursement of cash and receipt of cash. So moving away from cash, and going for digital payments is good for the banks, and they must invest in that. If we have to redesign